Very good morning, everyone. Welcome back to CA Intermediate Advanced Accounting. It's a one-day marathon revision that we planned, which was supposed to start at 9. We're starting a little bit. Firstly, sorry for that. And without wasting much time, let's get going. The small plan for the day is to start with amalgamation and then do partnership dissolution as well as amalgamation of partnership, including conversion. Then we'll do consolidation of companies, banking, NBFC, and post lunch break we have plan of doing liquidation. You might take a small break after liquidation and before we do buyback. And without wasting much time, let's get started with amalgamation of. So, how cool a chapter is this? This is not just a chapter, it is much more than just a chapter. The reason being, a lot of us know post qualification, we do specialization. People do specialization. And when you do specialization, people who are doing articleship already know. Specialization can be in audit, specialization can be in taxation. In audit, also, people do a little bit of specialization. But in the modern times, the specialization has come down to another wing called as M&A, mergers and acquisition. Previously, people post qualification used to take up the specialization field. But in the last 2 3 years, the developments are so big that students at articleship level are getting an opportunity to work completely in M&A, mergers and acquisition. They do 3 years of articleship exclusively in M&A. It's going to be not just a chapter, but a very big career opportunity or an entire wing what you can dedicate your entire career into. Let's quickly get started with M&A. Oh, sorry, amalgamation of companies. What you are learning here as per accounting standard 14. But when you come down to CA final, you will learn this as per Ind AS. There we call it combinations. And here, when they say amalgamation, though the name of the chapter is just amalgamation, this will include acquisition, merger, and external reconstruction, all the three topics together. And in final, when you call it combination, it will include everything. Mergers includes mergers, acquisition, external reconstruction, including small changes like your internal reconstruction is also part of the chapter combination. So this is the weightage of the chapter. 20 marks have come from this chapter before. 15 marks is also very usually expected. There are situations where they've given two questions, one of 10 marks and other of 5 marks also from this very chapter. And getting started, what to expect from the chapter? You can expect few theory questions based on difference between amalgamation and merger and amalgamation. There are two types of amalgamation, in the nature of purchase and merger. That difference they can ask, or they can also ask you difference between amalgamation, absorption, and reconstruction. Different types of amalgamation, like I just mentioned, or computation of PC questions can come under multiple methods: NATO, net assets taken over method, or lump sum method, or under intrinsic value method. Only PC computation, that will be for 5 marks. Or they can ask you to prepare accounting entries. Accounting entries can be in the books of transferor or can be in the books of transferee. Probability of ledger accounts is slightly less. More usual and more often is about journal, but ledger questions can come. And if they ask a 20 marker, they can ask you to prepare balance sheet post amalgamation in the books of transferring. Or sometimes for a 15 marker question, they'll ask you not to do accounting in the books of transfer. They can ask you to do accounting only in the books of transferee and balance sheet of transferee after amalgamation. So these are the variety of questions that can come from it. And quickly jumping into the topic of amalgamation, the definition is given as per accounting standard 14. And it says that amalgamation is amalgamation as we discussed under Companies Act 2013. The term amalgamation is not defined under Companies Act 1956, Companies Act 2013, or Income Tax Act 1961. Sorry, all the three defines it. There is not, merger is not defined, but generally what we basically mean is that it's combination of two or more entities decided to come together to take advantages of certain trade advantage, like conglomerate merger, different product, or backward merger. You merge with the producer or you merge with the person who buys the goods, take an advantage in the market. So with regard to this topic, amalgamation, absorption, and external reconstruction are slightly different, but we'll learn accounting for all three. When we use the word amalgamation, the best example can be Idea and Vodafone. Idea and Vodafone coming together. So in amalgamation, more than one company will be liquidated, and another new company will be. So absorption is where one company acquires another company. So one company will continue its existence. Only one of the company is liquidated, and the company which is continuing will acquire that company which just got liquidated. So the example can be Vodafone and Hutchinson SR, Vodafone acquiring Hutch, or Flipkart, Myntra, Jabong. Flipkart acquired Myntra and Jabong, and Flipkart was acquired by Walmart. The brand name still continues. So, or external reconstruction is where one company is liquidated with an intention of incorporating another company. So basically, there is the same company is acquiring the same company, but they just change the name of the company. Like they create one new company. The objective of the new company is to acquire that old company, what is going to be now. So that's what we call as external reconstruction. External reconstruction is very much similar to your internal reconstruction. Internal reconstruction, what do we do? The name of the company remains same. Within the financial statements, you do all the changes. Within the same body, the organs are replaced. Same old vintage car. Inside, you overhaul the entire car, change the seats, change the engine, change the tire, change the tube, almost redo everything except chassis. That is internal reconstruction. External reconstruction, what we do? We buy a new chassis, keep the old engine, old chair, or say old seat, old steering, everything. So all the assets and liabilities will be transferred to a new company, which is now created. That's our external reconstruction. Example is UTI Bank getting converted into Axis Bank. And like I just mentioned, what is meaning of amalgamation? Two or more companies are wound up and new companies formed to take over this. In the event of absorption, an existing company takes over the business of one or more companies which are going to be liquidated now. And in external reconstruction, one new company is formed, takes over the business of another existing company. And what are the companies involved? In the event of amalgamation, minimum two companies are involved. Or minimum three companies are involved because two are getting amalgamated to form one new company. Vodafone was there, Idea was there. Then we had something called V, another new company. In the event of absorption, two companies are sufficient. One company will continue to be there that will acquire the company which is getting liquidated. And in the event of external reconstruction, again, two companies are involved. One is getting liquidated and one is getting created. And liquidation. In the event of amalgamation, how many liquidations will be there? Minimum two. Minimum two, no? Both will get liquidated to form a new one. And in the case of absorption, minimum one liquidation. If one company is acquiring the other, one company is liquidating because the other company is acquiring it. In the event of external reconstruction, again, how many liquidations will be there? Only one liquidation. And incorporation, the event of amalgamation, is there any incorporation of a new company? Yes, one new company is incorporated. In the event of absorption, there is no incorporation. In the event of external reconstruction also, there is one company being newly incorporated. Objective in the event of amalgamation and absorption is take advantage of large scale production and avoid competition. So a lot of times when you want to go for merger, you need to take approval from Competition Commission of India also. And in the event of external reconstruction, it is to reorganize the financial structure of the company. This external reconstruction is not same as your internal reconstruction, but only thing is within the same balance sheet you make changes. Here we don't make changes within the same balance sheet. So that changed balances will come in the new balance sheet, but is the in the company which is newly incorporated. That's our external. So I hope you are able to place small differences between absorption, amalgamation, and external reconstruction. Yes. Going further ahead, the parties to the process of amalgamation, absorption, and external reconstruction are: one is transferor company, other one is transferee company. Transferor company is the company which is transferring all of its assets and liabilities to other company. This transferor company is what we call as small company. And transferee company, the company which is acquiring the business, acquiring the assets of such small company. The big company is called as transferee company. You can write it small. I've written it in caps so that you understand the differentiation between the other. The one who is receiving, is calling the assets and liabilities will have the word EE in their name. So I hope you are able to differentiate between transferor. Under accounting standard 14, we learn how to account in the books of transferee company only. Accounting standard 14 doesn't tell us how to do accounting in the books of transferor. Whatever accounting we learn, whatever accounting we do under transferor companies, that is under our liquidation approach or dissolution approach, is all based on generally accepted accounting. It is not based on accounting standard. So accounting standard 14 talks about accounting for amalgamation. It tells us how to deal with amalgamation, absorption, as well as external reconstruction in the process in the books of transferee company only. Transferor company, what do we follow? Generally accepted accounting. For this purpose, AS 14 classifies amalgamations into two categories. To help us do accounting in the books of transferee company, all the amalgamations are classified into how many categories? Two. One, amalgamation in the nature of purchase. Second one, amalgamation in the nature of merger. So, based on the practical scenario, we call it merger, acquisition, and absorption, external reconstruction. And for the purpose of accounting, as per AS 14, how many types of amalgamations do we have? Only two. One is merger, other one is purchase. Now, how do we call whether a particular process of amalgamation is merger or whether a particular process of amalgamation is purchase? This depends upon the compliance to the conditions given under accounting standard. So these are the two processes of amalgamation. Why do we have to classify an amalgamation into merger or purchase? Because accounting what is prescribed for merger is much different from the accounting that is prescribed for purchase. So we have two different types of accounting. So in order to accommodate ourselves and then apply both, we need to segregate it into this. Yeah, going further. So classification is based on compliance of 5 conditions which are given under accounting standard 14. So what are these 5 conditions? So first one, if all the 5 conditions that is just given, which we'll discuss after this, if all of these 5, not or, and all of these 5 are satisfied, then it will become amalgamation in the nature of merger. Even if one out of these 5 conditions, even one out of these 5 conditions, if it is not satisfied, we'll call it amalgamation in the nature of purchase. And if it is amalgamation in the nature of merger, the accounting method that is followed is called as pooling of interest. What is the accounting method that we follow? Very good. Now we'll see what are those 5 conditions. The conditions are given as per para 3E of accounting standard 14. Condition number 1 says that all the assets and liabilities of transferor company should be taken over by transferee company. The word says all. There is no discrimination. This asset won't be taken, that asset won't be taken. All the assets and liabilities of the transferor company should be taken over by transferee company. And the next condition is minimum 90% of the shareholders of the transferor company should continue as shareholders of transferee company. How is this possible? This is possible because you need to give them the purchase consideration in the form of shares only. You cannot give them cash. These two conditions comes up because people use amalgamation as an eye-washing technique to transfer assets. If in case you transfer a specific asset to me, it might attract a lot of tax loss, long-term capital gain and everything. So what you do is you create the company and you transfer that asset to company and you transfer the shares of that company. And whenever I want to sell that asset, I won't sell the asset. I'll sell the shares of that company. And in that company's balance sheet, I'll keep the asset at its book value only. So if in case this eye washing is basically done, it can evade a lot of tax loss. And such a transfer itself is regulated by Competition Commission. And they also say that here the intention to transfer should not be the intention to transfer a specific asset, but it should be intention to transfer the business. So to call it amalgamation in the nature of merger, you need to transfer all the assets and liabilities that is there, and the existing company shareholders should continue to be the shareholders in the new company. If the old company shareholders and new company shareholders are not same, then it is actually not sale of, it is not what to say merger, it is purchase. One set of people purchase another business. Very good. So then the third condition says that here when we say 90%, no, the shares of transferor company held by transferee company or subsidiaries is not included in 90. So before this merger process starts, either by way of subsidiary, one level subsidiary or 2 level subsidiaries, if you already hold some shares in transferor company, post amalgamation to compute this 90%, you cannot count that shares that you hold through subsidiary. Other than through subsidiary, whatever you hold, no, only that's count. And then the next third condition is consideration what should be given to the shareholders of transferor company to equity shareholders should be executed or released by way of equity shares in transferee company. I am transferee company. I am acquiring another business called transferor company. When I give the shareholders of that company purchase consideration, I should give it in the form of equity shares of this transferee company. How much? Entirely, except for the part of fractional shares. What is this fractional shares? Let us say the ratio is 2 shares in the new company for every 3 shares held in the transferor company. And there is a specific shareholder who has 5 shares. If he has 6, I can give 4 shares. If he has 3 shares, I will give him 2 shares. He has 5, sir, 3.5 shares. I can't give 2.5, 3 points. So already a share. It cannot be further shared. So to that whole number, I give shares. To that fractional part, proportionately I'll give. So that fractional part is ignored. Other than that, consideration to shareholders of transferor company should be settled by way of equity shares in transferee company only. There should be no cash given. This is the third condition. And the fourth condition says that business of the transferor company what I acquire, I should continue such business. It should be an intention to continue such business. I should not acquire that company with an intention of looking forward for their accumulated losses to write off against my Usually that is also an intention. We think we buy a company to have an advantage of large scale production, to have access to raw material, to have access to what to say front customer, or to have access to higher markets. That might not be the case. Certain scenarios, this can be a company which has huge accumulated losses, huge P&L account debit balance, that the company is about to go for winding up. If they go for winding up and they sell all of their assets, they might not even get enough money to settle their liabilities. Let's say there is a company which has 200 crores deficit, 200 crores loss, P&L account debit balance. So if they go for liquidation, the realization from their assets will not be sufficient to pay off their liabilities. Let's say I am a company which has 1,000 crores profit, just 1,000 crores profit. I will say I'll acquire their company. They would say that their company is worth negative money. If you want to acquire their company, you don't have to pay them any money. But I'm willing to pay 50 crores to acquire their company. They'd be more than happy. I'd pay 50 crores, acquire their company. You might be wondering, why would I want to acquire a company for 50 crores whose net worth is negative? I don't want their assets, I don't want their liabilities. When I acquire it for 50 crores, their losses will become mine. So they have 200 crores loss. 200 crores loss adjust against my 1,000 crores profit. How much? I would say 30% plus surcharge on the 200 crores by paying only 50 crores. So that should not be the intention. To call it amalgamation in the nature of merger, I should continue their business. If it is amalgamation in the nature of merger, their losses are my losses. I can take over and adjust against me. If it is amalgamation in the nature of purchase, their losses are not my losses. I will only take over their assets and liabilities, not their accumulated losses. I cannot adjust. There is no condition for me to continue there. So if I want to adjust their losses, I should continue their business. Because only and only if I continue their business, if I take over all their assets, if I take over all their liabilities, if their shareholders continue to be shareholders in my company to the extent of 90%, I give PSU to them only in the form of equity shareholders, then it will become amalgamation of giving me rights to acquire and then take all this. So the fourth condition is that the business of the transferor company should be continued by transferee company. And the last condition is assets and liabilities of the transferor company should be incorporated in the books of the transferee company at book value. At book value. Let's say there is a specific land which is bought by the transferor company for 1 lakh 10 years ago. As on the present date, its value is 1 crore. But no, when I acquire, I should acquire it at 1. I should incorporate it in my books of accounts also at the same book value. If the transferee company has done revaluation before amalgamation, then no problem. That revalued figure will be their book value. But when I acquire, I should acquire all the assets and liabilities at their book value, including reserves and surplus. And I should incorporate them in my books of accounts. At what value? This is when we call it amalgamation nature of merger. If we don't continue their business, or if 90% shareholders don't continue, or we don't give PC only in the form of equity shares, or any other condition, if it is not satisfied, one asset you didn't take over, cash you didn't take over, or one specific asset you didn't take over, or one specific liability you ask them to settle it by themselves. If in case you do that, then it will become amalgamation in the nature of purchase. You get this? However, here I told no, all the assets and liabilities should be incorporated in the books at their book value. There is one small exception. If the accounting policies followed by transferor and transferee are not same, they are different. Let's say I follow a specific method, like I follow first in first out method for valuing inventory. My subsidiary, that transferor company, follows weighted average method. And when I put both the stocks together, there should be unified accounting policy. So I recompute the value of inventory of transferor company under the method that I follow. I change their weighted average method to first in first out method, change their inventory and then include. That will not be considered as change in book value. It's no more merger, it is purchase. That won't be. So changes in the value of the assets and liabilities of transferor companies allowed if it is to bring in uniformity in accounting policies. This. So if all the 5 conditions are satisfied, merger. Even if 1 out of 5 is not satisfied, it is very good. According to accounting standard 14, in the event of merger, transferee company should follow pooling of interest. What is the method called? However, if it is amalgamation in the nature of purchase, we need to follow purchase method. What do we call it? Got it. And accounting in the books of transferor company, nothing is told. AS14 says, I don't know. You don't have to follow what I say. So then what we follow is generally accepted accounting principles. We call it dissolution approach or our realization. Call it either our realization approach or Very good. You get this? Ah, so what is purchase consideration? Throughout we spoke, no, purchase consideration should be given in the form of equity shares in the transferee company. Call it merger. What is purchase consideration? When you purchase some item, you give some consideration, something in return. That is purchase consideration. In the event of acquisition of an entire business, you give consideration to whom? To the owners of the company. So whatever is given is purchase consideration. Now, if I give debentures to equity shareholders of the transfer company, is it PC? If I give equity shares to equity shareholders of transfer company, is it PC? If I give purchase consideration in the form of preference shares to equity shareholders, is it PC? If I give equity shares, debentures, and preference shares to preference shareholders of transfer company, is it PC? Yes or no? Now some people are saying no, some people are. If I give equity shares to debenture holders of the transfer company, is it PC? If I give debentures to debenture holders, if we give preference shares to debenture holders, so we give, is it the question of whom are we giving, or is the question of what are we giving? Very good. The question is about whom are we giving. So there are three kinds of people in transfer company. One category of people are equity shareholders. Another category of people are preference shareholders. The third category of people are debenture holders. So as a transferor company, I have three people to whom I should pay money: equity shareholders, preference shareholders, and debenture holders. To pay all these three people, transferee company, which is buying my company, will give money or will give shares. They will tell this is to equity shareholder, this is to preference shareholder, this is to debenture holder. They can give consideration in the form of cash, bank balance, or they can give equity share, preference share, or debenture. Because my company is closing, even my debenture holder should either receive cash or he should receive debenture of transferee company. Whatever that company gives to pay to my equity or preference shareholder is part of my PC, irrespective of the fact whether it is equity share, preference share, or debenture. But whatever is given to pay to debenture holder is not part of PC, even if it is in the form of equity share of the transferee. Are you getting it? It doesn't matter what are we giving. Only thing that matters is to whom are we giving. Shareholders are the owners of the company. They own that company. Their company we buy. So whatever we give them is PC. So PC is anything that's given: equity share, preference share, debenture, check, cash to equity shareholder, equity share, preference share, debenture, check, cash in the from the transferee company to preference shareholders, but not debenture holder. This is not part of PC. This there, not debenture holder. Whatever we pay to debenture holder is not part of PC. Anything in any form paid to equity shareholder and preference shareholder is part of our. Hope you understood. So this PC can be computed in multiple ways. PC can be computed in multiple ways. So there are three prominent methods. One we call as lump sum method. So this is one of the easy methods. How lump sum amount is given and that lump sum amount will be given to us in the question. So we don't have to compute. Whenever they give that lump sum amount, 10 lakhs PC, 15 lakh PC, they'll also tell us how is the 10 lakh distributed, how much equity shares in it, how much preference shares in it, or they'll either give it straightforward or they'll give one hint in this ratio, in this proportion. That is what we call as lump sum method. We also call this payment method, but there is slight difference between payment method and lump sum method. In payment method, they'll also tell how to distribute. In lump sum method, only the lump sum will be given and we need to figure out how to distribute among the shareholders. Equity, how much, preference, how much to each shareholder, what ratio. We might have to figure that out. But in our problem solving, lump sum method and payment method are almost in problem solving. Practically, there is slight difference. And next comes another method called as net asset method. Under this net asset method, they won't tell the lump sum amount, nor will they tell how it is distributed. They will tell the revalued figures of each asset, or they'll tell how much of revaluation is to be done for each asset. They say this land and building is to be taken over at 20% higher price. This machinery is taken over at 15 lakh. Sometimes they'll give amount, or sometimes they'll tell how much higher price, how much lower price. So when they tell all of this, we'll take all these assets at the revalued figures, all these liabilities at these revalued figures. When you deduct both of them, you'll understand the amount of consideration that you need to pay. Are you getting it? And if it stops there, that amount has to be distributed either in that proportion that they mention or we need to figure it out. Sometimes they'll ask us to do it under net asset method. Tell us the revaluations. Also tell the total amount of purchase consideration. Then we need to compute the net assets that we take over with the purchase consideration that they mention. We might end up giving little more or we might end up paying little less. If we pay over and above the assets that we get, It means there are certain assets that we are getting, but we don't see. Why? The reason is it is not visible and it cannot be touched also. It is an intangible asset. We call it goodwill. If in case we pay slightly less, it means we're getting more assets for lesser price, which is our profit. And such profit is capital in nature, so we transfer to capital reserve. Are you getting it? Capital reserve or goodwill should not exceed, should not be there in the balance sheet in the event of merger. Come only in the by way of purchase. Like merger may I and you together, like we are going to become us. Then there is no profit, there is no loss. So it will be adjusted against the reserves acquired. But in the case of purchase, that's not the case. You acquire one more business. When you buy, there can be profit. So net asset method, they'll tell you the revalued figures. And using that revalued figures, we compute the amount to be paid or. And lastly, we have intrinsic value method. What is the last method called? This is a beautiful method. Under intrinsic value method, what happens is, now let's say I am acquiring your company. When I acquire your company, to the shareholders of your company, I will give consideration. I can give consideration in the form of cash. I can give consideration in the form of check. I can give consideration in the form of equity shares, preference shares, or debentures in my company. So in your company, we're doing valuation. Your assets, land will be this value, plant and machinery this value, inventory this value. We're doing a lot of discussion. Fine, we do all of that. Then we arrive at some number, 10 lakh rupees is the value of net assets of your. We agree. And then we also valued goodwill. You told 3 years purchase, I told 2 years purchase. We agreed at 2.5 years purchase, super profit method or capitalization. We applied some method, we computed goodwill, 2 lakh rupees goodwill also we added. So totally net assets is 10 lakh, 2 lakh rupees is goodwill, 12 lakh rupees I should give it to you in the form as a purchase consideration. This is agreed. Let us say we want to keep it in the form of merger, or I want to not give it in the form of cash. I want to give it in the form of equity shares of my company. So I will say each share of my company is 50 rupees. So I'll divide 12 lakh by 50 and I'll decide number of shares. Here, who decided that 50 rupees is the price of each share of my company? You are questioning. You are saying it's not 50. Prove me, tell me the math that it is 50. I will say 50 is a nice number, so it is 50. So you are questioning my credibility, saying how is it 50? So what do we do? Now, similar to the way I revalued all your assets and then put a new tag, you will question each asset in my balance sheet. How much is this? Its value is not this much. Write it down to this much. Write it up to this much. So we'll redo my balance sheet again. We'll redo my balance sheet, transferee company's balance sheet. All the assets at revalued figures or agreed values. All the liabilities at revalued or agreed values. We'll identify the total net worth or capital of my company. Divide it by number of shares that is there in my company. We'll arrive at some number. Let's say that comes to 35 rupees. That means intrinsic value of each share in my company is 35. So the price at which I will issue the shares to you should be 35 and not 50. So like how you do computation of revalued figures of assets, revalued figures of liabilities, asset minus liabilities, net assets. We do it only for transferor company. Under intrinsic value method, we should do for transferee company also. You're getting it? Transferor company's net assets will be their PC. That should be issued by dividing the transferee company's net assets divided by number of shares. That rate per share will come. No, that will be the issue price at which the shares are issued. So the net assets of transferor company divided by net asset per share value of transferee company will give us number of shares to be issued under intrinsic value. That net assets what we call compute no under net asset method. Under this intrinsic value method, we call it intrinsic value of the company or intrinsic value per share of the company. We call it intrinsic value of the company or intrinsic value per share of the. So when we say intrinsic value, we are trying to tell the balance sheet value. After revaluing the assets in the balance sheet, what is the value of each share that is there in the balance sheet? That will help us identify the. Did you get this? So more or less everything is same. All the methods here no. More or less it is same. It's not very distinctive, but there is slight difference between each of them. Got it? I'm not literally reading out the same sentences what is there. Making people understand it in a little lighter tone, because if you go on reading all of that and they would do the definition and all initially it's there, we won't be able to do this quick. This chapter we do it for 4 days, 5 days. We're trying to do entire all the chapters within 1 day. Then we have to run. I hope that's fine. At any point, if you find it too fast and you want me to go slightly slow, do tell me. Now, what is the difference between purchase consideration and net assets? Just discuss this. If in case our purchase consideration is more than the net assets that we took over, so we're paying for some assets which we cannot see, we cannot touch. That's what we call as goodwill. And if in case our purchase consideration what we're paying is slightly lesser than the net assets that we took over, we call that as capital reserve. This capital is this profit is capital in, and if there is goodwill and capital reserve already existing, that will be adjusted, net off, and then shown in the balance sheet. We don't write them separate. And then we need to learn accounting. Accounting, my presentation is not yet ready. Shall we discuss the accounting in the books of transferor company and accounting in the books of transferee company? Ready? This is similar to your dissolution or realization, what you do in the case of partnership. First, we're learning accounting in the books of transferor. Transferor is the company which is getting liquidated, which is getting closed down, whose assets and liabilities are now taken over by transferring. In this process, I told you accounting standard 14 doesn't tell us any accounting. Accounting is done as per generally accepted accounting. As per gap, what are we going to follow? We're going to follow either the realization approach, or it's also called as realization approach, or it's also called as liquidation approach. So under this approach, what we do, we transfer all the assets and all the liabilities at their book value to realization account, irrespective of the fact whether these assets are taken over or, let me repeat, transfer all the assets and all the liabilities to realization account at book values, irrespective of the fact whether these assets are taken over or, if it is amalgamation in the nature of purchase, there might be some assets which are not taken over by transferring. Still transfer these assets to realization. If it is taken over by transferee company, good. If it is not taken over by transferee company, against this we'll receive cash, we'll sell it, or it might not realize any money. So we'll write the entries and then close it. Because if I don't transfer to realization, it will be there in balance sheet. There is no need of balance sheet because there is no going concern concept. No, you are not going to do business next year. So you are either going to, they are going to take the asset, or you are going to sell the asset to somebody. Or worst case, you will give it away free. You can't keep it with you because you are not there next year. Your company is dead. So all the assets and liabilities will be transferred at book value to realization account, whether taken over or, exception is cash and bank. Cash and bank is not transferred when it is not taken. So we usually used to crack this joke in PU, cash and bank cannot be transferred to realization because cash cannot be sold. Here it is not sold, it is taken over. If in case it is amalgamation in the nature of merger, you will transfer cash also to realization account, and such cash is also taken over by transferee company. That, and fictitious assets and accumulated losses, if it is there, no, that again are not transferred to realization. Why? We'll transfer it to equity shareholders. Like how you do in partnership. If there is P&L account credit balance or general reserve, we don't write to realization. We'll write to partners capital account credit side. Here partners are not there, shareholders. We open an account called equity shareholder account. We'll transfer equity share capital, accumulated losses, accumulated profits, reserves, and realization profit or loss, everything to equity shareholder account, and settle them by the consideration what is received from transfer. You understand this? I'll be sharing this PDF to you people after class. So it is totally okay if you don't copy anything. And if you're copying, I won't stop. Wherever you feel like noting down something you want to note down, you can. But I'll share this PDF with you people later. So then agreed value, if it is given, don't consider. Revaluation account only agreed value per unit. Let's say this building agreed value is given. So when you transfer it to realization account, should we do it at book value or agreed value? Book value. Assets are there in the balance sheet, liabilities are there in the balance sheet. We are killing that balance sheet. We are closing that balance sheet. We are tearing that balance sheet. To close that balance sheet, all the assets which have debit balance should be credited. All the liabilities which have credit balance should be debited. If you debit liability, credit will be realization. If you credit asset, debit will be realization. Hope you got it. You transfer all the assets and liabilities. And when you transfer all the assets and liabilities, for transfer of assets, the journal entry is realization account. For transfer of all the liabilities entries, liabilities account debit to realization. So all outside liabilities should be transferred to realization, except share capital reserves and surplus. Don't transfer share capital and reserves to realization. Share capital and reserves and surplus will be transferred to shareholders account. Where will it be transferred to? Understood. Assets and liabilities transfer. Then we'll write the purchase consideration due. See, this realization account is like a box. We're packing everything that the transferee company wants in a box. We'll put all the assets they want, all the liabilities they want. We'll pack this box. We'll give this box to them, and they are supposed to give us purchase consideration. Purchase consideration is receivable. It is asset to me from transferee company. So I'll write transferee company account debit for receivable. What should I give them? Realization. This box, what I packed with assets and liabilities. So the entry will be transferee company account debit to realization for purchase consideration due. This purchase consideration will do a separate working note computing it and then write such amount here. After we write PC due, we will now receive PC. PC can be received in the form of shares, equity shares, preference shares, debentures, cash, whatever form we receive, we'll debit all of them. And then credit will be given to transferee company. Here we have debited transferee company because it was receivable. Here we received, so that will be closed by crediting. And whatever we receive, we will debit. And I told you, no, equity share capital and then reserves will be transferred to shareholder account. After we write this PC and dispose the assets which are not taken over, settle the liabilities which are not taken over, if any, we get realization profit or loss. That also will be transferred to shareholders account. After that, whatever balance is there in shareholders account, no, will be equal to this. This cash, bank, equity shares, preferential debentures, what we have received in PC, we give it to such shareholders, and that will be the closure of our shareholder. So certain assets which are transferred to realization account, if it is not taken over by transferee company, that will be left with us. We will sell it. We will sell it. If we sell it, we receive consideration. Usually write the entry as cash account debit to asset, to P&L for profit, debit P&L for loss. Here we won't debit or credit P&L, and we won't credit asset. Why? Asset account is no more there. Asset is closed now by transfer to realization. Our journal entry is cash account debit to realization. Cash account debit to, this entry should be passed at selling price. Entry should be passed at, sir, but asset is 10,000, it is sold at 12,000. It's okay, don't worry, write 12,000. Initially, when you transfer to realization, you did at 10. Now, if you write consideration 12, automatically realization profit, when you compute, there 2,000 gets adjusted. We are not trying to find item wise sale by profit. Why? If you are going to be there for next 2-3 years, there is a point that is required for decision making. What decision will you do? You are dead. Correct or not? When you are dead, each of the body part will not be burned separately. Full together, one the kerosene of Sutradashe. So you are not going to identify profit or loss on sale of each asset. You will write the sale consideration to realization account, and there only you will get the profit or loss, including every item's profit. Yes. And whenever they don't tell whether that asset is sold or not, let's say there are 5 assets. There are 5 assets: land, plant and machinery, motor vehicle, furniture, and inventory. And they say that the transferee company takes over inventory, furniture, land and building, and then motor vehicle. They don't take over plant and machinery. Transferee company is not taking over. And they don't tell anything. Usually in PU, you used to do that it is assumed to be sold at book value. But that's not what you should do here. If they don't tell that a specific asset is sold for some consideration, you will assume it is sold for 0 rupees. You will assume it is sold for 0 rupees. Don't write any sale entry. Or if you want to write for 0 rupees. Why? Conservatism. Why? If it is profit, they should tell. If they don't tell, it is loss. So unless they mention that a specific asset is sold for a specific value, if it is not taken over, we'll assume that it realizes nothing. However, opposite for liability. If in case there are 5 liabilities, transferee company is taking over 4 liabilities. One liability is not taken over. Liability is, we'll assume that this liability is settled at book value. We'll assume that this liability is settled at book value unless specifically mention that it need not be paid. Got it? Read this: entry to be passed at selling price. Ignore cost price or book value. Don't try to account for profit or loss on sale. In the absence of specific mention about selling price, assume selling price as, got that? And the journal entry will be, you receive consideration of bank account debit to realization account. Got this? Then settling liabilities not taken. I told you, unless they mention that it is not settled, you'll always write the entry for settlement at book value. Entry is realization account debit to bank. Read this: entry to be made for settlement value. Ignore book value of liability. Don't try to separately account for profit or loss. Let's say liability is 10,000, you paid 8,000. Don't try to book 2,000 profit. Just write the entry as realization to bank, 8,000, 8,000. 2,000 will straight away get affected to our realization profit or loss. What we, then, in the absence of specific mention, unlike assets, what do we assume here? Settled at book value. There, what do we assume? 0. Here we assume book. Get the difference? Used to do it differently, no, in PU. That is right for marks in second QC examination. But practically, this is right. Got it? Very good. So then liabilities which are not taken over is paid, assets which are not taken over is settled. If there is any realization expenses incurred, we should write that. Because to sell the assets, to settle the liabilities, we might incur expense. No? Now there are two parties involved. The company which is getting liquidated, company which is acquiring. Either of them can pay this liquidation expense. Either of them can pay this, and either of them can bear this liquidation expense. Let us say I am transferor company. I am the small company which is getting liquidated. I pay realization expense. Bank account or cash account credit, debit such expense to realization. All the profits or losses, all the expenses or incomes arising on liquidation should be booked in realization account. So I'll write the entry realization account debit to cash or bank for payment. And I'm only bearing it. I'm only bearing it. If in case it is paid by transferee company, will I write entry? Transferee company will write entry. What entry will they write? They will write goodwill to cash because they can't write realization account. They are not selling anything and they're not getting anything. So they're paying on my behalf. So they'll write goodwill to bank. This is when they pay, they bear. What if they have paid it, but I should bear it? I should have paid, but I don't have cash. On my behalf, they've paid. They will say that it is receivable from me and I would have to pay them. It will become almost like part of PC. You're getting it? Or if I pay it, I write realization account debit to bank, assuming that I am only bearing it. If I paid, but that company is saying, I am acquiring your company, no, your cremation charges I will pay. So if the transferee company says that, then it is no more our expense. Correct or not? They will bear the expense. So they will give us money. So they will give money, bank account debit. It is no more my expense. It is reversal of expense, or it is like income. I will credit realization. So when I pay realization to bank, if I only should bear, already I have written it to realization, so I don't have to write any entry, no specific entry, or borne by transfer. If it is reimbursed by transferee, we receive no bank account debit to realization. So basically, the entry what I wrote here is reversed. They pay. What if transferee company pays? If the transferee company pays, I write no entry. This is no entry. That one movie was there. No. So if transferee company pays, I write no entry. If transferee company has paid on my behalf and I need to repay to that company, then I have to write no realization. Whether I pay directly or he pay and I pay him, to me it is same. I'm paying. We get realization expense. We'll discuss this in the books of transferee company. Slightly. And finally, this realization profit or loss, whatever is there, will be transferred to partners' capital. Before that, purchase consideration payable to preference shareholders, purchase consideration payable to equity shareholders will transfer. Will close their capital account, will close realization account, will close reserves account, will close accumulated losses account, and transfer everything to preference shareholder and equity shareholder. Capital credit balance, reserve credit balance, and if there is accumulated loss, debit balance. Realization profit, credit balance, realization loss, debit balance. Reverse them and credit preference shareholder and credit equity shareholder. You getting it? After we do it, then we just pay that consideration whatever we received to equity shareholder and preference shareholder. So this will be the entry. Equity share capital will transfer to equity shareholder. Finally, we'll pay equity share. One thing that you should remember is realization profit or loss will be adjusted to equity shareholder, not to our preference shareholder. First, settle our preference shareholder. Transfer whatever belongs to preference shareholder to preference shareholder account, like preference share capital, arrears and dividend if there is any, premium on redemption if it's supposed to be paid. Such premium and all, if the provision is already made and it's there in the balance sheet, very good. If you have not made provision, then debit it straight away to realization. Debit it straight away to realization. You credit everything to preference shareholder, pay to preference shareholder. After you pay preference shareholder, then identify realization profit or loss, and then transfer reserves, transfer share capital to equity shareholder, and then settle. And this is how the accounting is done of transferor company. You understand this? Is this as per accounting standard 14? No. This is as per generally accepted account. Any part of this which you have doubt in and you want me to repeat? Ah, very good. So what I want you to note here is, in the question further, they can ask ledger account. We discuss journal entries. They can ask you to prepare ledger. They won't tell what ledgers to prepare. Sometimes they say prepare necessary ledger accounts. When they use the word necessary ledger accounts, please prepare realization account, transferee companies account. This is for purchase consideration. prepare preference shareholder and equity shareholder. You understand? These are the four ledgers that you should prepare. When they say necessary ledger, they specifically mentioned what ledgers to prepare, prepare what they've asked. If they don't mention, then prepare these. We go ahead. I will discuss accounting entries in the books of transferee company. When we are discussing accounting entries in the books of transferee company, we have two methods. It can be amalgamation in the nature of merger, or it can be amalgamation in the nature of purchase. If it is purchase, purchase method. If it is merger, pooling of interest. You will see accounting entries simultaneously under both methods next to each other so that we get comparison. Got it? First one, for business being acquired. When you acquire the business of the transferor company. So what is it? You are purchasing the business. So we debit business purchase account. We debit business purchase account. And against that business what we purchase, we should give consideration to whom? Liquidators of transferor company. So entry will be business purchase account debit to liquidators of transferee company. This is actually transferor. Okay. Business purchase account debit to liquidators of transferor company. And the same entry will come in the case of pooling of interest also. There's not going to be any change in this set. After this, that business purchase is like box. He called it realization. I call it business. The box that he packs by putting all the assets and liabilities and then tape. He calls it, I call it, now I'll open that box. When I open that box, from that box pops out all assets and all liabilities. He would have put assets and liabilities into that box at book value. When I open it, it will be all at agreed value. It will be all at. So when the transferor puts assets and liabilities into realization, he will put it at book value. He will pack it, he will give it to me. In the books of transferee, that box is called as business purchase. When I open that box, everything should be recorded at agreed value. So I'll record all the assets that I'll credit all the liabilities. And business purchase, whatever is debited here, no, will now be credited. Got it? So these assets are at agreed value, liabilities are at agreed value. Assets minus liability. What do we get? Net assets taken over. Assets at agreed value minus liabilities at agreed value. What do we get? Net assets taken over. And this entry is written at PC, no? Here we wrote business purchase to liquidators for PC due. Am I right? So NATO and PC. If NATO is less, PC is more, then what happens? PC is more, no, credit is more, debit is less. You're paying more than what you bought. That will give rise to goodwill. If in case you pay less, it will become profit. That will give rise to capital. So goodwill or capitalism, it is not both. It is not both. And whatever working note that you do to compute NATO, after that you do PC computation. There you compute no goodwill or capitalism. Then when you write this journal entry, check goodwill or capitalism that you get here. This should match with that. The moment this matches with that, it means that everything that you're doing so far is correct. All the working notes that you do know for amalgamation, PC computation, NATO computation, all this under mutual indebtedness adjustment that you do, unrealized profit adjustment that you do, all these working notes that you do adjusting all of this, impact of this will be given in transferee's book and never in transferor. None of those items will come in transferor's books. All of this will come as an impact where? In transferee company's books. Why? He's dying. Did you do working note to kill someone? No, working notes are done to present the items in transferee company only. Just remember this. Good. So we write asset account debit, goodwill if it is any, capitalism if it is any, two liabilities, two business. This is in the event of purchase method. In the event of pooling of interest method, there cannot be anything like goodwill or capital reserve. The reason is there is no you, there is no I. It is us. We both are now together. I can't say that I acquired you and then I paid you more and there is goodwill, or I acquired you and I paid you less, there is capital reserve. There can't be things. Getting it? So what do? We write all the assets at book value. The value at which they packed is the value at which I record. Same values we record. So there can be no difference. There can be no difference. So I open the assets. Assets are at the same value in which he packed. So I'll write all the assets. I'll write all the liabilities. If in case still we paid more than that as purchase consideration due to some reason, such goodwill or capitalism, it doesn't matter. It has to be adjusted through resources. It has to be adjusted through of whom? Of transferor company. We acquire that company's reserves, no. we adjust goodwill or capital reserve against that reserves of transfer. Sir, why can't we do it under purchase method? Under purchase method, we don't take over their reserves. No? Reserves are transferred to their shareholders. Here, they only become shareholders here. No? So to that extent also they get shares. Then after this, debenture holders of that old company who are there, they should be given debentures or they should be given cash or given something in the new company. Why? The debenture what they hold, which has the name of the old company, is no more valid. Why? That company is not there. So usually we can give them debentures in the new company or give them shares or settle them by way of cash. So in this liabilities, what you would have credited here, no, there will be liabilities in the form of debentures of transferor company. So that we will debit. Are you getting it? So debentures of transferor company, whatever is included in this liabilities. So we'll debit it, and then we can give them either debentures, we can give them preference shares, we can give them equity shares, we can give equity shares or preference shares or debentures at premium, or we can give them cash, or if it is not equity shares and preference shares cannot be issued at discount. Section 53 will restrict. If it is debentures, we can issue them at discount. We can issue them at slightly discount. You get this? This is the entry in the books of transferee company under purchase method. What about pooling of interest method? Same to same. No difference. Entry will be same to same. No difference. In this context, you will tell one dialogue called same. I thought I'll keep the material little later. Or I should have typed same to same, no difference. Here I put this image because if you remember 2019 World Cup inauguration when they asked, how do you feel about India, Pakistan? Virat Kohli spoke for good 2 minutes explaining the entire scene. And then this Pakistani captain, only thing that he had to tell was, my answer also same. No difference. That is the English that he. Okay. Now Babar uncle knows little bit English. Yeah, not batting. And our cover drive is better. Yeah, cover drive is not that great. It's good, but king. Let's go ahead. Then discharge of purchase consideration. So as transferee company, we give purchase consideration to transferor company. Am I right? So when we do give consideration, it is given to liquidators. In the first entry, when we purchase the business, we have credited liquidators of transferee company, sorry, transferor company for the consideration to be paid. Am I right? Here we have credited it because it is payable. Am I right? When it is paid, I will debit it. I will debit it. And I can give them equity shares, I can give them preference shares, I can give them debentures. There can be issued at premium or you can pay them slightly cash. Showing the meme. 2019 World Cup. 23 World Cup. He doesn't know who's Babar Azam. What did he show? Okay, fine. And you're showing him the screen time. 5 hours straight. What did you do? 2 movies. Studying on phone. Nice. So for discharge of purchase consideration, you debit liquidator account because that liability is reducing. Whatever consideration you give, you write it. One more important point. Whenever the shares are issued in the transferee company at premium, here we credit premium. You're getting it? When we write entries in the books of here, when we write entries in the books of transferor, when we write books entries in the books of transferor company will give us purchase consideration. When we receive PC here, when we write equity shares in transferee company, security premium we don't write separately credit. You're getting it? Let's say 1 lakh is the nominal value of the shares. It is issued with premium 1,20,000 rupees. The value of the shares in PC. Here when I write preference shareholder account debit to equity shares in transferee company, or here when I write equity shareholder account debit to equity shares in transferee company, I will write 1,20,000. I will not write 2 equity shares in transferee company 1 lakh, 2 security premium 20. No. To transferor company, it is not premium. It is premium to transferee company. They in their balance sheet have to show nominal value on security premium separate. Here, this is the cost of acquisition. We'll record it at cost. Getting it? In the initial entry, when we receive PC, we would have written one entry, no? Transferee company account debit. Here, Equity shares in transferee company, preference shares in transferee company, debentures. Here again, we'll write it at a price including premium. Or if debentures are given to us at discount, we'll write it at discounted price. Don't write it at nominal value. Nominal value on security premium differentiation is in the books of transferee company. Remember this, because a lot of them end up doing this very silly mistake. It might sound to you, ಇದೆಲ್ಲ ಹೇಳ್ತಾ ಇದ್ದಾರೆ ಅದೇ ಮಾಡೋದು ತಪ್ಪು. Yeah, there was an kind of adventure sport called as building a metal tunnel, sitting inside it, and then jumping from the top of a cliff. People used to do it with waterfalls. We break a small tunnel, we call it capsule. They sit inside that capsule, a small metal tunnel, and then they put themselves into the water, flowing stream of water, and that capsule will fall from the top of a waterfall, and people survive. It was an adventure sport, 1940s, 1920s, in 18th century and all. People used to do this. There was a guy who survived fall from what is that river? Nile River. What is that waterfall? Because Niagara waterfall. He survived a fall from the top of Niagara waterfall. And after that achievement, he was called as one of the bravest man. Survived the fall from the tallest waterfall in the planet. And then one fine day after that, he was walking on the street. Someone had thrown an orange peel, not even banana peel, orange peel. He stepped on the orange peel. The liquid out of the orange peel, what came out, made the surface flat, and then friction was lost, because of which couldn't pick up the feet and then keep further. It slided. When he slided forward, no, the legs, because of imbalance, his head fell back. Then his head hit the pavement, because of which he got hurt here, and then he died on the spot. The man who survived the fall from the top of the Niagara Falls died because he stepped on an orange peel. So it is not the Niagara waterfalls jump that will kill you. It is all these small things that will kill. Most difficult, complex adjustment you might be able to crack. Some silly mistakes is what will cost you 2 marks, 3 marks. So be cautious, because the easy catches are the most difficult catches. Great. Fine. Next, realization expense of the transferor company. It is paid by transferor company. No problem. We don't write entry. If we paid, we need to write the entry. If it is purchase method, then we call it goodwill account debit to cash. Why? To be in their good books. See, whose expense is it? Realization expense, transferor's expense. Who should pay? Transferor. We are paying them. Why? To be in their good books. What good books are there? Books are only wound up. But still, you write goodwill account debit to cash or bank. But you don't get anything. No, you only get their goodwill. If in case, what to say, it is amalgamation in the nature of merger, we can't write goodwill or capital. Sir. Let's say you write goodwill account here. Then what should you do? Again, that goodwill should be adjusted against reserves. No. So instead, straight away write reserves account debit to cash. Okay? Then mutual indebtedness. Is it? One owes the money to the other. Either transferor owes money to transferee, or transferee owe money to transferor. They owe money to each other. Against this, no, till the time transferor and transferee are two different companies, no problem. When they become one company post amalgamation, then you cannot show that asset and liability, because you are one. You should pay yourself. Should you pay money to yourself? No, you should eliminate it from the asset as well as the liability. This is for debtor, creditor, or bills receivable, bills payable. We eliminate both. How do we eliminate both? Liability will be debited, asset will be credited. Creditor account debit to debtor account, or bills payable account debit to bills receivable. Same to same entry is done in the books of done in the, if it is the amalgamation nature of merger also. This is going to be no difference. That then comes unrealized profit. This debtor creditor relationship, or bills receivable bills payable relationship between the transferor and transferee comes because one has sold goods to the other. One has sold goods to the other, and that person who purchased has sold these goods to outsider. No problem. I am transferor. I sold goods to my transferee company, and my transferee company sold all of these goods to an outsider. No problem. No adjustment required. Those goods are not there. Problem starts when transferor has sold goods to transferee. Transferee has not sold it to outsider, but still there in the balance sheet. Or transferee has sold goods to transferor, and transferor has not sold these goods to outsider, but it's still there in the balance sheet. That's when the adjustment. The reason being, the selling company would have booked profit. The buying company would have recorded at the price which is slightly more than the cost to other company. I sold 100 rupees worth of goods to 120 to the other company. I have booked 20 rupees profit, and that company is recorded the stock at 120. If they sell it to outsider at 130, no problem. I record profit of 20, he records profit of 10. The problem starts when he has not sold it outside. The problem is again not there when we both are distinct companies. When we became one single company, then I have record in the amalgamated balance sheet. I have recorded the stock at 120 rupees, whereas the cost to myself is 100. And the 20 rupees cost value increased. That 20 rupees is booked as profit in the same balance sheet P&L account. So in reserves and surplus, there is profit of 20 and the balance sheet asset side, inventory shown at 20 rupees higher price, which is not fair. So we'll reduce the value of the inventory by 20 and we'll also reduce the reserves by, so the stock value will be reduced. Am I right? So stock account will be credited. Stock account will be debit, will be goodwill account. If it is amalgamation in the nature of purchase. If it is merger, we cannot use the word goodwill. So we'll straight away write it to P&L or general. If in case you write goodwill, is it wrong? No. Again, that goodwill has to be adjusted with reserve. Got that? Next, statutory reserve. Because of any statutory requirement, if the transferor company is forced to continue some reserves, there is some foreign currency translation reserve or some dividend equalization fund or some other fund, what they should continue to maintain as a reserve. Now, when they die, I take over their business. Just before the transferor dies, transferor keeps their hand in the books of hand in transferee's hand and say, "This is my promise. Please fulfill this promise." Because I am not able to fulfill. Like you see in retro movies towards the climax. So transferee has taken up the responsibility. You're getting it? So then now transferee's company's responsibility is to load, aim, and shoot for the rest of the movie too. So what does the transferee company do? They'll maintain it. Now, how to do entry for this depends upon whether it is amalgamation in the nature of merger or amalgamation in the nature of purchase. If it is amalgamation in the nature of merger, you don't write any entry. Why? We take over all the assets and liabilities, including reserves and surplus. No, when we take over reserves, we've taken over their general reserve, we've taken over their P&L account, we've also taken over their statutory reserve. We maintain it. There is no problem there. However, if it is amalgamation in the nature of purchase, they won't give us reserves. We take only their assets and liabilities. Now we would have to record it. What do? I will record statutory reserve by crediting it. But I'm not going to receive anything against it. So this will be created by way of amalgamation adjustment. So I'll write amalgamation adjustment account debit to statutory reserve account. This entry will be passed and reserve will be shown in the financial statements for a period of 2 years, 3 years, whatever is the balance period for which the compliance was supposed to be made by transferor. Once that compliance period is over, then this reserve will be reversed. We'll write statutory reserve account debit to amalgamation adjustment account. Now, there is lot of controversy with regard to this amalgamation adjustment account. Where do we write this amalgamation adjustment? See, the statutory reserve, we know, we'll write it in balance sheet, reserves and surplus. Where to write this amalgamation? Initially, when this came, long ago, before Companies Act 2013, this amalgamation adjustment was written in other current assets in balance sheet. Or some cases, some authors had written this in miscellaneous expenditure in balance sheet. But all of this came to a close because under revised Schedule 6, no, that miscellaneous expenditure was there. Under Schedule 3, miscellaneous expenditure concept was not there. There is no miscellaneous expenditure in the balance sheet asset side. Now we are left with two options. Either we should write it in other current assets in the balance sheet asset side, or we should deduct it from reserves in the liabilities. Again, lot of author material still write other current assets, amalgamation adjustment in other current assets. But as per the opinion given by the EAC, this amalgamation adjustment, whatever is arising, has to be deducted from reserves and surplus. We'll write reserves and surplus now of the transferee company. From there only you will deduct this amalgamation adjustment back. Get this? It is not another current asset. It doesn't fulfill the criteria for an asset to write it as done. What have you people read so far? Wherever you read it from, however you read it from, reserves reduction. If you're reading it as an asset to be written in the balance sheet asset side, I would tell you to correct it. I'm not telling you that it is wrong. Some author materials have still done that. I can show you one or two RTPs which is still shown that as an answer, but not recommended. What is very strongly recommended is to deduct it from reserves and surplus. And anyone who's ready to be written in balance sheet asset side? No one? No one? Nice. So we'll deduct it from reserves and surplus. That's fine. This is one place where you might do mistake again. And mutual indebtedness and unrealized profit adjustment, don't try to adjust them in transferor books. You need to do adjustment only in the books of transferee. You know that that money, that debtor is transferee, but still transfer it to realization, transfer it to what to say in the PC computation also you take it. PC computation allo adjust ಮಾಡ್ಬೇಡಿ. NATO, goodwill, PC computation, but don't eliminate that mutual indebtedness. Don't adjust that unrealized profit. Finish all that working. Only in the accounting entries when we're doing in the books of transferee, you should do it. Getting it? So it's like after takeover is when you adjust it, not before takeover. Not before takeover. It's like this: you owe 10,000 rupees to one friend of yours, and then you end up marrying that friend. Do you have to pay? No, then you don't have to. When after marriage, not before. First, everything should be over. Then you'll say, don't have to pay. Why? My money is your money is your money. So I don't have to pay you any money. Yet, did not understand. Eventually, you'll get it. Even I felt like, what is it that's been later I understood. Statement goes like, not told by me, but it will be told by my wife tells. My money is my money. Your money is my money. ಅರ್ಥ ಆಗ್ಲಿಲ್ಲ ಬೇಡ. But understand it looks very complicated, but it's nice to hear, funny, laugh, and then ignore. An unrealized profit is theoretical profit or deficit that exists in balance. We remove that. I explained it to you already. Statutory reserve also I told it to you. So you can follow. And there are certain disclosure requirements. After you prepare, every accounting standard has certain disclosure requirements to be made. No? Similarly, accounting standard 14 also has some disclosure requirements. So this is one thing that I used to do when I wrote exam. So what I used to do was this disclosure requirements are there. You learn it in accounting standard 14 class. This you don't usually read it with amalgamation. Whenever you do question on amalgamation, when you start your answer on amalgamation, do this disclosure requirements alongside with balance sheet. After you prepare balance sheet of transferring company, write disclosure requirements as per accounting standard 14. Right? Name of transferor company, name of transferring company, nature of business, gottilla, dash. Effective date of amalgamation, gottilla, dash. Nature of purchase consideration, PC. What is a lump sum method or net asset method or intrinsic value? Write that. Write that. See, that is already there in the question. You write it. That will create a kind of impression in the eyes of the evaluator that, oh, this student has not just read all the formats and how to write journal entries and how to do the problem. Student has read theoretically correct. This person deserves to become chartered accountant. That heart might melt in some corner because of it, some place where there is a possibility where ingu agbodu, angu agbodu, if it is there, they'll put you on the side from which you might go for. Think this. So please do write it. It won't take much time, 10 seconds extra. And you won't get extra marks for writing. You will get a soft corner for writing it. Get that? Evaluator also has a heart. It can also melt. You just need to be hot enough with your answers. Your answers. You get it? You can't show your face. No. See, everything that you would have done for 6 months, 6 months of efforts, and then 24, 25 hours of studying just the day before it will be judged in the span of 3 hours of what you write by an evaluator who corrects it in 20 minutes. So the gateway to evaluator's heart is in the time period of 20 minutes. In 20 minutes, no, you should express it to him how hard you worked in the last 6 months. You can't write, no, there was no power at our house. I studied under street lamp. You can't write all those stories. But gateway is just show them your work as to how hard you work, how much do you know. That's the place for you to show. Got it? Without writing your name. Okay, and this is one more thing. I last time when the results came, a lot of people, you people have messed up. In some random place, you written your name or you written your roll number. Or worst thing is additional sheet. When you take in the additional sheet, some people have written roll number, and you won't believe results was withheld. When the results came, these students' results was withheld. They didn't show the results. And later students had to write a sorry mail saying that I am sorry, I followed whatever malpractice has been done is not with an intention. I seriously apologize for it, and I would ensure that such malpractice or such disobeying of any of the examination guidelines will not happen in the further time. They had to write a mail. Once they wrote their mail, weak-heartedness may I say release their answer because clearly given in the guidelines, not write your name or roll number or any religious symbols or anything at any point of time. And not one, not two, I can show clear cut messages of so many students who have written. Some people didn't even know what mistake they had done. I also asked them to apply for photocopy. And there we spotted. Whenever they take additional sheet, in the additional sheet they've written their roll number. You should not write number in additional sheet. Should not write. Tag matter tirala, trust. That tag is, that is trust. Trust it. Get it? And then some people are smart also. Sir, how do they get to know what if the tag is gone and paper is missing? You write no in the initial booklet. Number of booklets taken, 2, 3, you write. I'm thinking, sir, I would have taken 2 additional sheets. If I write 3, then they'll search that third sheet is there. Please don't play games with ICI. Remember, you're playing with ICI. If you think you can play a game by writing 3 sheets instead of two, think what games can ICI play? Huh? Not the person to mess up with. No, don't do that. So then you can basically start solving problems after this. So I think we've taken more than the time that we actually allocated. Can we go ahead to do other chapters? Yeah. And what I've done is this compilation, this PDF, what I'll share with you people later, as compilation of all the past exam questions. All the past exam questions. Solution is there in the form of an Excel sheet. I'll share that solution sheet to you people. I'll share this question sheet to you people. So this can be your last minute revision or last revision material. Are you getting it? So this will basically reduce. Now whichever material you might have done from would have had 20 questions, 30 questions to do. So here I have given only 8 questions, 9 questions, which is all the past exam questions and RTP. So first I put past exam questions, then I put RTP. So from each topic, if you do those 2 questions or 3 questions, you will understand the examination type. I'm not telling you will have 100% coverage of concept. Hey, so covered. 3 questions where we can complete the entire concept. Why do they give 20? The material that you read from wherever you read is absolutely good and perfect. But the day before exam, you won't be able to do 20. So you do such questions which are exam type. So that exam type questions is there in this PDF right after. You can try. But that, shall we now go to next one? Partnership. Decided. Let's do partnership. Hey, did you understand this amalgamation? If you have any specific area that's bothering you in amalgamation of companies, any specific doubt, please do ask. Any part that you want me to repeat, reiterate, tell again? Can you go forward then? Then let us now do dissolution first. Dissolution of partnership form, amalgamation and company. We'll finish dissolution and then do. Because when you do amalgamation, ಅದೇ ಡಿಸಲ್ಯೂಷನ್ ಮಾಡಿದ್ರೆ ಅಮಾಲ್ಗಮೇಷನ್ ಮಾಡಿದ್ರೆ in amalgamation also we should do dissolution. ನಾನೇನ್ ಹೇಳ್ತಿದ್ದೀನಿ amalgamation of partnership form, if you should go, you should realize the assets and liabilities of the partnership. Realization of assets and liabilities of partnership form, you will do it in dissolution of partnership. Flow and continuation is there, no, that is there from unit 1 to unit 2. The realization account what you prepare in partnership is slightly different from realization account that you prepare in company. So we'll first finish off dissolution and then do amalgamation. That will be extension. Okay. So you might have done this chapter in your PU again, your favorite, in fact, in PU, dissolution of partnership. Correct or not? Simple. All the assets and liabilities are there. ಈ ಕಡೆ ಇರೋ assets ಎಲ್ಲ ಈ ಕಡೆ ಇರೋ liabilities ಎಲ್ಲ ಈ ಕಡೆ ಹಾಕ್ಬೇಕು, ಈ ಕಡೆ ಇರೋ assets ಎಲ್ಲ ಈ ಕಡೆ. Correct or not? That's it. Okay. You put that and then it's over. And then cash account will tally. Balance sheet nu ಮಾಡೋ ಅವಶ್ಯಕತೆ. That's not how it works. Here it becomes little more practical, and that's where the problem starts. Problem starts because it is little more practical. So dissolution or winding up, why does it happen? If it is partnership at will or partnership for a specific period, if that specific period is over or if that will is over, it will be liquidated. Or if the partnership is specified for is created for a specific project, like a joint venture, a special partnership, and that project is complete, again that partnership form has to be dissolved. In this construction and joint development and all will be usually done in partnership. You have land, you don't have money. I have money, I don't have. So if I buy land from you, you will have money, I will have land. You can never construct. What do? We'll start one partnership. You contribute land, I will contribute money. You will build buildings on your land. 20 flats, 20 flats. Are you getting it? So that's partnership which is started with a specific objective. It will go for 4-5 years or minimum 4-5 years. So we construct, I put in my money, you bring in your land, we register it in the form of in the name of partnership form, and we will build the building. Once the building is built, we'll either decide 60-40 ratio, 50-50 ratio, 80-20 ratio. We'll take so many flats, I'll take so many flats. Either the firm will sell it and then distribute the cash, or you take 20 flats, I'll take 20 flats. That's it. You sell it whenever you want. You want to keep, you keep. You want to give it to rent, you give it to rent. You want to sell after 5 years, sell after your choice. So we'll take that, firm is liquidated. So this is the reasons for liquidation. Or it can be some petty issues like say fight between the partners, or interest of the partners changing, or insolvency of any partners, or they want to do a different form of business. They want to retire. Almost all the partners or all the partners except one partner want to retire. Again, this will be the reasons for dissolution of partnership. And there is little more of theory that needs to be learned when the partnership can go for dissolution. So I think I can skip that. Shall I do skip this part? In a regular batch, though, we have a lot of fun. Now, not. So what do we do in dissolution? We sell all the assets, we pay all the liabilities. Whatever money is left, we give it to partners and then see, sell the assets, pay the liabilities, pay money to partners. The person sitting here and then paying is liquid. This liquidator can be one of the partners, can be the auditor of the partnership firm, or another ultimately, or say completely outside person also. Can be one of the partners, or can be the auditor of the partnership, or can be anyone. It can be basically anyone. It can be me, it can be you. Or my friend, yes, can be. So we sell all the assets and we pay all the liabilities. To do this, what do? We transfer all the assets and liabilities to realization account. Yeah, this is continuous. We start with amalgamation, we straight away discuss something. So what do? We realize all the assets and liabilities by transfer to realization. Same old concept. Transfer all the assets and liabilities to realization account, whether taken over or not at book value. Whether taken over or not at book value. There it was taken over by the new company or not taken over by new company. Here it can be sold, it can be taken over by one of the partners, or it can be taken over by another firm in lump sum. All the three are possible. So we don't care. All the assets and liabilities, whether taken over or not, be transferred to realization account at book value. You get that? So assets are to be credited, realization account has to be debited. Now, cash or bank, should it be transferred? If it is amalgamation of firms, then that new firm what is getting created is taking over cash. Then you should transfer cash to realization. If it is not taking over, then we'll not transfer cash to realization. We'll open one separate. You understand that? That's what I've told. And some questions they'll give bank overdraft. Some questions they'll give bank overdraft. One of the question in our ICA study material, which is also there in ICS material also, is a similar tricky question. So what people do is there are two approaches here. One, bank overdraft can be treated like a liability and transferred to realization. And later when you sell all the assets, you get cash. From that cash, when you pay liabilities, you pay bank overdraft. This is a nonsense tricky method. The easier method is you open cash account, you open bank account, open bank overdraft account with bank balance on the credit side. Sell all the assets, write realization in bank overdraft account debit side. You pay liabilities, you write it in credit side. So automatically payment entry is done there only. Are you getting it? So what is both are right. There is nothing called wrong. Why? There is no accounting standard telling that this is wrong, that is wrong here. Partnership Act 1932 doesn't tell anything about maintenance of account. Are you getting it? And there is no accounting standard which talks about dissolution. And IBC provisions are applicable only for company, not for partnership. So here whatever we do is only correct. So you can do either. But what is recommended is open bank overdraft ledger. There you write it on the credit side, the opening balance, and all the realizations you go ahead and then write it in the realization. Sorry, that realization received and amounts paid to be written in the bank overdraft account. Getting it? So the alternative approach is okay, but I've still written here with an authority that bank overdraft will not be transferred to realization account and bank loan should be transferred to. Alternative treatment is also correct, but I personally won't recommend it. It will become a little tricky. And assets should be transferred at gross figures. If in case there is debtors with provision, debtors you transfer to realization separately, provision you transfer as a liability to realization separately. Don't mess it up. Getting it? Even if there is provision for depreciation on assets, don't transfer the net value. Transfer gross value of assets, that is original cost, and then provision. Understood? Then you transfer liabilities also. Liabilities has to be debited by crediting realization. If there is any accumulated profits and then partners capital, that will not be transferred to realization. That will go to partners capital. And then when the assets are sold, cash is received. We write the entry cash account debit to realization. Don't try to book profit. Don't try to worry about cost is 10,000, the sale value is 12,000. What do we do with 2,000? Don't worry. Don't worry. Write the journal entry only for sale value. And if any liabilities are settled, again the entry will be realization account debit to cash. Don't worry about the settlement value, book value, if there is profit on realization, sale, loss on payment, discount received, nothing. Don't worry. Just write the value at which it is settled, value which is received. It will straight away impact our realization profit or loss, which will go to partners. If any asset is taken over by partner, then we won't receive cash. We can't write cash to realization. Instead, we'll write partner's capital to realization. So it will decrease the capital. So we don't have to pay cash to the partner to that extent later. Sometimes the liability also can be taken over by partner. Sometimes the wife's loan, whatever is there, will be taken over by partner. You would have come across such adjustment. That liability is decreasing, debit that liability, and we usually used to credit cash. Now we'll credit a partner's cash. And when some of the assets are taken over by creditors, this is interesting. We'll write no entry. Let's say there is stock, there is creditors. There is stock, there is creditors. We are supposed to pay 10,000 rupees to creditors, and we have 8,000 rupees worth of stock that we purchased from them only in our balance. So rather than we selling the stock to somebody and then giving them money, our creditors will say, I will only take that stock. So it takes over that stock. For that, we don't write any entry. Why? Liability is reducing, asset is reducing. So we should actually write creditors account debit to stock. Am I right? But here creditors is not there. Why? Creditors is already transferred to realization. We don't have stock also. Why? Stock is also transferred to realization. So if in case we write entry, what will be the entry? Realization account debit to realization. Wow, what an entry. So we don't write it. We don't write any. Sir, what if creditors payable is 10,000? They take over stock worth 8,000. 2,000 rupees difference. That profit or loss should be actually transferred to realization. So entry will be realization account debit to realization account to realization. Or if it is loss, realization account debit to realization. So ultimately no entry. Ultimately no entry to that extent. Let us say creditors is 10,000. Stock is 8,000. They take over stock of 8 and we need to pay them balance 2,000 cash. For that balance what we pay, I'll write realization to cash. If it is adjusted by way of discount, only when I pay cash, I write the entry, adjustment of assets against liabilities or liabilities against asset. Then, so there can be unrecorded liabilities which will be settled. If it is settled, treat it as it is a liability which is recorded at 0 rupees. Don't treat it differently. Unrecorded liability is not like big difficulty. What is it? The liability which is there but recorded at what value? 0. Now we pay. What is the entry when you pay liability? Realization account debit to cash. Write the same entry. Realization account debit to cash or bank. Whatever amount you pay, that will straight away go and sit in your realization loss. You don't have to try to adjust it separately. And if there is any unrecorded asset, and this unrecorded asset is sold, we receive consideration. What do we assume? It is recorded at 0. Now when we receive consideration, bank account debit to realization. What if there is unrecorded asset and that unrecorded asset is not realizing anything? Asset recorded at 0 is realizing 0. No entry. If it is an unrecorded liability which need not be settled, there is an unrecorded asset 10,000. That's it. They don't tell that it is sold. What do we assume? It will be sold at 0. So then no entry. If they say unrecorded liability 10,000, they have not told that it is paid. What do we do? You should pay. You should pay. Even if they don't tell, liability has to be settled. Asset will assume it will be realizing 0. Right? So that's the entry. And dissolution expense paid entry is realization account debit to cash. If in case one of the partner pays, then you write the entry as realization account debit to partner's cash. And the closing entry is close this realization account after these entries, and whatever profit you get, no, you credit it to partner's capital. If in case there is loss, you debit it to partner's capital. After you transfer this, you transfer the share capital account where there will be reserves, there is realization profit or loss and capital, and that money should be paid to them. Realization account cash is there, no, same cash will come. So whatever cash is there will be paid to partners, cash account will get closed and cash will be paid to partners. To the extent cash is not paid to partners, it will be realization. Are you getting it? So this is how we do accounting for liquidation or dissolution of partnership. But life will not be so simple. Life will not be so simple. The reason is, what did we do now? We sold all the assets, we realized the entire money, we paid all the liabilities, and we paid the capital. Will you sell all the assets like this at once? No. You sell the assets in installments. You sold land today, the other plant and machinery you're trying to sell, trying to sell. It took 1 month, it took 2 months. Will you tell all the liability holders, wait, I won't give money now. I will sell all the assets. After that, I will start paying you. Will you do that? No. The money is realized. You need to start paying it simultaneously. So you sold one land, you got 1 lakh. You have 4 liabilities. You should pay all the 4 liabilities. Whom do you pay first? All the liabilities will be paid in the same priority. All the liabilities will be paid in There is bank overdraft, there is creditors, there is loan. All the three liabilities will have same priority. Let us say creditors is 20,000, bank overdraft is 30,000, loan is 1 lakh. So 20, 30, 1 lakh. Correct or not? We pay in the ratio 2 is to 3 is to 10. If we realize 50,000, 50,000, 2 by 10, 3 by 10, sorry, 2 by 15, 3 by 15, 10 by 15. We split in that ratio and then pay. After you pay all of these outside liabilities, then you pay partners loan. After you pay these outside liabilities, you will pay partners. After you pay partners loan, you will pay capital of partner. First you will pay outside liabilities, then you will pay partners loan, then you will pay partners capital. The next question. After you pay outside liabilities, then you should pay partners. When will you pay partners wife's loan if there is any? It is on par with outside liabilities. But isn't she the partner's partner? Partner's partner is not partnership's partner. Correct or not? For the partnership firm, that life partner of the partner is an outsider. It? So you write that outsiders liability, you write no creditors, bank overdraft, loan to Mrs. A or Mr. A also possible. Or some people do ask this question. Sir, why is always Mr. A the partner and Mrs. A the wife of the partner is given? Why can't be like Mrs. A is doing business and Mr. A is at home cooking? Possible. Possible. Don't question it. So Mrs. A can be a partner in the firm and Mr. A can be person who's contributed loan to the firm. Possible. Okay, you write that way. And whenever you disclose this, all of this, and then pay it in installments, no? So that's where we start calling it a piecemeal distribution. We need to understand how that money needs to be distributed between them. I forgot one more thing before that. In this case where we are trying to pay partners, no? Remember that partnership has unlimited liability. If in case realization from the assets is not sufficient to pay liabilities, realization from the assets is not sufficient to pay, then such liabilities have to be made good by bringing the money from partners' private estate. Partners has to bring in money from their private estate, from their personal assets to pay those liabilities. And if in case any of the partners' private estate or private assets is not sufficient to bring in money, means his liabilities are more than his assets, then we call it insolvency of a partner. If generally partner is insolvent, there is no problem. If the partnership firm has deficiency in cash and the partner is insolvent, then we are bothered. See, partnership firm, there is enough cash to pay all the liabilities. Partner is insolvent, firm doesn't care. Firm doesn't care. The problem starts when firm doesn't have money and the firm is going to ask money from partner and partner is insolvent. That's when we need to learn how to account. So what to do? Partner is insolvent. Who's an insolvent partner? Partner who has debit capital balance, meaning he has to bring in money to the firm, meaning firm has deficiency. Capital is 10,000. Realization loss is 12,000. In the capital account, you wrote credit side 10,000 capital, debit side realization account loss 12,000. His capital has 2,000 negative balance. And it is not or, and his personal assets are not sufficient to pay liabilities and is not able to bring in the 2,000. That's when we call him insolvent partner. Sir, what if partner's personal assets are not sufficient to pay his personal liabilities, but he doesn't have any liability to firm? His capital account has credit balance. Then do we call that partner as insolvent partner? He is an insolvent person, not an insolvent partner. Are you getting it? This entire case, what I'm going to teach you next, will come only and only when the firm has debit balance in the capital account of that partner and his private assets are not sufficient to pay his private liabilities, because of which he cannot make his capital good. Cannot make his capital good. His capital is negative. Capital is, if capital is negative means what? He owes money to firm. Can he bring money to firm? He cannot bring money to firm. And there is realization loss, meaning you don't have sufficient money to pay liabilities. You have to pay those liability holders. Who will bring? Solvent partners will bring. Solvent partners will, provided they have credit balance in their capital. If any of the partners who are solvent have debit balance in their capital, they are not supposed to make good this loss. Who tells this? This is applied by way of Garner versus Gray. What is this judgment called? So this is actually a landmark judgment in a case which happened long ago. in UK. So I'll show you the entire case also. So this is what happened. So the case had three parties: Garner, Murray, and Wilkins. So Garner, Murray, and Wilkins are three partners. In that, what happened? Wilkins had debit balance in their capital account, and Wilkins' private assets was not sufficient to pay his liabilities. So Wilkins could not bring money into the business. So Wilkins did not bring money. So Garner and Murray have to pay no to the liability holders. So Garner and Murray were fighting who should bring money. Garner and Murray were fighting who should bring money. In that, Garner had debit balance in his capital account, but he was solvent. Garner had debit balance in capital account, but he was solvent. Wilkins had credit balance in his capital account, and Wilkins was solvent. Garner was telling, I don't have to bring money. Wilkins was saying, both of us should bring money. And what ratio to bring? That case was it. So they went to Justice Joy. They went to the court, and in the court, the judge name is Justice Joy. He gave this judgment. When is this? This is in 1900. We're in 2023. So then Justice Joy told that Garner need not pay, only Murray should pay. Why? In the case of insolvency of any partner, the insolvency of the or deficiency in the account of the insolvent partner should be borne by the solvent partner with credit balance in their capital account. And he further gave how to do the accounting. I don't know if Justice Joy did LLB or did what is it, CA examination. He told first the all the partners whoever are there in the firm should bring their realization loss in cash. Should bring their realization loss in cash. Why? Realization loss is the amount of shortage. Realization loss is the amount of shortage. They should bring that in cash. If everyone brings, there is no deficiency. The problem is one of them won't be able to bring. Why? They don't have money to bring. Either they will not bring only or they'll bring part of it. They'll say he can bring only 50 rupees. Sometimes they'll say 50, 100, 200, they'll tell amount. Sometimes they say he's able to bring in only 50 paise in a rupee. That is 50% or 25 paise in a rupee. That insolvent partner. So you will write whatever is a realization loss that every partner should bring. But whatever that partner cannot bring, how much ever he can bring, you will write. After you write that, in the insolvent partner's capital column, there will be still deficiency. Why? Cannot bring full money. Whatever is the deficiency in the insolvent partner's capital account, what he cannot bring, has to be borne by solvent partners with credit balance in their capital. To be borne by whom? Solvent partners with credit balance in their, in what ratio? Not in profit sharing ratio, in capital ratio. In capital ratio, which capital do we put? Then one partner will say, capital ratio, no, just before dissolution, I will withdraw much money. Or after, just before this judgment, I will withdraw money, drawings. Why? My capital will come down means my last sharing will come down. In fact, I'll withdraw so much money that my capital will become debit balance. Then I don't have to pay, only that guy has to pay. Can you do that? Similar thing they do in B list contributors in liquidation. Get that? So to ensure that this doesn't happen, the capital should be taken just before dissolution, just before you execute this dissolution process. Whatever capital is there, that has to be taken. And again, it totally depends what is the capital system for. Is it a fixed capital system or is it fluctuating capital system? It is fixed capital system. Then the fixed capital is there, no, that itself. If it is fluctuating, then we should take capital just before dissolution. Just before dissolution means all these dissolution entries will come, no? Before you start passing dissolution entries. Before you start passing dissolution entries. Whatever capital is there, that has to be taken. By fluctuating, no? Capital account, current account, both are in same thing. If capital account, current account, both are separate, whatever is the balance in capital account is the balance as per partnership deed. That is the ratio that we take. Getting it? Yeah. I'll give you a minute. You can enjoy reading this. It'll be like a short break. Yeah, enjoy reading this. This is what happened in the literal case of Garner and Murray. Font size okay? One paragraph done. It is not 635 rupees. It is 635 euros or pounds. Doubt. Wilkins is the unsung hero. It actually named as Wilsing and Justice Dewey. Wilkins declared himself solvent. It might sound funny, but this is actually practically very correct. When you do piecemeal distribution, you get that surplus efficiency, surplus adjusted between partners. When you do know, that is nothing but Garner versus Murray only being adjusted there. Mathematically also correct. This holds good. That's it. And there is some criticism against this. And just for thought, what is it that I have my interpretation also I have given it here. So let's not waste time reading that. And did you understand Garner versus Murray now? Okay. Let's quickly revise Garner versus Murray once again because this is important. Now tell me. In Garner versus Murray, when is it applicable? One or more partners is declared insolvent, not all of them. And there is no agreement between the partner to share deficiency. If they have specific agreement written as to how are they going to deal with deficiency, we'll follow that. If that is not there, that's when we go with Garner versus. What do we do in Garner versus Murray? Points to remember. You can read this or shall I tell? What do we do? I'll tell. Realization loss will be brought in cash by all partners. If there is an insolvent partner, he cannot bring it. If he can bring part of it, we'll make him bring part. After you write that realization loss brought in cash, in the insolvent partner's capital column, we find balance. That is the deficiency, what is unable to bring. So much of money has to be brought in or made good, or it should be shared between the solvent partners with the credit balance in their capital. Okay. Solvent partners with credit balance in their capital account should bear it in what ratio? Capital ratio. What capital? If it is fixed capital system, whatever the ratio, the fixed capital, the same thing. If it is fluctuating capital, then we need to compute the capital just before dissolution. We need to compute the capital just before, and in that ratio is split. Got it? And I've given it all here: fixed capital system, fluctuating capital system. So if you already have your own short notes, I will tell you very honestly, please stick to your own. If you have not made your own short notes, then you can refer. But if you're already very comfortable with something, some notes, some place say you're reading, please don't change. Too late to change. Yeah. Next, let's start with that piecemeal distribution. Sorry, I started piecemeal before Garner versus Murray, and then I realized that Intel Garner, and then we did Garner versus. Will we come back to piecemeal? Piecemeal says that meals should not be added in lump sum; it should be added in piece. Like realization will happen in piece. Settlement of liabilities also will happen in piece. So little bit of realization has happened. Whom do we give? How much do we give? How do we give? Whom do we give? All the liabilities. What order? No priority order. All of them have equal right. In what ratio? Ratio of their outstanding balance. Ratio of their, are you getting it? And after you pay this outside liability, including the partner's partner loan, then you pay the partner's loan. After you pay partner's loan, then you should pay partners. To pay partners, there are two methods. To pay partners, how to compute the amount? There are two methods. So what are these two methods called as? One is called as highest relative surplus capital method. What is it called as? highest relative surplus capital method, or in short, people call it surplus method. And there's another method called as maximum loss. They are name wise two methods. Accounting wise, they are same. They give same answer. It is just that same thing seen from two different perspectives. From what I have, after I give you what after what is given, what is left is I should take, is what I should take. This is one approach. Other one says from what I have, after I take what I should take, what is left is to be given. That's the difference. Both are same, no? Or in order to tell you in different way, this is what I should get. From what I should get, if I deduct what I will get, what is left is what I won't get. Or other way is from what I should get, if I deduct what I won't get, what is there is what I get. ಅರ್ಥ You take one partner's capital account. You take one partner's capital. In the partner's capital account, credit side you write their capital, you write their reserves, and then you write realization profit. If there is realization loss or accumulated loss, you write on the debit side. Correct or not? After this, there are two things. One, you pay them and balance carried on. Because this dissolution, balance carried on won't come. So there is cash. So you write amount payable to partner, everything, reserves, realization profit or realization loss, and then you pay them. In this, it is about three items. One, capital, payment, realization loss. I will tell this much is the amount payable. This much is paid. So this much is loss. This much is paid. So this much is not paid to them. This much is loss. Loss is found as balancing figure. That is highest relative surplus capital. Now what is maximum loss method? This is the capital to be paid. In this much we won't pay. This much we won't pay. So this much is paid. That is maximum loss. In your partner's capital, if you write buy cash first and then find buy realization account loss later, that is highest relative surplus. If you first identify realization loss and then tell how much is the money to be paid, that is maximum loss. Both ways answer will be same. Getting it? Yes or no? So let's quickly see that part. Maximum loss and highest relative surplus. If I teach you the theory here, you wouldn't understand much. This table is little too nonsense to make you understand. The moment I say you will either sleep or you will either not understand. There is no point of understanding. So shall I show you a problem to make you understand? Very good. So what we do is under either of the methods, the way you do accounting for outside liabilities is same. There's going to be no change there. Is it? The way you settle outside liabilities will be same. There is going to be no change there. Yeah. The dissolution approach, accounting is done under realization approach. Process is piecemeal distribution. That is highest relative surplus capital method or maximum loss method. And so this is our material. Whatever questions are there, no. First question number 1 to question number 14 is realization. 15, 16, 17, 18, 19, 20, 21 is HRSCM and maximum. 15th one I've done under both methods. So I'll show 15th. If you already have the material, you can see 15th one. If you don't have, don't worry. I will show the question on the. How many of you are here for the first time? You don't have the material? Don't worry. You have a neighbor? You don't have a neighbor. Let's show the question. Hi, John. Yes. I didn't. You both were not there yesterday. Also, you were there yesterday. I've seen you before. I've seen you before. Oh, we've met before. I've not seen you before. I've seen. Then you didn't have long hair, maybe. Nice. Ah, and what I've seen students present is for highest relative surplus capital method, you write particulars, then you write amount available column, amount payable column, liability 1, liability 2, liability 3, then partner A, partner B, partners. You'll do one big table. Don't do one such big table. You will not have so much space in the examination. And lot of items is only becoming lengthy and repetitive. So what you do is whether it is highest relative surplus capital method or maximum loss method. First to do a table for settling outside liabilities. First do a table for settling. After you do outside liability settlement, then you write settlement to partners on separate table. Maximum loss method, you do two tables. Highest relative surplus capital method, you do one table. Don't do that. For both the methods, do two tables. One table for outside liabilities, one table for capital. Get that? So outside liabilities table and capital table. I think I've done one concept capsule. It's better off I explain the concept capsule. Why? Why to disappoint people? Some people don't have material. So let me disappoint everyone. This is the question. This is the So there is assets of 1,10,000. What is the value of the assets? 1,10,000. And capital of A and B is 10 and 10. There is A's loan. This is partner's loan. And creditors and loan, not from partner. So now when we sell these assets and then we start paying liabilities, whom do we pay first? First we should pay creditors and loan to partner. After we pay creditors and loan to partners, from what is left, we will pay A's loan. After we pay A's loan, from what is left, we'll pay capitals. You getting it? This entire sundry assets is not realized one shot. This is realized in three installments. Sundry assets means all the assets together. So there are three realizations. Realization number one, 40,000. Realization number two, 30,000. Realization number three is another 30,000. So three installments may will doing realization 40, 30, 30. We can't wait for complete realization to be over to start paying. So what do? We pay whenever we receive. So let us say we realized 40,000. We realized 40,000. When I realized 40,000, so let us see, this is the statement showing distribution of realization proceeds to creditors or outsiders loan and partners loan. Should I clear this and then show the numbers freshly, or should the numbers be there freshly? Okay. Now, the first realization. Let me start with this part now. Let's write first realization. How much is first realization? Have a look here. Hey, do you want to copy the question? Lazy people. I'll scroll up, scroll down. Like, sir, you scroll up, scroll up. We'll keep our ass like this. 40,000 first realization. So I'll write first realization amount available is 40. What is the liabilities to be paid? Creditors, loan, and A's loan. How much is creditor? How much is loan? How much is A's loan? 15, 45, 30. Shall I write 15, 45, 30? I should pay 15, I should pay 45, I should pay 30. Together, how much should I pay? 45 plus 15, 60. 60 plus 30, 90,000 is the total amount payable. Amount available is, so now we'll pay this 40,000. To whom? Creditors and loan both. Creditors and loan both. Here also I'll write 40. Now, how much should I give to creditors? How much should I give towards loan? 40,000 multiplied by 15 divided by 60 and 40,000 multiplied by 45 divided by 60. Do it. 10,000 and 30,000. Did you understand this? And do you have any money to pay to A? No, we don't have. So A's loan will be 30,000. Loan 45 was there, 30 is paid. How much is remaining? 50. Creditors 15 was supposed to be paid, 10 is paid. How much is remaining? 5. Amount payable was 90, 40 is paid, 50. Here amount available is 0. Now we'll go for second real. How much is second realization? 30,000. So let me write here second realization. So this 30 also should be again paid to creditors and loan. So shall I say less creditors and loan? How much? 30. But here payable is only 20. Will you give them more? Will give them only 20. Hello, 30 ಕೊಟ್ಬಿಡೋಣ sir. ದುಡ್ಡು minus 20. So we'll write 20 in the ratio 20 into 15 by 60, 20 into 45 by 60. Do it. You should get 5 and 15. You should get. You get 5 and 15. We paid. So we still left with how much? 10,000. We still left with 10,000. This 10,000 will pay to whom? Yes loan. How much is yes loan? 30. We can only pay 10. So still yes loan is remaining 20. This loan creditors is paid. Total amount payable is 20. Now can I go to third realization? Look at the question. How much is third realization? Last realization 30,000. So let me write credit. Sorry, last realization 30. Whom do I pay this to? Ace loan. How much? 20. So 20,000 liability will decrease. So this liability 0, Ace loan 0, loan 0, creditor 0. Correct? I'm still left with how much? 10,000 is still there with me. So this 10,000 I'll use it to pay whom? Partners capital. Partners. Now the question is, partners are like this, A and B, 10,000, 10,000. And their profit sharing ratio is not given in the question. So their profit sharing ratio is equal. Profit sharing ratio is, now whom do we pay this amount of 10,000? Both of them? Whom first? You should try to actually find it. So in my partner's capital account, let's say I write balance brought down 20,000. Get this? A 10, B 10. Correct? No, capital is how much? A is 10, B is 10. So 20. When I write A 10, B 10, 20, and I basically write cash available is how much? 10,000. I'll write cash of 10,000 is available and say realization account is 10,000. That is loss. Why? I'm supposed to pay 20, but I have only 10. I'm supposed to pay 20, but I have only 10. So 10,000 is loss. I'm finding this loss as balancing figure. This is highest relative surplus capital method. Highest relative surplus capital method. And if in case I write here, balance brought down is 20. You getting it? So realization loss is 10,000. And then I find how much is the amount that I can pay now? 10,000. I'll find this 10,000 as balance figure. That is maximum loss. Ledger account, you are not understanding the difference. When you do the table, you will understand it. Shall I do the table? And this is an introduction question. No, only one realization. Usually to partners also there will be several realizations. 3, 4 realizations for partners. Then it will become interesting. If you want, I'll show one of such problems as well. Now let's see. Amount payable to partner is 10 and 10. Correct or not? Totally how much should we pay? 20. So profit sharing ratio of the partners. What is the profit sharing ratio? 1 and 1. So is anyone contributing any surplus more than his share of capital? If anyone has contributed more than their share of capital, they should be paid in priority. Here, none of them have paid that way. Both of them have paid 10 and 10. Correct or not? So this is their capital per share. Capital per share. So if in case one has contributed more, the other has contributed less. The one who has contributed less, we take their capital as base and then identify what should have been the capitals of other partners if we take that partner with less capital as base. And whatever they've contributed actually over and above that base capital will be called as surplus. Will be called as surplus. If more than one partner has surplus, we call it relative surplus. If other partners don't have surplus, only one partner has surplus, we call it absolute surplus. We need to compute absolute surplus. First, we would have to pay absolute surplus. Then we need to pay relative surplus. After that, we need to pay the balance of the capital. This is as per PS. I'll do one more example. Okay, let's do this quick. So now what do? We need to start paying them. So 20,000 is to be paid, 10,000, 10,000. I'll start paying them the same ratio. Amount paid is 10,000. I'll pay 5 and 5 equally. Got it? So 5 and 5,000, 10,000 will be realization. This is our table under IS relative surplus capital. Still you're wondering how can this and maximum loss method be different yet so same? Shall I show a maximum loss? Under maximum loss, what we do is amount payable is 10 and 10, 20. I won't write that 10,000 how it should be split. I'll write amount available as 10,000. So 20,000 is payable, 10,000 is available. Tell me how much is realization loss? 10,000 is realization loss. Do you agree with me? Amount payable is 10. So amount available is 20. Amount of payable is 10. So realization loss is 10. This loss should be borne by them in profit sharing ratio. Share that loss to them. How much is 10,000 to be shared between them? 10,000 into 1 by 2, 1 by 2. 5 and 5. Out of this 10,000, they won't get this 5,000. So how much do they get? 5. How much this guy gets? 5. So amount available is 10. From this amount available, I'll deduct this 10 in the ratio 5 and 5. And whatever we did here, no, this is just working out. If I eliminate this sky blue, that will become highest relative surplus capital. Did you understand? How is it same yet so different? Okay. If you want, I'll take another example question with different ratios, profit sharing ratio being different. Shall we? Okay. Okay. But for me to do this, I want you to copy question. It will take 10 seconds. I don't want to scroll up, scroll down, scroll up, scroll down again. Copy this question and we'll quickly finish this answer. Example question. We'll do this question with maximum loss method. And okay, I want to do the same question under both methods so that you want this absolute surplus. It's the same question. Or do you have any question from the material which you want to me to do? Any question that bothers you? Or shall I do this question only? You tell, guys. I think we'll do these two capsule questions. Too much of time ತಗೊಳುತ್ತೆ. Copy this. We'll do quickly maximum loss method, and I'll do one highest relative surplus capital. Done. Data 2 is to 1 is to 1, capital is to realization is to. I don't want to write all the want you to write all the statements. At least basic data you write, so that when we're doing the question, you have the when we're doing the answer, you have the question. Initially, when we planned marathon revision, I was trying to do one cheat sheet, like a sheet where theory is already printed. Whatever problems I'm solving, question is printed and format is put for the answer. Only numbers have to be put. So I started planning doing it. Then my last 15 days, wherein I was supposed to not have class, got blocked with. We had to do this also abruptly in the not as per a proper plan. So I couldn't do that. Otherwise, the plan was to do that. But I still did it for one chapter consolidation. We used it in regular batch also. Next batch will have a proper some 50-60 pages material for crash course exclusive, which has theory printed, question printed, format for answer printed. Only numbers have to be filled. So as and when I do the answer, you can also fill it there. Feel little confident that you wrote something. Today you sat for so long but didn't write a single. That you wrote little for the sake of writing and to not fall asleep. Aryan, you are blocked. I can't see you. Because he's right here. Can we start? Pakka. People wrote the question. Question is so small. Answer is going to be so big. So here we are assuming that all the liabilities are already paid. But because that liability table is easy, no? After paying all the liabilities, we have realized 50, 40, 80, and capitals of the partners are 1 lakh, 60, and 40. Profit sharing ratio is 2 is to 1 is to 1. Shall we do this now? Let's quickly write partners capital. How much is partners capital? Beam. ಇದನ್ನ ಹೇಳಿ ಅಂತಾನೆ ಬರ್ಸಿದ ಕ್ವಶನ್ beam ಚುಟ್ಕಿ ಚುಟ್ಕಿ Raju, Raju. How much? 40. You got this? Now, let's quickly write realization proceeds. How much is the realization proceeds? First realization proceed. What date? 29th of April. How much? 50. Here amount payable is 1 lakh plus 60 plus 40. 2 lakh. Now, what do? We are doing maximum loss method. This is called pessimistic approach. Pessimistic, we believe that this realization happened of 50,000. Ashte. We won't have any realization. All the good days in our life is over. Anymore, it's only bad days. It's a negative statement. What if I tell you the entire good days in your life is over? Sir, I don't want to continue. Now listen. So what I'm going to do is 50,000 is the realization, and we're not going to have any realization after this 50. So partners are to be paid how much? 2 lakh. How much do we pay? 50. So how much will be their loss? Assuming that 50,000 is the only realization and balance is loss. How much will be loss? 1 lakh 50. This 1 lakh 50,000 loss, this I got it by doing 2 lakh minus 50. Am I right? This loss has to be shared between partners. In what ratio? Profit sharing ratio. What is their PSR? 2 is to 1 is to. So 1 lakh 50 into 2 by 4, 1 by 4, 1 by 4. What do we get? 75. Then 37,500. 37. Got this? Yeah. So in 1 lakh, what was supposed to be paid to be 75,000 will not be paid. So how much will be paid? 25. How much will be paid? 25. Chutki was supposed to be paid 60. In that 37,500 she won't get. How much will she get? 22,500. The 60 minus 37,500. So complex. Calculate. You had once been, I had once told you to get calculator, no, in the class, regular batch. Textbook, textbook, calculator. Who's your friend? Yeah. Okay, 40 minus 37,500. 2,500. So these are the monies to be paid. 25 plus 22,500 plus 2,500. We have 50. We have that much only. So shall we give that? Less amount paid to partners. Minus 50. Minus 50. Minus 25. Minus 22,500. Minus. Whatever we did here, no? Two is okay. So not counted. Now again, how much money should be paid to Beam? Beam should be paid 75. Chutki should be paid 37,500. Raju should be paid 37,500. You get this? Now again, same story. How much should be paid in total? 75 plus 37,500 plus 37,500. 1 lakh 50. How much is the next realization that we have? 40. Next realization is in this 40. We are assuming that Ashte 40 is only lucky. We thought we will never get anything after this 50, but somewhere little more of punya was left. We got this 40. After this, everything is papa only. Like all sins of my all previous lives, I'm going to pay for it now. I'm not going to realize any money further. 1 lakh 50 is supposed to be paid. Only 40 will be realized. So what will be loss? 1 lakh 50 minus 40. 1 lakh 10,000 is loss. This 1 lakh 10,000 should be shared between partners in PSR. 2 by 4, 1 by 4, 1 by 4. 55. Then 27,500, 27,500. In 75, 55,000 will not be paid. How much will be paid? In 37,500, 27,500 will not be paid. How much will be paid? 10. Here, 10. 10 plus 20, 10 plus 10 plus 20. Hey, we have 20. We have exactly 40,000. Shall we pay 40? 20, 10, 10. Correct? Then 75 minus 20. 50 is still supposed to be paid. But 55 is still supposed to be paid. 37,500 minus 10. 27,500 should still be paid. Again, 37,500 minus 10. 27,500 should still be paid. So totally how much should you pay? 90. Sorry, 1 lakh 10. How? 1 lakh 50, 40. We told 1 lakh 10 loss now. But 1 lakh 10 should be still paid. Here you see 1 lakh 50 was assumed loss now. 1 lakh 50 should be still paid. Okay. Now 1 lakh 10 has to be paid and then we have one more realization. How much is next realization? 80,000. We are assuming that 1 lakh 10 is there, no? Only 80 realization. Ashte. Enu barala. How much loss? 30. 30, no? 30 has to be shared between partners. 2 by 4, 1 by 4, 1 by 4. 15, 7,500 and 7,500. If 55 may 15, I won't pay. How much will I pay? 40. 27,500 minus 1,500, 20, 20. 20 plus 20, 40. 40 plus 40, 80. Hey, 80,000 we have. We'll pay 80,000. 40, 20, 20. And this much what we did is just working. To compute how much to pay, we're assuming that if we don't realize anything further, balance is lost. If we say how much they won't get, balance figure is how much they will get. See, this is partners capital. This table is like partners capital. This is credit side, payable. I wrote realization loss debit side and found the amount to be paid as balance figure. In highest relative surplus capital method, what do? We put their capital, we put the ratio, divide capital by ratio, find out surplus, and surplus has to be paid. We write how much should be paid. From payable, after what we pay, what is left is realization loss. So there we write paid first, find loss as balance sheet. Here we write loss first, and then find paid as balance. That's true. Answer will be same, both methods. That's it. Is there any more realization? No. Is there any realization left after this? Realization loss is 30, 15, 7,500. Got this? Okay. Should I solve the same question under highest relative surplus capital method or a different example? Same to same. Different question ready ಇದೆ. ಇದು solve ಮಾಡಬೇಕು. Different question okay na? If you want different one, I will solve now, but it will take slightly more time. Different one, copy the question. Concept capsule number 2. So you might end up taking 10 minutes. Format, table, formula. Guys, like I know, I was there the day this was invented. Remember one day Shisha diploma. Their class was foundation class. Don't know, you're in inter now. Next history foundation class. Matter of time, be giving visiting card and then advertisement transfer pricing. You just follow away. And after that, do you have any articled assistance for referencing? Like you'll be teaching, no. You tell me if there is any. Allig ಬರುತ್ತೀರಾ of year or two, not year or 2 years articleship is only matter of 3 years. Thankfully, at least membership number. What is your membership? 2 is it? 1 difference. Good. And one of the very first students whom I've thought, no, their membership number and my membership number, no difference is about 5,000 6,000. Was the attempt in which I cleared. In the very next attempt, a lot of my students, because I had taught them at CPT when I had not even started my final examination. I was still doing first year, second year of article. So we cleared with 6 months gap. Numbers are about 5,000 6,000 because I applied also late for membership. Got it? You copied the question? Let's start with that. When it is this absolute surplus method, no, this highest relative surplus capital method, you have to do 2 tables to compute the payment. First you have to identify what is the order of payment and then you start paying. So just to summarize, under maximum loss method or highest relative surplus capital method, you prepare a table to pay outside liabilities first. After you pay outside liabilities, if it is maximum loss, you start with payment to partners. Within the table only you do working note. If it is absolute surplus, you can't do working note within the table. I can show, I can do, but you won't be able to write. Mine is Excel sheet. Column insert. Your book may space will not be sufficient. So do one separate table to compute surplus. Do one separate table to compute surplus. Then do one separate table to distribute the payment. Getting it? Distribution is actual work, actual table, and computation of surplus is the working. Shall we start with the working note now? Tell me what are the capitals of the partners? 2 lakh, 1 lakh, 1 lakh. What is their profit sharing ratio? 1:1:1. See, their profit sharing ratio is equal. So I cannot say whatever realization proceeds are there available to pay partners, I'll pay them equally. You can't do that. Why? There are certain partners who has paid more than the capital that they should pay. Are you getting it? Now take their capital, divide by profit sharing ratio, identify capital per share. For per share is paid 2 lakh. Per share B has paid 1 lakh. Per share C has paid 1 lakh. Sir, same thing you do. Because the ratio is equal, it's little simple. If you want, I'll change the ratio to 3 is to 2. Will come. The next concept caption. I'll show you that. Yeah, we'll solve this. So we'll take the lowest as base. What is the lowest here? If I take the lowest as base, taking this lowest capital of 1 lakh as base capital, we find capital of each partner. How much they should have made it. How much they? Now tell me. What is the capital as per base? A's capital should have been 1. B capital also should have been 1. C's capital also should have been 1. But as A contributed only 1, no, A has contributed 2. How much is the surplus that A has contributed? 2 lakh minus 1 lakh. 1 lakh extra. What about B? We've taken his capital only as base, obviously 0. But what about C? 50,000. 1 lakh 50 minus. Now, among A and C, who should be paid first? That also we should find again. This is not the end. There are two people to be paid, no? So this is relative surplus, not absolute surplus. So A should receive 1 lakh before B. C should receive 50,000 before C. Why? A has paid 1 lakh more than the normal capital what anyone would have paid. C has paid 50,000 more than the normal capital anyone would have paid. So what do? We divide this relative surplus by profit sharing ratio 1 and 1. We divide this relative surplus, not the initial capital. This relative surplus. Surplus allu yaar first iskobeku. Then we'll do capital per share, or actually this is surplus per share. This is actually relative surplus. This chapter is going to CA Foundation. The next June 2024, CA Foundation students, full fresh show. They come from second PUC. Yeah, they would have done in dissolution. Cash account will tally. They'll be like dissolution, sir, easy, sir, dissolution, 100 second PUC accounts. Peaceful distribution. So 1 lakh divided by 1. 1 lakh here, 50,000 divided by 1, 50,000. What do we take as base? Lowest surplus. Lowest surplus, base surplus per share is 50,000. Yeah. Now, when you take the base surplus per share, A should have given 50,000 as surplus. B should have given 50,000 as surplus. But A has given much more. How much is A's surplus? 1 lakh. How much he should have given? 50. How much is his extra money? Absolute surplus. This guy has nothing. So now what we should pay? First we should pay this 50,000. First we should pay this 50,000. After we pay this 50,000, we pay this relative surplus. After we pay this, finally we pay. Did you understand? First we should pay 50,000 to A. If we pay 50,000 to A, look at the capital. How much is capital of A? 2 lakh. B, 1 lakh. C, 1 lakh 50. Same profit sharing ratio, no? If you pay 50,000 rupees to A, A's capital will become 1 lakh 50. B will be 1 lakh. C will be 1 lakh. Then we'll pay A and C, both 50-50. A, B, C, all three will become 1 lakh, 1 lakh, 1 lakh. Then we pay them in profit sharing. You understand the priority order? Sir, after we pay 50,000 to A, we should pay 50 to A, 50 to C. Who should be paid first? Both together. Sir, what if we don't realize 1 lakh? We realized only 10,000. 5,000 to A, 5,000 to. What if their profit sharing ratio was not equal? We don't care. 50-50 idiyala. That amount ratio should find, not profit sharing ratio. What if it was 30 here, 20 here, 3:2 ratio, even if profit sharing ratio is equal? Got it? We do capital ratio, no? That's how it gets adjusted there in Garner versus Murray when we do this table. When we have realization loss, when we do this table, if one of the partners' capital becomes negative, that partner's capital will put it to other partners in profit sharing, capital ratio. No, their Garner versus Murray will get adjusted in piecemeal without even you realizing that it is G versus M. Got it? Now, when we start distributing the payments, now tell me, what is the amount payable to partners? 2 lakh, 1 lakh, totally 4 lakh 50. How much is the amount available? Have you written the question? How much is the available amount? 1 lakh. So whom should we pay first? First we should pay A. How much? 50. I'll write less absolute surplus of 50,000 to A. Still how much is remaining? Still 50 is remaining. Then we'll pay relative surplus. After this 50, next A and B. 50-50. Correct or not? Sir, 50-50 kotre 50,000 will enough 49,900. 50,000 into 1 by 2, 1 by 2. 25, 25. Got it? People have become so clinically sick that you are not in a position to appreciate joke. You laugh crazily for this joke in foundation. You used to at least smile in inter. Now you people have become dead inside. People are like, I will laugh after exam. Exam is over, no sir. Then I'll be like, I will laugh. Then nobody will come and joke. 2 lakh minus 50 minus 25. How much? 125. Totally 225, 350 is to be paid. How much is amount available? Realization. 1 lakh. See, in relative surplus, we are supposed to pay 1 lakh. We paid how much? Only 50. We'll pay another 50. Relative surplus between A and C, 25, 25. Still how much is remaining? Still 1 lakh is remaining. Now, first priority over, second priority over, then third priority. Equal 1 lakh, 1 lakh, 1 lakh. How much is remaining? 1 lakh. But the unfortunate part is we can't share it equally. Why, sir? 33, 333, 33, 333, 33, 334. Or sir, 0.33, 1 paisa. Again, 1 paisa will be left. So write 1 rupee extra. Carry kodu. See? Why? In death of a partner, C will die. No. To keep here, 1 rupee. So 1 lakh. 33, 333, 33, 333, 33, 334. Got it? Then what is left after that? Here 125 minus 25 is 1 lakh minus 33, 333, 66, 667, 66, 667, 66, 666. Is there further realization? How much? 1 lakh. Again, this you pay same order. Capital as base 1 lakh, pay 33, 334, 33, 333, 33. Right? Then we gave C, no? Next we'll give A. You know, the realization is a B code. That will be sir. Then what do we have left? Realization loss. Whatever is left is 66, 667 minus 33, 333. 33, 333. 66, 667 minus 33, 333. 33, 334. Here, 33, 330. Together it is 1 lakh loss. Got it? Same thing you can do under maximum loss method. If you do under maximum loss method, the stable computation working is there, no? That will happen here only, in between, here in between, here in between, here in between. You're getting it? So if in case you guys can practice this much and then do it, this will be 10 marker, 15 marker questions in exam. You won't ask same both highest relative surplus and maximum loss. They'll ask either. And if they ask highest relative surplus or maximum, then there won't be question on realization. Usually one of them. Usually there will be realization based question or piecemeal distribution based question or amalgamation of firms question. Got it? I am no speculator. I can't speculate what comes, but I can cover everything. So I put one more capsule question where it is profit sharing ratio 3:1. Yeah, if you have to just quickly see table, I'll give you 10 seconds. I'll give you a minute. That relative surplus we divide by the ratio. You're done. Shift your Look at me, I'll understand. Amalgamation of firms. And one thing that I forgot to tell here is when you are paying, there can be a possibility of FEC and C, adjustment of surplus. That amount to be paid when you're computing, no, it will come as negative. It will come as negative for any of the partners. If it becomes negative, that negative amount you make it positive and then share it to the other partners in the profit sharing ratio. It will get adjusted. Got that? That's the point. And one more thing is there can be liquidators remuneration. Liquidators remuneration. Two ways. One can be percentage of assets realized, can be percentage of amount paid to partners. If they say percentage of assets realized, whenever you realize the asset, there only you put that percentage, you deduct, balance only you pay against liabilities, balance only you pay to capital. If they tell it as percentage of amount paid to partners, every time you realize money, you do into that percentage divided by 100 plus that percentage. After that, what remains, you go on sharing. Did you get it? If it is percentage of assets realized into X by 100, deduct that remuneration, balance you share. If it is amount paid to partners, you do that amount realized into X divided by 100 plus X. After deducting what remains has to be shared. When both are there together, when both are there together, and first realization, second realization, let's say you used it to pay liabilities. After you pay liabilities in second realization, some part is remaining and available for partners. Some part is remaining and available for partners. When you start with distribution to partners, again don't deduct the remuneration percentage of assets. Already that is given. Only deduct the percentage of remuneration that is to be deducted for payment to partners. That is done. Next realization. You deduct two. One for assets realized, two for payment to partners. Both have to be done. Both have to be cautious on that part. And some questions they'll tell provision for liquidation expenses to be made 10,000, 5,000, 15,000. They would tell that way. When they say that way, in the very first realization or from the cash balance only, you keep the money aside. You keep the money aside. And later at the end, they'll tell actual. When they tell actual, actual can be more than the provision or actual can be less than the provision. Let us say actual is less. You kept aside 15,000, but actual expenditure is only 12,000. So from 15,000, you incurred only 12. 3,000 will be left. That 3,000 you add back to realization, last realization. Last realization, you should add back that 3 and then distribute. What if there is excess? It need not be last, it can be in the middle also. One of the question that's there, that excess has to be made not in the last realization, but last but one realization. There only they've told that excess money incurred for realization. So whenever they give in that realization, deduct that extra amount also. Deduct that extra amount also. Done? Okay. So this is with regard to realization. And one question is a very, very famous question. This question is come multiple times in RTP under IPCC scheme. Before CA intermediate came IPCC scheme, this was part of examination also. So this is the question where one of the partner is minor. One of the partner is minor. To such minor partner, we should not share loss. Correct? No. Minor is admitted to the firm for the benefits of the firm. You cannot make him lose money. So then what do we do? How do we compute absolute surplus? First, very simple. You pay outside liabilities. No. Along with the outside liabilities, after you pay outside liabilities, before you pay partners, pay that minor partner. Treat that minor partner's part is actually capital, but treat it like partner's loan. How you settle partner's loan? No, you pay it like that. Pay it like that. But don't write in that liabilities table. Write it in the capital table only. But don't include it in surplus computation. Pay it after outside liabilities. Before you start paying partners, you pay him full money. Then you pay the rest of the partners in the same surplus computation and then done. So that's it, guys. So the rest entire chapter ka whatever the questions that is there in your book, solution to all the questions with working note color, it's there in the sheet. This sheet is a different sheet, but I can share this sheet also separately. Right? But this is not print justified. Group 1 accounting guide, it's print justified if you want, but this you can't take print. If you take print till F, it will come in one line, G will come in one more page. Print is not recommended, but you can read from this if you want to. Cool. So now we'll discuss amalgamation of partnership firm and then take break, or take break and then discuss amalgamation of firms. Amalgamation of partnership. Though the word says, or though the unit says amalgamation of partnership firm, there are two units, there are two topics in this. One is amalgamation of firms. There is one A company, there is one B company. They together form AB and company. That's one type. Second type is there is one A partnership firm, A and company. A, B, C are partners. They are converting that to private limited company. So that is also there. So there are two varieties. One, conversion of partnership firm to company. Second one, merger of two firms to form a new firm. If you've done amalgamation of companies well, no, almost majority of the concepts are very similar to what you've done there. It's just that partners capital may slight changes will come, which we need to understand. Can we start with unit 2 after chapter 2, amalgamation of firms and conversion of firm to company? So what are the journal entries? First, transfer the assets to realization, realization to assets. Then transfer the liabilities to realization, liabilities to realization. Remember, all the assets and liabilities to be transferred to realization account at book value, whether taken over or not. After that, this will be taken over by the new firm. Let us say new firm. Open a ledger called purchasing firm account. Here we write transferee company. Here we write purchasing firm account debit to realization. Got that? And then you will receive consideration in the new fund. There we used to receive consideration in the form of shares, debentures, cash. Here no share, no debenture, no cash. This partner will become partner in that company, that partnership firm. So we'll write capital in that partner to be given to this partner. No, straight away write partner's capital account, and then credit that. Credit that. So we are basically credited. No, realization purchasing firm debit. No, purchasing firm credit and debit the partner's capital account with the capital that they'll get in the new form. So first we settle. Then if there is any asset not taken over, that asset we will realize, bank to realization. We're going fast. If in case there is any liability not taken over, you settle it, realization to bank. Remember, nothing mentioned, asset realizes zero. Nothing mentioned, liability has to be settled at book value. After you settle this, realization expenses, if any paid, you write the entry. Then close realization account, transfer profit to partner's capital account, or close realization account and then transfer loss to realize partner's capital account. Accumulated profits to be transferred to partner's capital account. Accumulated losses to be transferred. Then that capital in the purchasing company will become the capital of that retiring part. Sorry, the partners who are selling their business. So that entry is purchase settlement entry. And then if there is any firm settlement entry, if they are paying some cash, or if the partnership firm's cash is not taken over by the new firm, some cash is left over, that cash will go to partners. Sir, in what ratio should we distribute that cash? Don't apply ratio. In partners capital column, whatever balancing figures you get no individually, that in total will become the cash that is available. Do you understand? If in case the liquidating partnership firm's cash is not taken over by the purchasing company or purchasing firm, then that cash will be left. No. How do we distribute that cash between the partners? What ratio should we put? Don't put ratio. That capital account, you identify balancing figures. After you transfer everything that should be paid to them, capital, reserves, realization profit, loss, accumulated losses, everything, you will give them capital in the new form. If you don't give enough capital in the new form, balance will be cash. Sometimes cash will be shortage. Cash will be shortage. Why? A specific partner who has lesser receivable has taken higher capital in the new form. Another partner who has higher receivable has taken lesser receivable in the new form. So then there will be cash balancing figure will come. That one partner will bring cash, which the other partner should take. One partner should bring cash, which the other partner should take. So there are two ways there. One, write cash, bring it to cash account and then settle. Or in this partner's capital account, write that partner's capital account. In that partner's capital account, write this partner. You can settle that way also, assuming that they are settled it privately. Or you can assume that firm is doing the settlement. What is recommended? Route it through cash account. Route it through cash account. Bring it to cash and then take it. You get that? That's one thing that you should note about this part. And we need to learn accounting in the books of the new form. Accounting in the books of the new form, what do we do? These assets and liabilities, everything will be taken over. No, debit all the assets, credit all the liabilities. Before that, you write that purchase account debit to liquidating firm account. Then write all the assets debit, liabilities credit, purchase account of business is that you credit. Same thing like business purchase to liquidator. Are you getting it? Then that firm account debit to capital of the partners in the same ratio what we agreed on. That will be the opening entries. And once we do this, we would have to prepare balance sheet also in some case. If it is partnership firm, we need to prepare horizontal balance sheet. That would do. If it is a company, you might have to prepare proper Schedule 3 balance sheet. Yeah, sometimes it will become little demanding. For 15 marks, they'll ask accounting entries, incorporation entries, as well as balance sheet. It will become lengthy. I agree. There you would have to save time in preparation of balance sheet. You have to save time in preparation of balance sheet. And balance sheet, we discussed it yesterday. Fine. Balance sheet, you know how to prepare. Just go on writing the items and then fill it. Do notes to accounts if required. If there is creditors, only creditors is there. Trade payables is the heading. No, don't go to prepare notes to accounts. There only you write. Chalega. Where in conversion of partnership firm to company, not in financial statements of company. They're expected to present. You are expected to prepare notes to accounts. Here you are not expected. Here trade payables is there. No. Right next to trade payables only in the bracket creditors and write the amount in the outer. Got it? PP don't even have to prepare notes to accounts. There is only building both the companies. Right, 10,000 plus 20,000. Both the firms think then write without preparation of notes. And skip, take it little lightly here. But in the chapter where they are expecting you to present the balance sheet, preparation and presentation of financial statements. That chapter may expected is only presentation. They're not expecting any computation. So they prepare with proper notes too. Got it? Come. So by this we are done with this part. Conversion of to company also same thing. Just the balance sheet will become slightly different. And instead of giving capital in the new firm in the form of partners capital, we give them shares. Shares can be issued at premium. Premium should be accounted only in the purchasing company's books, not in the books of the closing. Come. So I think we overshot, no? Took way more time than. But not bad. Huh? We finished some two big topics. So the plan was from 10 a.m. to 11:30. We took till 12. Break. How long? 10 minutes, 15 minutes. If you want longer break, then we'll keep lunch break also shorter. Not hungry enough for lunch? Not hungry. Short break of 10 minutes. Post break will start with consolidation. I'm here to do consolidation. After I do consolidation, will you people still sit? Will you? A buyback ESOP, I'll actually make it nice. Buyback, I'll teach you some nice shortcut which can make your life very simple. If you remember, in buyback, you do that one equation, no? Simultaneous linear equation. I will teach you how to skip the equation. I will teach you how to solve that question without doing equation. I promise. Sir, ಸುಮ್ಮನೆ ಸುಳ್ಳು ಹೇಳ್ತಾರೆ ಮತ್ತೆ ಕೊನೆಯಲ್ಲಿ ಹೆಂಗೆ ಜಾಬ್ ಅಂದ್ರೆ I'll actually teach. I did that. It works wonders. Yeah, like redemption of preference share, mein that formula works. No, similarly buyback, mein I'll teach you an amazing shortcut, and that we'll do at the end. We'll do ESOP and then do buyback. This video को अंत तक देखिएगा. Hello, let's take a short break. It is 12 o'clock. See you all at 12:15. When we come back, we'll do consult. Good morning once again, everyone. Welcome back to CA Intermediate Advanced Accounting Marathon Revision. Pre-break, we have finished discussion of amalgamation and partnership dissolution and amalgamation of firms and conversion of firm to company. Now, in this session, our objective is to do consolidation and consolidation, banking and NBFC. Oh, nice. Let's start with consolidation. The consolidation of financial statements is not optional, but it is mandatory. The reason being Section 129 of Companies Act 2013, when it defines financial statements, the definition of the word financial statements includes consolidation. So every entity, when it has a subsidiary, it is mandatory for it to consolidate the financial statements. Financial statements consolidation means consolidation of balance sheet, consolidation of statement of profit or loss, as well as consolidation of cash flow statement. All the three have to be consolidated. But that further, there are exceptions. if such holding subsidiary relationship is temporary in nature. Yeah, someone gave you one stock tip that this company share is dip, buy the dip, buy the dip. So you bought the shares without knowing that you bought more than 50%. Go rich, example. And your objective is to sell those shares after some time. You have no intention to have long-term control over such, what to say, company. Then you don't have to do consolidation. You had 40% of shares in that company, and the 31st of March it became 51%. Then April 15th you sold 30%. Should you prepare consolidated financial statements? Not required. Why? You have no intention to have long-term control over such company. And second one, you have long-term control over such company. You have long-term percentage of holding in that company. You have intention to hold it, but because of the market conditions and legal regulations, you can never exercise control over that company. Again, you don't have to do consolidation. For example, all your GST network is being made in GSTN. Heard of that? GSTN. GSTN is a Section 8 company registered under Companies Act 2013. GSTN is a Section 8 company, means not for profit organization. Company created for a purpose other than earning. So all your GST return, what you file 1, 2, 3, 3R, 3B, everything is there in the GSTR. And in the present date, no, what is the biggest what to say asset? It is not any inventory or it is not any land, building or anything. The biggest important asset is the idea and the business secret. It what I'm trying to resources, knowledge, what we call data. Data is the most significant asset in the modern time. Now, for any business which is sustaining the present time, who's your biggest competitor? If someone follows your model, if someone knows from whom are you buying, if someone knows to whom are you selling, if someone knows at what price are you buying, at what price are you selling, and in what quantities, in what month, entire data is available with GST. No, which month how much is purchased, where is season, which is not season, from whom do you buy, at what rate, what discount you get, everything is available in bills. Bill to bill data is uploaded to GST. When you file a GST, all the data is there with GST. Right? I'll tell you something very surprising. GSTN में percentage shareholding is there. No, whom do you think holds percentage of shares? What percentage and who holds? Huh? Surprisingly, more than 50% is held not by government. It is held by HDFC and Axis. Just imagine HDFC and Axis comes together and then says, we want data. They give GST data. They take the complete data and they start selling the data. Now there is one business which is doing really nice. You will identify, no, from whom are they paying, to whom are they selling. The entire their trade model can be copied. How much is their profit margin can be known only by the GST filing data that you done. You don't want your income tax data also, which is all wrong. I know. So that's why so much data business model can be completely copied. So the entire nation will come for a halt. Entire nation's economy will go for a toss that way. So though more than 50% holding, I think now it is 49 and 51. 51 is held by government, 49 is held by private players. But that was not the case. For the first 2-3 years of GST incorporation, 51% was held by Axis and HDFC, 49% was held by government with state government, central government with state government. So can we impose restrictions and then decide what to do with the data? Shall we start selling the data from GSTN? We can't do it. So though you hold more than 50%, long-term restrictions are such that you can't exercise any control. You can't exercise any control. So if that is the case, then you can't treat it as consolidate. You can't consolidate that financial statements into yours. Now your railways also they're starting PPP, no, public-private partnership model. When you say public-private partnership model, so in IRCTC there will be major amount of funds coming from private. So the financial statements of IRCTC should be consolidated with whoever invests more than 50. No, they can't, because though they'll invest more than 50, if in case they do, we don't know the ratio. If in case they invest more than 50, still they can't decide. Railway road nam pakkan mane road alaki, this railway station nam taate necessarily. They can't decide things. So I'm not telling you those small decisions. Even business decisions can't be taken by them. Getting it? So in such case, you don't have to do consolidation. Let's quickly start with consolidation of balance sheet. As and when we start doing the problems, I'll start explaining it. So these are the concepts that you need to learn. There are 19 concepts that I want you to learn. And over and above these 19 concepts, two concepts what I have not put into this is bonus issue cover. And two concepts I had missed in this. So those also I'll teach it to you once we dividend is eitherly. Dividend is also covered. Bonus issue is also covered. Okay, we'll start with the entire thing. So first we'll start with a fully owned subsidiary. Shall we do a fully owned subsidiary? So these are the two balance sheets we're trying to consolidate. These are the two balance sheets we're trying to consolidate. Consolidation is literal addition. We need to add one balance sheet to another balance sheet, line to line, line to line. So share capital of holding company is how much? 10,000 shares of rupees, one each, 1 lakh. No. So I'll write this 1 lakh. This 1 lakh rupees, whatever is there in the balance sheet of the holding company, I'll write it here. 10,000 shares of rupees 10 each. Then exactly in the same line, I have subsidiary share capital 50,000, 5,000 shares of rupees 10 each, 50,000. Am I right? I'll pick this from here. I'll write this also in the consolidated balance sheet. Liability side added. Then let's go to asset side. We have property, plant and equipment 50, property, plant and equipment 50. I'll add 50 plus 50. I'll write 50 plus 50. And then what do we have? Investment in subsidiary shares 50,000. Holding company has bought some investments. I'll write that investment in subsidiary company. Now the balance sheet will tell 1 lakh plus 50, 1 lakh 50, 1 lakh plus 50, 1 lakh 50. But what you need to understand here is the liability side, whatever the share capital that is there here, the asset side, whatever investment that's there here, it is the same. This investment is asset of holding company. This share capital is liability of subsidiary company. So in the till the time there are two different entities. You have asset, they have liability. But when you become one company in one balance sheet, that asset and liability is like mutual indebtedness. Similar lines. Do you get this? So what do I do? This investment is nothing but this share capital. I'll eliminate this share capital. I'll eliminate this investment. So in my consolidated balance sheet, I'll write equity share capital 1 lakh, PPE 1 lakh. That's it. This is how I prepare my consolidated balance sheet for a wholly owned subsidiary. Wholly owned subsidiary is 100% of that company I only hold. Get it? Now let's improvise the question a little. Let's make it not wholly owned, or it's a wholly owned subsidiary, but there is small difference. Here what happened here is 50,000 was the share capital and our investment was also 50,000. Come on here. How much is equity share capital here? 1 lakh. Ours is 1 lakh. What is subsidiary share capital? 50. Shall I write it together? I'll write here, see, 1 lakh and 50. Got it? I've added them and then everything. Then PPE 60,000, PPE 50,000. Together 1 lakh 10. I'll write PPE 60, PPE 50, 1 lakh 10. Got that? Then one more asset that is there in the holding company's balance sheet is investments. How much? 40. May I write? This 40,000 investment, I'll write in the balance sheet 40. Now the balance sheet will tally 150 plus 10, 160, 140, sorry, 1 lakh plus 50, 150, and then 1 lakh 10 plus 40, 150. But this investment here is representing this share capital. Do you agree with me? So we eliminated both and then prepared the balance sheet. But now the problem is here the share capital is 50,000 and here the investment is 40,000. If I eliminate this 40, I can deduct only 40 in this. I will be still left with 10,000. What is this 10,000 about? This is because the company has 5,000 shares. In this 5,000 shares, I own only 4,000 shares. Balance 1,000 shares is non-controlling interest, or what we call as minority interest. Shares what I don't own in the subsidiary but somebody else owns. So what do? I write that minority interest here in the balance sheet. I eliminate 40 here. I deduct 40 from this 50. Still what am I left with? 10,000. You get it? Okay. The next thing, if I redraft this, I'll write 1 lakh rupees share capital, minority interest 10,000, PPE 1 lakh. Presentation. Instead of scratching it, I do it little. Shall we go to the next one? Next concept. See the same thing. Equity share capital 1 lakh, equity share capital 50. Shall I write them together? 1 lakh and 50. How much do we write in consolidated balance sheet? 1 lakh. I'll write 1 lakh and 50, 1 lakh. Got it? What do we have after that? PPE 60, PPE 50. Together 1 lakh 10. Let me write PPE 60 plus 50, 1 lakh 10. Am I going fast? Getting it? Then what do we do after that? Investment in subsidiary is there 40,000. I'll write this investment in subsidiary 40. Done. Now we've written this investment asset here. There is share capital here. Both are representing the same thing. I will scratch it. Shall I? I'll eliminate this 40,000 from this 50,000. What do I get? 10,000. It is not minority interest in this question. You know why? In the previous question, it was minority interest because Out of the 5,000 shares, I held only 4,000. That 1,000 is somebody holding it. But in this case, 5,000 shares, what is there in the subsidiary? I am holding all 5,000 shares. So then why do we have 10,000 difference? Basically because this 50,000 is nominal value and I don't have to pay nominal value to buy. I might pay something more or I might pay something less. Here I paid only 40,000 to get the shares of nominal value 50. I paid only 40,000 to get shares of nominal value 50. So I made profit. I made 50,000 worth of capital I got, meaning 50,000 worth of assets is mine. I got 50,000 worth of assets by paying only 40,000 rupees. Profit, which is capital in nature. Profit, which is this capital profit of 10,000 is arrived at by eliminating 40,000 from asset and 40,000 from liability. That 10,000 capital profit will be capital reserve. So I'll write equity share capital 1 lakh. This 50 is eliminated. Capital reserve 10. PPE is 1 lakh 10 and my consolidated balance will tally. I'm gradually building it block by block. Got it? So in this question, what happened? He had to pay 50,000, but we paid only 40. We got 50,000 nominal value shares. That is assets worth 50,000 by paying only 40,000. In the next concept capsule, you know what's going to happen? You're going to get 5,000 shares whose nominal value is 50,000. That is right on the assets which are costing 50 by paying 60,000. So you paid more. You paid, shall we see how to treat it? Very simple. Share capital here 1 lakh, share capital here 50. I'll rate them both 1 lakh and 50. Then what do we have here? PPE 40, PPE 50. Together PPE 90. Got it? Then investments. How much is investments here? 60. Let me write here investments. Is there any outsider holding the shares? No, 100% subsidiary. So I'll eliminate 60 here and 50 here. Oh, not possible. I'll eliminate this 50 here and I'll eliminate this 50 from 60. I'm still left with 10,000. I'm still left with 10,000. I cannot write here as minus 10. I'll write it as asset. What is happening here? I'm getting 50,000 nominal value of shares by paying 60,000 rupees to them. I'm getting 50,000 worth of assets from them by paying 60,000. Then what does it mean? There is one more asset here worth 10,000 what I'm getting, which I don't know. I can't see. That is nothing but goodwill. Are you getting it? That's it. So you'll write 1 lakh rupees share capital, PPE 90, goodwill 10. Together 1 lakh, the balance will 10. Did you understand how will goodwill arise? How will capital reserve arise? Okay. Then we'll go to next case. Have a look at concept capsule number 5. At any point of time, if you think I'm going fast, you'd want a minute to stare at the answer or you'd want me to repeat what I'm telling, please ask. Stop me there. Got it? Yeah. See here. Capital is 1 lakh, no problem. 5,000 shares in subsidiary, no problem. We have 4,000 shares at 60,000. We knew 4,000 shares at 50,000, 4,000 shares at 40,000. Now we have 4,000 shares at 60,000. Because we have only 4,000 shares, that means there is minority interest. And we paid 60,000 instead of 40. So there is goodwill also. So both minority interest and goodwill coming. So I'll first take share capital of 1 lakh, share capital of 50. I'll write it together. Now we'll not do that writing and scratching. Now we'll act little mature. I'll write my share capital in my balance sheet. Who's preparing the balance sheet? Holding company. Holding company will write only holding company's capital. Holding company will not write subsidiary's capital. Why? On the share certificate of the subsidiary company's name is written. This is not subsidiary company's balance sheet. So I can't write. I will write this 1 lakh rupees my share capital in my balance sheet. Subsidiary share capital of 50,000. I will write outside the balance sheet. Shareholding of subsidiary. 5,000 shares or rupees 10 each. Done. Whatever is written in yellow, that's the only thing that I've written. Rest of the items are assumed to be not there. Today you want me to clear it and then do, I can clear it and then do it. This is fine. This will be a little quicker. So next item. What is the next item in the liability side? Nothing. Go to asset side. What do we have asset side? PPE. How much PPE? PPE 40, PPE 50. Shall I add them? Let's write in the balance sheet PPE 40 plus 50, 90. Done. Come to the next line of the question. Investment in subsidiaries 60,000. See, this investment I will not take it to my balance sheet assets. Why? This has to be adjusted with this. Correct? Huh? So I'll take this outside. Shall I take this outside? How many shares are there? 4,000 shares. So right here, share capital is 50,000 rupees, which is 5,000 shares. In this, holding company has 4,000 shares. If it is 4,000 shares, what is the nominal value? 40,000. If it is 4,000 shares, how much is nominal value? So this 40,000 nominal value should be adjusted against that investment. So I will prepare cost of control table. We call it cost of control. Call it cost of control. So we'll adjust this liability and asset. Here it's there, no. He has to adjust this 60 with this 50, no. In this 50, I don't own completely. Only 40 of this and 60 should be compared. You did know 40, 60, 20 goodwill. That's cost of control. So I'll write this 60,000 investment asset. 60,000 is asset. And in this 50,000, 40,000 is liability. You take the net now. If 40 liability, 60 asset, which is more? Asset. How much is that asset? Goodwill, 20,000. Understood? Goodwill will write in balance sheet 20. Got it? Here, 4,000 shares out of 5,000 I hold. How much does minority hold? 1,000. 1,000 will be 10,000. This I'll write it in balance sheet as minority. Take the balance sheet total 110. Did you understand? Previously, I used to do this scratching off here only. Now I've started to do as a separate table. Why? I would need it for the problems which becomes a little more complex. I would have to do a separate working. I don't do step 1, step 2, step 3, step 4 approach. Majority of you might have learned very different. So this I see it as, what to say, one kind of flow is what I bring it into. Yeah. If you're comfortable with whatever approach that you read, otherwise, please continue the same. Yeah. People who are open still to learn something, this is one. But ultimately, concept is same at the end. Just the way you present the working note is slightly. Got it? Next concept capsule. Okay. What is different in this one? We own 4,000 shares out of their 5,000. So there is minority interest. And we paid 30,000 for 40,000 nominal value worth of shares. So there will be capital reserve of 10,000. Shall I do it? Now, my share capital of 10,000 shares of rupees 1 lakh each. I'll write in my balance sheet. What do I do with subsidiary share capital of 5,000 shares of rupees 10 is 50,000? Separately, I should write to adjust. So I'll open one separate table where I'll write shareholding, share capital, 5,000 shares of rupees 10 is 50,000 rupees. Ashte, where ಏನು ಬರಿಬಾರದು. Just write so much. Then comes to next item, PPE. Our PPE is how much? 20. Their PPE is how much? 70 plus 50. Our PPE is 70, their PPE 50. Together 70 plus 50, 120. Done. Next item. Investment in subsidiary, 30,000 rupees and 4,000 shares. First focus on 4,000 shares. Focus on 4,000 shares. So shareholding of subsidiary is 5,000 shares. In that holding has 4,000 shares, which comes to 40,000. So this 40,000 is nominal value of investments, which is liability. Against this, how much is the asset here in the balance sheet? How much is the asset? 30. I'll write here book value of investment is 30. Book value of investment is, so liability 40, asset 30. Which is more? Liability. How much? Liability of 10,000. That liability will be capital reserve. If it was asset, it would have been goodwill. I'll write this capital reserve in reserves and surplus 10. Got it? Then out of shareholding, 4,000 holding. Correct? 1,000 will be minority. That is 10,000. Minority interest I'll write in balance sheet 10,000. Now look at balance sheet. 1 lakh plus 10 plus 10, 120. 120 PPE, it's 10. Consolidated balance. Will we slightly go to the next one now? Slowly after each concept capsule, I'm adding one new adjustment. You observe. Observe. What is the adjustment in this one? Reserves has come. Reserves and surplus of 10,000 in subsidiaries balance. Getting it? Whom does this reserve belong to? Holding and minority. Holding and, you're getting it? This has to be split between holding and minority. And further, the holdings share in the reserves should be categorized as how much is pre-acquisition and how much is post-acquisition. Why? Pre-acquisition reserve, whatever is there, is capital in nature. Post-acquisition reserve, what is there, is revenue in nature. Pre-acquisition reserve should be adjusted against the cost of investment, and post-acquisition reserve should be taken to general reserve, not P&L account. You get this? I'll do it. We need to do one more table for reserves in this case. Let's start with equity share capital. How much is my equity share capital? Where do we write it? In our consolidated balance. Shall I write? In my consolidated balance sheet, I'll write equity share capital 1 lakh. Got it? Let's go to subsidiary. What do we do with subsidiary share capital of 50? This has to be split. How much holding company and how much minority. So I'll prepare one separate working. I'll write share capital of subsidiary company. 5,000 shares of 10 each is 50,000. ಅಷ್ಟೇ ಬೇರೆ ಏನು ಬರೀಬಾರ್ದು ಇದೆಲ್ಲ ಆಮೇಲೆ ದಿಸ್ ಆಲ್ we don't know, we'll get to know later. Then what is there? Reserves and surplus of 10,000. Reserves and surplus of, there is some adjustment here. On the date of acquisition, reserves is how much? 2,000. So what do I do? Reserves of subsidiary is 10,000. Reserves of subsidiaries in that pre-acquisition is 2,000. Is capital in nature. Post-acquisition will be how much then? 8,000, which is revenue in nature. Is this 2,000 rupees pre-acquisition reserves is capital in nature. This will decrease the cost of. This will decrease the cost of. What do we do with this revenue reserve of 8,000? That will go to balance sheet. I will write in balance sheet revenue reserve 8,000. Straight away to balance sheet. Done. Is something. Then what do we have after that reserves? Balance sheet assets. PPE is to 50. PPE is to 60. 50 plus 60, 110. Balance sheet asset side. PPE 50 plus 60, 1 lakh. Come back to asset side. We have investment in subsidiary. 5,000 shares, 50,000 rupees. 5,000 shares. Let's do our share cap. Holding is how much? 5,000 shares, which is 50,000. So this is 100%. So minority is 0 in this question. Here I just want you to understand pre and post treatment of reserves. Then we'll do pre and post treatment of reserves with minority in the next concept. So 50,000. 50,000 is nominal value of investment. What is 50,000? I will write cost of control table. Nominal value of investment 50,000 liability. How much is the investment cost? Here, how much is the asset value? 50. But we need to adjust pre-acquisition reserves of 2. Whenever we receive pre-acquisition dividend in investment account also, what do? We deduct it from the cost of investments. In the investment account credit side amount column. That's what we're trying to do. Book value of investment is 50. From that, I deduct pre-acquisition reserve of 2,000. So I will have 48,000 as my asset. Now asset is 48, liability is 50. Which is more? Liability. By how much? 2,000. Liability is capital reserve. In my reserves and surplus, I'll write capital reserve. Done. Check the balance sheet total now. 1 lakh 2 plus 8, 1 lakh 10 and 1 lakh. You getting it? Some cases in the presentation, what they would do is this 2,000 pre-acquisition reserve, I'm deducting from the cost of investment. No. Some presentations, what is given in some materials, they usually add it to this nominal value 50. They say share in the share capital, share in the pre-acquisition reserves, they add. It will give same answer. If I add, it will become 52 here, 50 here, 2,000 liability capital reserve. But that is not in line with accounting standard 13. What people do when they do that such approach is, we are totally forgetting accounting standard 13. We are only applying AS 21. AS 21 doesn't tell how to adjust cost of control. It only tells it's capital in nature. So what we do there is we are completely ignoring accounting standard 13. Accounting standard 13 says pre-acquisition profit, dividend or interest should be deducted from correct, no, cost of investment. So we have to deduct. Answer will be same. You will get marks in the exam. You get marks in the exam by doing it. But if you ask me what's more appropriate, I will say deduct it from 50 and not add it to. Don't add it to liability 50. Deduct it from cost of investments. Got it? Shall we do next one? Too much? Jasti aita? Artha agtidya? Very good. So now have a look. So what is happening in this one? We hold 4,000 shares. How many shares do we hold? How much do they have? 5. So 1,000 minority interest is there. Reserves is 10,000. So now this reserves doesn't completely belong to us. This reserves will belong to minority also to an extent. So what do we do? This reserves should be split into pre and post. Among the pre-reserves should be further split into holding minority. Among the post again should be split into holding minority. Holdings pre-acquisition reserves will reduce the cost of investments. Holdings post-acquisition reserve will go to balance sheet. What do we do with minority share? Minority share in capital plus minority share in pre-acquisition reserves plus minority share in post acquisition reserves. We'll add all of it together and call it minority interest and write it in. Shall I solve? Have a look. So equity share capital, how much? 1 lakh. I'll write our share capital, our balance sheet. Then subsidiaries, 50,000. What do we do? I'll write it in share. 50,000. 5,000 shares of rupees 10 each. After that, this has to be split between holding minority. Right now, we don't know. Then reserves and surplus of minorities. Sorry, reserves and surplus of subsidiaries. How much? 10,000. In this, how much is pre-acquisition? So I'll write 10,000. Reserves of subsidiary 10,000. Split between pre and post. Pre 2, post 8. Pre 2 ಆದರೆ post ಎಷ್ಟಾಗುತ್ತೆ 8. ಕರೆಕ್ಟಾ? Then PPE. How much hours? 50. How much theirs? 6. What's mine is mine. What's there is also mine. 50 plus 60. 110. I'll write here. PPE. 50 plus 60. 1. Sir, but out of that 60, you don't own completely. I don't own completely, but I control it completely. And asset is based on control. So we write it here. However, to the extent I don't own, I'll write minority interest no later. So that this much assets is completely mine except this minority interest. Got it? Then we have investment in subsidiary. 4,000 shares, 50,000 rupees. So out of this 5,000, how much do I own? 4,000. How much is minority? 4,000 is mine, 1,000 is minority. Correct? So 40, 80%, 10,000 and 20%. This percentage is required now to share. So I was doing it from then only. 40,000 rupees is the nominal value of investment. I'll write in cost of control 40,000 lakh. Are you getting it? 10,000 minority interest computation will write share capital. How much is the cost of investments here? How much did we pay? 50. I'll write here in the cost of control book value of investments 50. This is asset. This is done. Next, what's after that? I think the question is over. Question is now we have the ratio here. No, how much holding? 80%. How much minority? 20%. So here we have segregated this reserve as pre-acquisition to be 2,000, post-acquisition to be 8,000. So this pre and post should be again split between holding and minority. How much holding? How much minority? How much holding? How much minority? You can say that I'll put two more boxes here only. Here I put reserve, pre, post. Under pre, holding minority, post, holding minority. I can do that way. What if there are two reserves? Reserve number 1, pre, post. Pre, holding minority, post, holding minority. Reserve number 2, pre, post. Pre, holding minority, post, holding minority. No, more reserve is it will look like some, what is a fiber root system. Getting what I'm trying to tell? So it's nice to draw arrow marks like that, but it will not work out here. We'd have to save time. So what do we do instead? I'll take pre-reserves and post-reserve, prepare a table. So in my table, I'll write how much is pre-acquisition reserve, 2,000. How much is post-acquisition reserve, 8,000. Same thing, guys. Pre-2, pre-2, post-8. Now we'll split between holding and minority. What is the ratio? 80 and I'll write here holding 80, minority 2,000 into 80%. 1,600. Holdings share in pre-acquisition profit. What is the accounting treatment? Should be used to reduce the cost of investment. How much is the cost of investments? 50. I'll reduce this 1,600 from there, making it 48,000. Asset is 48,400. Liability is 40. Goodwill of 8,400. I'll write in balance sheet goodwill 8,000. Then how much is post-acquisition share? 8,000 into 80%. 6,400. This 6,400 will go to balance sheet as revenue reserve 6,000. Minority share will be how much? 20% of 2,400, 20% of 8,000, 1,600. These both 400 and 1,600 will belong to minority. In my minority interest, they also get capital of 10,000, capital reserve of 400, revenue reserve of 1,600. Together, how much is minority interest? 12,000. This 12,000 I will post here. Minor. Done. Now see the total. 1 lakh plus 12,000 plus 6,000. 1 lakh 10 plus 8,000. You like this way of presentation? This chapter, what we did is this, whatever this box you see, no, no, that box was printed without numbers and without data. These two balance sheets were printed with numbers. People had to only fill these boxes in the, and later we did the big questions. Big questions they could do it themselves straight away. First question they could do it themselves. We did them also, but just this concept capsules will make our life very easy when we go to big questions. Yeah. Similarly, I did the concept capsule questions for partnership. Now trying to do similar thing for other chapter. So every chapter when we start, before we do question number 1, I want you to do some 15-20 small capsule questions. We do 15-20 small concept capsule questions. There other items only there. Only that adjustment item only will be there. So you become very comfortable doing it, and you will be able to cover more adjustments in less time. Lot of items are easy in the question. Only one adjustment is tricky. Just for that one adjustment, you do big question. If you do that, you won't be able to do many questions. So once you do this, you are aware of all the adjustments. Then you do big questions. Big question may you don't shiver because you already know, no, that only adjustment difficult part you trained well. Got it? Yeah. It's like every time you want to get match practice, you don't have to play a 50 over game. What are you bad at? Ball outside the off stump. Then you bring one net bowler and then only for 10 overs you bat only ball outside your off stump. So you become really good at it. You go to the match, whether the ball is outside off stump or the ball is right over your head, you will be able to play. Let's see. Next, illustration number or concept capsule number 9. See what's unique in this one. So there are two reserves. How many reserves? Tell me, what do we start with? First one, share capital. What do we do with share capital? Where do we write it? Consolidated balance sheet, liability side, share capital. Done. Next item. Hey, you should tell. I've done so many. I've done how many? I've done 8 examples. Subsidiary share capital. Where do we write? Outside the balance sheet, I'll write share capital 5,000 shares of which is 50,000. Ashte. Don't write more. What is after? Next item. General reserve. How much? 10 and 5. Where do we write? Outside the balance sheet, we write waiting to be split into pre and. So I'll open one more table here for reserves. General reserve 10,000. P&L account 5,000. Do we know the split? We don't. We'll come back later. Okay, now what is after that? Reserves over. Then PP, how much? 50, 65. Total 115. I will write in my balance sheet straight PP 50 plus 65. 115. The revaluation adjustment. Yeah, you see here, I have one episode list here. See, now we are doing illustration number 9. We're doing more than one reserve. Next will be negative reserve. After that, bonus issue, then dividend, then upward revaluation of PP, then downward revaluation, then upward with depreciation, then downward with depreciation, then mutual indebtedness, then mutual indebtedness upward. Previous one was downwards, then debenture. Yeah. So the next time this will be in the theme of friends. So it will be like, okay, one with fully owned subsidiary, one with minority interest, one where there is no goodwill, one with capital reserve. So each of them is like one episode. I'm making it like for theme based. Be fun to do. Be very hectic to do. ಮಾಡಕ್ಕೆ sit for long hours. Be exciting. Done. So PPE we added. Next. Investment in subsidiary. How much? Investment in subsidiary 4,000 shares. First we'll deal 4,000 shares. Then we'll come to 50. Where do we rate 4,000 shares? Share capital of subsidiary ಬರ್ದಿರ್ತೀವಲ್ಲ, there will split 4,000 and so I'll write here holding 4,000. So minority will be 1,000. If holding is 4,000, that will be 40,000 rupees and then 80%. Minority will be 10,000 rupees and 20%. So shall I write this 40,000? Where do we write 40,000? Cost of control. Liability asset. Asset. So I'll write cost of control. Book value of investment is how much? No. Sorry. Nominal value of investment is nominal value of investment is 40,000 liability. What about this 10,000? Minority interest share capital 10,000. Done. So next, investment value is how much? 50. This 50 where do we write? Cost of control, book value of asset. Book value of asset where do we write? Inner column 50. Inner column, everyone got it? Okay. What's after this? Come to next slide. On the date of acquisition, general reserve is 6, P&L account is 1. Sir, mathili 10 and 5 antide. 10 and 5 is on the balance sheet date. 6 and 1 is on the opening date. 6 and 1 is on the 12 rate. In the 10, 6 is pre, 4 is in P&L 5, 1 is pre, 4 is, shall we do that? In reserve sell rate. Pre is 6, post is in P&L account. Pre is 1, post is. So now we'll take these reserves together. So how much is pre? 6, 1 together 7. I'll write total 7,000 pre acquisition. Post acquisition 4, 4. Can I say 8? This has to be split between holding and minority. Do we know the ratio? Yeah. How much? 80 and 20. Shall we share in 80-20 ratio? 80% of 7,000. 5,000. Where do we write this 5,600? Deduct it from cost of investments. Where is cost of investments? ಅಲ್ಲಿ ಅಂದ್ರೆ cost of control. Cost of control, you would have written asset, no, book value of investment 50. From that you deduct pre-acquisition reserves 5,600. If you deduct 5,600, what do we get? 44,400. Done. Okay. Next item we go. 6,400 post-acquisition for holding. Where do we write it? Balance sheet. Straight away. Reserves. Revenue reserves. 6,400. After that, minority. 1,400 and 1,600. Where do we write? Minority in 1,400, 1,000. Together, 13,000. Where do we write this 13,000 minority interest? Balance sheet asset. And then here, asset is 44,400. Liability is 40,000. Tell me what is more. Asset of 4,400. That will be goodwill. Where do we write? Balance sheet asset side, goodwill 4,000. Everything is marked in yellow. Everything is closed. Getting it? Take this to one time ಬೇಕಾ 1 lakh plus 6,400 plus 13,000. 1,19,400. Liability side, sorry, asset side, 115 plus 4, 190, 400. Understood? Okay. That's what I asked. Do you want me to teach like this? The other approach was this way. ಇಲ್ಲಿ ಬಂದ್ಬಿಟ್ಟು ಇಲ್ಲಿ ಹಿಂಗೆ one more approach was like this. Consolidation. Consolidation, guys, this all the companies, what is their subsidiary, we merge, we add these two balance sheets together, we do one balance sheet, that is consolidation. And then basically tell what is control, what is non-controlling interest, what is minority interest, and then make you tell all these points. Consolidation of balance sheet, points to consider, ensure that the balance sheet dates are same, important date of identify date of acquisition, determine percentage of holding, explain it theoretically like this. How to treat reserves, how to treat bonus issue, how to treat dividend, tell orally statement. This is fine. Actually, the main adjustments will start now. Bonus issue, dividend, devaluation of asset, and all of that. But now you got used to this format, no? Now you're familiar. Now you feel no, idu alli baratte, adu illi baratte, idu illinda alliga. Now you will be able to place it much. Chalo, let's start with next question. Question number 10. See what's happening here. General reserve 10,000 and 5,000 is there, no? Here on the date of acquisition, general reserve is 6,000. Okay, post will become 4. P&L account. P&L account is 5,000, no closing date. On the opening date, it is 6. Amele, you did loss. Business you made loss of 1,000. 6,000 was the profit and loss account balance at the beginning of the year. End of the year, it became 5. Do you want to solve this? Solve this. 2 minutes. I've done 10. Sir, I've done 9. I'm asking you to do 10th one. Don't copy the balance sheet. Only do the answer. Little bit of writing. Stop the recording. People in the class were solving it. For the people who did it from home, this is the answer for concept capsule number 10. 10, the question is here. The answer is here. You can pause and check if you want, and I'll also show the reserve analysis. That's it. Doubt. No doubts. Which part? Minus 1,000 here. See, reserves is 5,000 on the balance sheet. In that, on the date of acquisition, it is 6. From 6, how did it become 5? Minus 1. That is, during the year, there is loss of 1,000. So this becomes our post acquisition. 5 minus 6. Then simple. 6, 6, 12. 12,000 pre acquisition. Post acquisition 4 minus 1. That will become 3. Okay. Now then you split that 88-20 ratio. If you do it in 80-20 ratio, 9,600. 4,000. 4,000 post acquisition minus 1. 4,000 plus minus 1. Plus minus minus 4,000 minus 1. I hope that was the only doubt. Ratio stay further. Why would we treat 9,600? 2,000 not required. Shall we go to 11th one? 11th one, bonus issue. Bonus issue. Interesting. Have a look. And bonus issue, if it is made by holding company, it doesn't affect much. It is interesting when bonus issue is made by subsidiary company. And if that subsidiary company's bonus issue is already accounted, then we don't have anything to do. If they have not accounted, they'll tell after the balance sheet date, now they're making bonus issue, asking us to do the accounting entry. Then it becomes, okay, what do we do? Bonus issue madadaga. Capitalization of reserves of subsidiary. Subsidiaries reserves will decrease. Holding subsidiary share capital will increase. We'll take money from this reserves, 52 share capital. So, should we deduct it from pre-acquisition reserves? Reserves they will be deducted, or post-acquisition reserves. Order of B bonus issue. First CRR. CRR will be pre. Then it will be security premium. If it is post, can be post. We don't know. So it depends upon the reserve order. CRR, security premium, capital reserve, general reserve, and then P&L. Usually it will be from pre-acquisition reserves. You deduct it. Are you getting it? And then pre-post normal analysis. Then it will get added to capital. What do we do? Capital just here. That bonus issue is there, no? That should also be shared between holding and minority. Why? Holding also will get bonus shares. Minority also will get bonus shares. What do we do with holding share of bonus? Cost of investment minus or plus? I'll tell something. You should not adjust cost. You should not adjust cost. Why? Accounting standard 13. Accounting standard 13. What does it do? Whenever there is bonus shares, does it affect amount column? It should increase nominal value column. So now bonus issue should be added to liability nominal value of investments. We'll add it to liability. We write no cost of control, nominal value of investment, book value of investment. Pre-acquisition reserves we deduct from book value. Bonus issue we add it to nominal value. Nominal value will increase. What about subsidiary? Sorry, what about minority? Take it to minority table, add it and put it to balance sheet. I hope you understood. I showed you some story now. We'll see the story. Let's start. Equity share capital, 1 lakh. Where would this go? Balance sheet. Balance sheet. Then equity of subsidiary. What do we do? Split. Outside we'll keep it and then split it. Split it between holding and minority. How much? Then reserves of subsidiary. Sorry, reserves of holding 20. This will write like that only in the balance sheet. Don't change it. General reserve 20,000. General reserve. Okay. Subsidiaries general reserve 20, subsidiaries P&L account 5 should be split as pre, post, holding, minority, adjustment for bonus, everything. So we'll write it outside. I'll write it outside as what to say general reserve 20, profit and loss 5. We don't know pre, post. We'll just write and wait. Okay. I'll write reserves. General reserve 20, P&L. Do we know how much pre, how much post? Not right now. When do we get to know? After balance sheet in the adjustment. Yeah? Next item. What's after this? Assets. PPE 70, PPE 75. 70 and 75. Shall I add them and write? 145. Next, when we do questions, we'll do it based on revaluation of. But then I will not give you adjustment of separate questions. 70 and 75, 145. Understood this? Amele. Investment in subsidiary, 4,000 shares, 50,000 rupees. 4,000 shares, 50,000 rupees. First concentrate on 4,000 shares. First concentrate on here equity share capital of subsidiary done outside. I'll split. Holding 4,000 shares, 40,000 rupees, 80%. Subsidiary 1,000 shares, 10,000 rupees, 10%. This 40,000 where do I write? Cost of control, nominal value of investment, inner column 40. Why inner column? Bonus issue to be adjusted. Then what do we do with this? Minority is 10,000. Minority interest, share capital 10,000. Done. Come back. 50,000 rupees is book value of asset. I'll write in cost of control. Is something. Book value of investments, cost of control 50,000. Then balance sheet is over. Shall we go to adjustments? First one, general reserve and P&L account. Pre-acquisition is how much? 15 and 1. 15 and I will write in reserves and surplus. Pre-acquisition 15. Post-acquisition 5 agate. And this one, pre-acquisition 1. So post will be 4. 5 minus 1. Here 20 minus 15. Understood this? Any doubt? Previously, we used to take this 15 and 1 and write it in resource allocation. Now we don't do that. Why? There is some adjustment. What is the next adjustment? Subsidiary company announced bonus issue of 1 share for every 5 shares. 1 share for every. So, listen to me carefully. Bonus. Bonus. Shares held, if it is 5, bonus will be 1. What is share capital of subsidiary? Have a look at share capital of subsidiary. How much is their share capital? 5,000 shares. How many shares? Now, if their shares is 5,000, how many shares will be given as bonus? 1,000. How? 5,000 into 1 divided by 5. 1,000 shares will be given as. What is the value of each share? Nominal value 10. So bonus shares is 1,000. Nominal value per share is 10. Can I say reserves required is 10,000? From where do we take reserves? We'll start with CRR. Is there CRR? Next, security premium. Is there security premium? Next, capital reserve. Is there capital reserve? Next, general reserve. Is there general reserve? Yes. And is there 10,000 in general reserve? Yes. So shall I take 10,000 from general reserve? Yes or no? So 15,000 general reserve. I took 10,000. I took 10,000. This 10,000 will become my bonus issue. 10,000 is 1,000 shares of rupees 10 each. This should belong to holding and minority. Holding and tell me how much will holding get? 80%. Sir, 80. Here we did no. That is the reason we compute here 80-20 percentage. Got it? Now come on here. Holding will get 80%. That is 800 shares, 8,000 rupees. Think and tell me. I've already told you. What do we do with this 8,000 rupees? Cost of control. Very good. What do we do in cost of control? Add to what? Nominal value of investments. We add it to nominal value of investments. Here in cost of control, we have nominal value of investments 40,000. Correct? To this, I'll add bonus issue 8,000. How much will it become? 48,000 liability. Then what do we do with minorities 20%? That is 2,000. Add to minority interest. Minority interest is here. Bonus issue 2,000. So bonus issue is over. Anything else left in the question? No, everything is over. Reserve analysis, distribution of reserves, cost of control computation, posting to balance sheet. Will do. Reserve. How much is pre? 5 and 1000. Correct? Ah? Totally 6000. 6000 pre-acquisition. What about post? 5000, 4000. Together 9000 post. Holding will get 80%. 80% of 6000. 4800. What do we do? Adjust it from cost of. Very good. Cost of investments. Pre-acquisition reserves 4800. I'll adjust. 50 minus 4800. 45,200. Got it? What do we do with post acquisition? 7,200. Balance sheet. I'll write revenue reserve 7,000. Minority 1,200 and 1,800. Write in minority interest. 1,200, 1,000. Take the total of minority. 15,000. 15,000 will write here. Illi. Liability 48,000. Assets 45,200. What is more? Liability. Of how much? 2,800 liability capital. I'll write capital reserve of 2,800. Check 20,000 plus 2,800 plus 7,200. 30,000. 130 plus 15, 145. And it is 145 anta. Sir, no sir, 130. Time alla. Balance sheet total. 145. Okay? Idan doubt idya? Sarana? Saran doubt idya? Sir, inna artha ಮಾಡಿ. Then also has to call Chetan. Sorry for now, sorry for then, sorry for future. Let us go to next concept. Hey, anything that you got stuck here? You understood? Observe the reserve part. You do pre-post first. From pre, you eliminate bonus issues reserve. Whatever is there will be taken to analysis of reserves. You should do everything in one table. Now you split it into multiple tables. Usually, ICS statement, they do it all in one table. One table inner column they do, and then outer column, and then they split. That's how it is in the middle. Yeah, I used to find it very difficult to understand from this. So then I made for my understanding, but unfortunately, I never wrote consolidation in my exam. Because when I wrote IPCC, consolidation was not there. When I wrote final, I didn't understand consolidation. I should teach step 1, step 2, step 3, step 4 approach. Ooh. I did not understand. So I used to do amalgamation. A consolidation or amalgamation. Once I read, first time I read, the day before the exam, I could not revise. It went over my head the day before exam. Then I stopped. Then I cleared writing only amalgamation. Next example. Pakka next example. Let's go to next one. Dividend. Dividend. Who's declaring dividend? Subsidiary. If hold, doubt. Subsidiary is declaring dividend. If holding declares dividend, no problem. Deduct cash, deduct reserve. Khatam. Subsidiary declares dividend, you know what will happen? Holding company, what should they do? Holding company, what should they do? That dividend received is received in cash. You cannot write cash account debit to dividend income to P&L. The reason is such dividend what we receive can be from pre-acquisition profits. If such dividend received is from pre-acquisition profits, such dividend should be adjusted against the cost of investment. If it is from post-acquisition profit, it should be taken to P&L. Got it? When they give dividend here, we need to check whether they've declared dividend but they've not written entry. They want us to write journal entry, or they've declared a dividend, they have paid a dividend, they have accounted a dividend, and the holding company has taken it wrongly to P&L. So are they asking us to do updation of books of accounts for dividend, or are they asking us to do rectification of wrong treatment of dividend in the books of holding company? The question. If they've already paid dividend, if they've already written entries for it, and the holding company has wrongly included in P&L instead of treating it as reduction in cost, then we'll deduct from profit of holding, deduct it from cost of investment in the balance sheet, assets. That's it. Minority, no adjustment. Cash, no adjustment. Nothing adjustment. If in case we have to pass journal entries, reserves of subsidiary, which is free, has to be reduced. Cash balance of subsidiary has to be reduced to the same extent. Cash balance of holding should be increased to the extent holding receives cash. And so to the same extent, we decrease the cost of investments. Minority interest will never get affected. Why? We give them cash. They take cash and they go. So we don't have to add it to minority interest. However, if it is declared but not paid, then we would have to add it to minority. We would have to adjust it with cost of investment. But however, that used to be done previously under limited what is say revision that is made in accounting standard 4, events occurring after balance sheet date. Dividend is not an adjusting event. Remember, adjusting event, not adjusting. Dividend is not an adjusting event. Dividend should be recorded only when it is declared, not when it is proposed, because the shareholders have a right to either accept it at the same rate or accept it at discounted or deny the dividend. So proposed dividend we should not adjust. So proposed dividend either ignore ಮಾಡಿ, or you write it in the consolidated balance sheet also as a liability proposed. So let's see it here. Equity and liabilities, 10,000 shares of rupees 10 each, 1 lakh. Where do we write? Balance sheet, 10,000 shares of rupees 10 each, 1. Then subsidiaries, 5,000 shares of rupees 10 each, 50,000. What do I do? Outside the balance sheet, I will split holding and minority. How much holding, how much minority? Gottilla. We'll get to know later. Reserves, 10,000, 5,000. What do? We should write and then split. Right now we don't know split. We'll write it outside the balance sheet as reserves. How much general reserve? How much P&L account? Write so much and P. What's after that? 10 and 5. PPE, PPE 50, PPE is 65. 50 plus 65. 50 plus 65, 1,15,000. I will write in my balance sheet asset side PPE 50 plus 65, 1,50,000. Done. After that 50 plus 65, 1,15,000. What do we have? Investment in subsidiary 50,000. That is 4,000 shares. How many shares? So what do we do with 4,000 shares? 4,000 shares here we split. No, holding 4,000 shares. Correct. 4,000 shares is 40,000 rupees. 40,000 rupees will become nominal value of investments. Here, nominal value of investments. 40,000. Okay. Then minority will be 1,000 shares. 10%. Sorry, 20%. This I'll write in minority interest. Share capital. Understood this? What is after this? Then on the date of acquisition, general reserve and P&L 6 and 4. I'll write in analysis of reserves. Pre is 6 and then post will be here. Pre is 4, so post will be one last adjustment. Subsidiary declared dividend of how much? 10%. How much is their share capital? Subsidiaries 50,000. Declaration of dividend at 10%. How much is 50,000 into 10%? 5. So 5,000. Let us write here 5,000 rupees. Anybody 5,000? Dividend. We'll deduct it from reserves. 5,000. We'll deduct it from reserves. 5,000. Got this? This dividend of 5,000 is pre-acquisition dividend. Why? It is given out of pre-acquisition profit. It is given out of pre-acquisition profit. Share it between holding and minority. How much will holding it? 80%. That is how much? 4,000. That is how much? 4,000. This 4,000. What do? We should adjust it against the cost of investments. Shall we deduct it from cost of investments? How much is my book value of investments? 50 plus pre-acquisition dividend. What do we do with minority? 1,000. We are assuming that this is not proposed, declared, due to be paid, not paid. If we assume to be paid, we'll deduct it from cash. We are assuming that it is due to be paid. So this 1,000, what do I do? 1,000 I'll write here, minority dividend 1,000. Done. Question ಏನಾದರೂ ಬಾಕಿ ಇದೆಯಾ? Question over. Now come on, let's finish reserves. So how much is pre-reserves? 1,000, 4,000. Together 5,000. Post 4,000, 1,000. 5,000. Share it between holding and minority 80-20. How much 80? 4,000. 4,000 will be deducted from cost of investments. I'll do here pre-acquisition reserve 4,000. Pre-acquisition profit. Then what about this holdings 4,000? Post balance sheet. Balance sheet revenue reserve. Minority 1,000 and 1,000. Where do? Minority interest. Capital reserve 1,000. Revenue reserve 1,000. Done. Ta-da, that's it. Come on. We will close this. This is over. This is over. This is over. Illi. Goodwill continue. Liability 40,000. Asset 50 minus 8, 42,000 asset. Asset is more or liability is more? How much? 2,000. We'll write in the balance sheet asset side goodwill 2,000. And here minority interest is 13. Right? Minority interest 13 in the balance sheet. Now take the 1 lakh plus 4,000 plus 13,000. 1 lakh 4 plus 13, 1 lakh 17. Liability side, sorry, asset side 115 asset plus 2 goodwill, 1 lakh 17. Done. Pakka. Any doubts? What if dividend is already declared and paid? And they mention in the question, dividend received from subsidiary is taken in P&L account by holding. If they give question like that, what do you do? Deduct from P&L of holding, deduct from cost of holding. That's it. Minority will not get adjusted. Reserves of subsidiary will not get adjusted. Why? If they tell that dividend declared and paid, subsidiaries reserves is already deducted, cash is already deducted, minority has already received, holding is already received and included in cash. There they are asking us to only do rectification in such question. Getting it? Such question also can come. There you would have to only eliminate from reserves of subsidiary, reserves of holding, and eliminate from cost of. Did you understand the concept? That is much simpler. Here you don't have to do updation, only rectification. Can I go to next one, or should we take break? Next one, we are doing example number 12, concept capsule number 12. I think we have till 20. We have till 19. I don't mind. I can take. Asking you. Ball is in your court. We'll finish. We'll take much more time to finish. We'll take about 30 minutes at least. If you want to do all concept number 13 to 19. Or if you want me to do little fast, you say, sir, we'll sit for another 20 minutes, sir. You please finish it and then we'll take break. We'll do it. Okay? Yes? Because I don't want you to compromise. You will say, sir, I was hungry, sir, so I didn't observe revaluation of asset. I don't want you to tell that later. Okay? Shall I do? Good. Nice. PPE was revalued by 75,000. Same to same like previous one. What's happening now? Asset is now revalued. Asset is now revalued. We'll start. First one. Our capital is our capital. 1 lakh. Where do we write our capital? Consolidated balance sheet. I'll write share capital. Then subsidiary share capital is how much? 50,000. Where do we write this? Outside the balance sheet, I'll write subsidiary share capital 50,000. That is 5,000 shares of rupees 10 each 50. We have not split this yet. We'll do it later. After that, reserves and surplus of subsidiary 10,000. I'll write reserves and surplus of subsidiary 10,000. Do we know the split? No, we don't. What is after that? PPE 50 of holding. Subsidiary right now is 60, but there is adjustment. So I'll write 50 plus 62. 50 I'll write. 62 I don't write. I'll just keep this on hold. Shall I keep it on hold? Or I should write 50, 62 in the inner column and then add revaluation. We'll do it later. Then investment in subsidiary. How much? 4,000 shares. So in the subsidiary shares of 5,000, 4,000 is holding, that is 40,000. 40,000 I'll write in cost of control, nominal value of investments 40,000. Minority will be 10,000. This I'll write in minority interest share capital. Done. Next, what do we have after that? 50,000 is book value. I'll write in cost of control, book value of investments 50. Done. What's after that? On the date of acquisition, reserves was 2. On the date of acquisition, how much was reserve? So we'll split our reserves. Pre-acquisition is 2. Post-acquisition will be 8. Done. Amele, what else is there in the question? Last one. PPE was revalued to 75,000. So here we have 50. Here we have 60. This 60 should be taken as 75. So in the balance sheet, it will be 50 plus 75, 1,25,000. But what is the actual value? 60. What is the value at which you're taking? 75. So how much are we increasing? As per accounting standard and property, plant and equipment, when we revalue the asset upwards, what do we do? Asset account debit to revaluation reserve. Asset account debit to. So PP is 60, revalue to 70, add asset 15,000, add revaluation reserve 15,000. So now we have revaluation reserve 15,000. Sorry. Now we have revaluation reserve 15,000. Remember, revaluation is done on consolidation, but this is adjustment to the values, that is excess depreciation that is charged in the previous period. So now tell me, this revaluation reserve is pre or post? Always pre. Revaluation reserve is always, so I'll write pre-acquisition 15,000. Now tell me, what is the total pre-acquisition profits? 2,000 year, 15,000 year, totally 17,000. 8,000 year, 0 year, totally 8,000. Got it? Now we have 17 and 8 holding minority 80 and 20%. How much is 80%? 13,600. What do we do with 13,600? Deduct it from the cost of investment. What about holdings post acquisition 6,400? You go to balance sheet, revenue reserve 6. Then what do we have after that? Minority 3,400, 1,600. We'll write in minority interest 3,400. Everything's done. Minority interest 15. And then here our okay, 50 minus 13,600 is 36,400. Which is more? Liability is more, 3,600. That will be balance sheet, reserves and surplus, capital. Check total 113, 119, 124, 134. Sorry. 119 plus 109 plus 15, 124. 124, 600 plus 400, 125. Valid. Understood? Now we did upward revaluation. We did what? We increased the value of the PPE from 60 to 75. So we did plus 50. We did plus 50. Next one going to be minus. PP is how much? 60. PP should be revalued to 55. From 60, we are bringing it down to 55. If you bring it down to 55, you know what will happen? Revaluation reserve will be minus 5. Revaluation reserve will be that minus 5 pre-post we should do. How much is pre? Minus 5. Minus 5 post 0. Got it? Do this. Let's see. Should I just show answer or solve it? It tallies at 1,12,600. It will tally at 1,12,000. It tally at 1,12,600. Got it? You got it. Reserves. You would want to see. Jag. Udar. Remember. We'll do revaluation of asset with depreciation. Easy. Revaluation of the asset with depreciation. Same question. One adjustment is the value of the asset is 54. Asset is to be revalued to 75,000 and depreciation should be provided at 10%. Depreciation should be provided at, okay, now 54 worth of assets will become 75,000. 54 worth of asset will become, so you take so much, you add so much to PPE, you take so much to revaluation reserve. Revaluation reserve will be pre total, holding minority, holding part decrease in cost, and then holdings post acquisition balance sheet. Minorities pre-post together in minority interest. That much we know. Rest everything is simple. Tell me, what do we do with depreciation of 10%? Postally minus part. How much? Tell me how much. I have put the numbers. 21,000 into 10%. Little 54,000 is after charging depreciation already. Some people say we'll charge depreciation on 75,000. Should not charge on 75. The reason is 54,000 is after charging depreciation. Got it? So the value of the asset was 60. We have charged a 10% depreciation, brought it down to 54. If the value of the asset is 75, we should charge depreciation on 75. That is 75,000, sorry, 7,500. But in that, on 60,000, already 6,000 depreciation is charged. Only on that additional increase 15,000, you should charge 10%. That is 1,500 rupees depreciation only. You get it? You get it? Again, how much is depreciation in this case? 1,500. Sir, how, sir? Very simple. What is the value of PPE? Before. They're telling it to revalue, it to be revalued to what rate? 75. 54 is not becoming 75. 54 is after depreciation. Before 54 before depreciation will be 60. 60 is becoming 75. 54 is not becoming 75. 54 is not becoming 75. 60 would have become 75. If you do 54 minus 75 and then do, in the balance sheet, you should write 75,000 and then deduct 7,500 and then write. Whoever used to do 54 minus 75 and then that much used to charge depreciation, in the balance sheet used to write 75,000 minus 10%. So the way you present in balance sheet, the way you do in adjustment in pre-acquisition, post-acquisition reserve was not matching. For that moment you would get happiness, but later when you see correct to depreciation. The logic is 54,000 is 90%, that is after charging 10% depreciation. Before 10% depreciation PP was 60. 60 is now becoming 75. Increase is 15,000. On that 15,000 you should charge depreciation. How much is 10% depreciation on 15,000? 1,500. 54,000 minus 1,500. What do we get? 52,500. 52,000 or other way. 75,000, no revalued figure, into 10%. How much? 7,500. 7,500 total depreciation will not deduct from profit because already 6,000 depreciation was charged. You only charge 1,500 to what? Post acquisition profit. Post we don't know. Post is there, from there we deduct. Sir, why post? See, revaluation pre means after revaluation we charge depreciation, that will be post. If it is, this is what? Downward. Sorry, upward. Then downward revaluation if we do, ulta. That depreciation is there, no? We will not deduct it, we will add. Should I show the entire answer? Should I solve point to point or just show the answer? So 54, you understood, no? 54 is after depreciation of 10% from 60. So 54,000 is 90%. 100% was 60. Now that 60 is getting revalued to 75. In balance sheet, I will do 75 minus 10%. And in what to say, in reserves adjustment, what do I do? 60 and 75 difference. 15,000 will 10% depreciation. 1,500 should be adjusted. Shall we see it? Observe it. In the balance sheet, I'll write 75,000 minus 7,500 depreciation. In our table for adjustment, depreciation will be 1,000. How? Book value is 60. Already depreciation charged 6. So it is 54. Revised depreciation 7,500. So to be charged depreciation is 1,000. Done? And this 1,500 is deducted, no, here. Understood? Once then we'll get capital reserve, revenue reserve, same holding, subsidiary holding, holding minority split, minority interest and the cost of control company. For the other party, for the next question, here look at this. What is PPE? 54. PPE after 10% depreciation. So before depreciation is 60. It is revalued to 55. So there is downward revaluation of. That downward revaluation in revaluation reserve, it will be negative. And we have charged depreciation on 60, that is 6,000. We should have charged depreciation on 5,500. Sorry, 55,000, that is 5,500. We charged 500 depreciation extra. That 500 depreciation will be added back in post acquisition. Here, depreciation 500 I'll add. And in the balance sheet, I'll take 55,000 minus 10. Understood? And that, what to say, revaluation reserve, that will be minus 5. Completely free. Done? Sir, over? No, I think still we have 3. One is mutual indebtedness, then unrealized profit, then debenture. Now only or later. Tell something. Now, 10 minutes. Mutual indebtedness. What do you mean mutual indebtedness? One company owes money to the other. Holding goes to subsidiary or subsidiary owes to holding. Why? Because of debtor-creditor relationship or bills payable, bills receivable that is there with them. Individually, no problem. In the consolidated balance sheet, eliminate from bills receivable as well as bills payable, or eliminate from debtors as well as creditors. Easy. Mutual indebtedness is not problem. Unrealized profit is interesting. Mutual indebtedness is not difficult. Mutual indebtedness is easy. We deduct from asset and liability. Unrealized profit is interesting. What will happen in unrealized profit? One has sold the goods to other, and one of them has booked profit. One of them is showing the cost stock at higher value. If the stock is sold, no problem on unrealized profit. Unrealized means holding has sold goods to subsidiary and subsidiary has not sold to outsider, or subsidiary has sold goods to holding and holding has not completely sold it to outside. The stock is still there. The stock is gone out, no problem. No problem. The problem is only when stock is still there. So in the consolidated balance sheet, stock will be at higher value. Stock will be at profit will also be booked in the same books. Should eliminate profit, we should eliminate stock. Should eliminate profit, we should eliminate. From whose stock should we eliminate? Whose profit should we eliminate is what we're trying to discuss. Whose profit and whose stock? How do we get to know? Depends upon who has sold goods to whom. We call it downstream, upstream. These are the words that is used in the material. We can tell the same thing. Downstream means holding has sold goods to subsidiary. Downstream means holding has sold goods to. So who has closing stock? Subsidiary. Who has book profit? Holding. From whose stock should I reduce? Subsidiaries stock. I should reduce this. A lot of them, what they do, know, they take holding stock, subsidiary stock total, and total say they reduce. Don't do that. You should show the disclosure from whose stock are you eliminating unrealized profit. So take subsidiary stock, eliminate that unrealized profit, and then take it out. Holdings profit is there, no, in reserves and surplus balance sheet. From there we eliminate that unrealized. Got it? They will say goods costing 10,000 rupees were sold, of which only 20% is still remaining unsold. So adjustment should be only for 20%. 10,000 into 20%, 2,000. On that profit margin, that should be adjusted. Got it? This is easy. By downstream, from whose reserves are we adjusting? From whose stock are we adjusting? Now upstream, subsidiary has sold goods to holding. Subsidiary has sold goods to. In whose closing stock should we do adjustment? Holding. In whose closing stock should we do adjustment? In whose profit should we do adjustment? Now subsidiary profits ಏನೇನೋ ಆಗುತ್ತೆ pre post holding minor. From where do we deduct? Pre. From where do we deduct? Pre. Pre-acquisition profits of subsidiary. From that we eliminate and then we do the stock. Got it? Then last adjustment. Debentures. As a last adjustment. What do you mean by debentures? Debentures is acknowledgement of debt that is there for subsidiary. Such acknowledgement of debt of subsidiary can be held by holding. Can be held by, if it is held by holding, like how we do share capital, we write share capital and then do holding minority, holding share, we take cost of control, nominal value, book value, difference, goodwill or capital reserve. Same to same. Debentures of subsidiary, holding, not minority, others. Not minority. Okay, control illa adರಲ್ಲಿ. Not controlling interest, not controlling interest. It is others. Debentures of subsidiary, holding, others. Holding portion, whatever is it, nominal value you get, right, below cost of control, only right, nominal value of debentures. In the holdings balance sheet, book value will be there 12,000, right, book value 12,000. Book value asset 12, nominal value 10, liability. Which is more? Asset is more, 2,000 goodwill. This goodwill 2,000, that cost of control, whatever goodwill or capital, so together you write it to balance sheet. What if book value is less and nominal value is more? Capital reserve. This capital reserve, that share adjustment में capital reserve or goodwill, what you get together you post it to balance sheet. I'll show. So you understood now how to treat that. See, debentures of subsidiary split like this. 1 lakh. Here we do cost of control for shares. Do cost of control for debenture also. I'm going to say include in the same thing. Here we got, for debentures we got 10,000 rupees capital reserve. For shares we got goodwill 8,400. Which is higher? Liability, take net capital reserve 1,600 to balance sheet reserve. And this subsidiaries, whatever, this other debentures, whatever we have 2,000, 20,000, 2,000 debentures, write it to balance sheet liability side 20,000. Ashte country. Yeah. And when we do consolidation, please check whether both the balance sheets are on the same date. If both the balance sheets are not on the same date, you need to update the balance sheet and then do it. You need to update the balance sheet and then one more trick is whenever they give reserves and surplus, sometimes the acquisition need not have happened on the beginning date. Year end is 31st December. Date of acquisition is 1st of January. ಯಾರು ಹೇಳಿದ್ದು ಫಸ್ಟ್ ಆಫ್ ಜಾನ್ವರಿನೇ ಅಕ್ವೈರ್ ಮಾಡಬೇಕು? ಯು ಕುಡ್ ಹ್ಯಾವ್ ಅಕ್ವೈರ್ಡ್ ಆನ್ 15th of April, 15th of May, 23rd of March. You can acquire on any other day. Then what should you do? Let's say you acquired in the middle of the year. They've given entire year's profit and beginning of the year's profit. Beginning of the year's profit is pre. Profit earned during the year has to be split based on months. Month till date of acquisition is pre, after date of acquisition is post. That is one more trick that can be asked. And that's it. You don't have anything else in consolidation of balance sheet. Consolidation of balance sheet, about 23, 24 questions, the solution is there. This what we did is now is concept capsules. After this full-fledged problems like the ones that's there in ICA study material, that questions also we can solve it the exact same way. But the point is there we write balance sheet and notes to accounts also. After that notes to accounts, our any question in the ICA study material what you show, we can do the answer same way how we did now. See this, this, and then this. Possible or not? Any question. You tell the question, we can do the answer the same way with notes to accounts. Here we added and straight away wrote no balance sheet. In the exam, when you're doing consolidation question, you should also prepare notes to accounts. You should also prepare the consolidation of PL now only or later. Let me finish it off. Consolidation of profit and loss account. Holding and subsidiaries profit and loss account should be brought together and then written together. What can happen is holding company is controlling the subsidiary company. Holding company should take decisions on behalf of the subsidiary company. Holding company will take board meetings to take decisions for subsidiary company. So holding company is incurring a lot of money to manage subsidiary company. So holding company will charge management fee. Holding company will charge management fee to subsidiary company, and subsidiary company will pay it. Whenever subsidiary company will pay management fee, for subsidiary company it will be other expense. For holding company it will be other income. Separate P&L accounts, or expense, your income, okay. Consolidated P&L account, eliminated from other expense, eliminated from other income. Got it? Second one, holding subsidiary might have buyer-seller relationship. Holding might have sold goods, subsidiary might have purchased goods. For holding, because it is sale, it will be there in revenue from operations. For subsidiary, because it is purchase, it will be there in purchase of shit, purchase of stock in trade you have. When they are separate, holding a sale, subsidiary a purchase, okay. When they are one, it cannot be. So what do we do? From the holdings, revenue from operations, from the subsidiaries, purchase of stock and trade, we eliminate. Sir, can't it be ulta? Yes. Subsidiary could have sold goods to holding. Then eliminate from subsidiaries revenue from operations and holdings purchase of stock and trade. Whenever there is unrealized, whenever there is this mutual indebtedness and goods sold by one to other, check if all the goods are sold. If all the goods are sold, no problem. If certain parts of goods are not sold, on that profit is booked by the other person. So what do? We eliminate it from the profit when we eliminate it from the stock. We just discussed. Stock when we deduct, no. Closing stock will reduce. The closing stock will reduce. In the statement of profit or loss, changes in inventory we do know. There will be reduction. Changes in inventory only reduction. Closing stock value will reduce. Changes in inventory is found as opening stock minus closing stock. When closing stock reduces, that changes in inventory value will further decrease. We should not forget but adjust it. Then whenever interest is to be given by holding to subsidiary for debentures, for subsidiary it will be what to say borrowing cost, that expense, interest expense. For holding it will be other income. Should eliminate it from both places. Same with regard to dividend. I think that's it. There will be no other adjustments for statement of profit. Cash flow consolidation is the easiest thing. For one there will be outflow, for the other there will be inflow. Outflow, inflow. Got it? That's the easiest one. But I think the rest of it you will be able to handle. I hope we were able to do decent justice to the topic of consolidation. Yes, we were supposed to do banking and NBFC before break. Shall we start with banking companies? We'll take break. Yes, sir. I want you to tell. No, sir. I want you to tell. We'll take break. But you people are making me tell. Oh, we did consolidation for. Okay. Started only at what time? 12:15, I guess. 12:20. Huh? 2:20. And 22 hours. Hey, but 2 hours may we covered almost every adjustment. We didn't leave anything. This part of consolidation we didn't discuss anta illa. Correct or not? Yeah. When you come to CA finally, consolidation will become more beautiful. No, we can follow the same approach what we did. I'll tell you how will it become beautiful. Now we have one holding company, one subsidiary company. Then there will be holding company, holds subsidiary company. Subsidiary company holds one more subsidiary company. Chain holding ಅಂತ ಹೇಳ್ತೀವಿ. I am holding you, you are holding them. That chain holding will become interesting and become triangle holding. You know how? A, B, C. A holds 60% of B. A holds 40% of C. And B holds 40% of C. So A directly C is not subsidiary. A along with the shares in B, C is its subsidiary. And in this, C will hold 10% of B. Sometimes before they become holding subsidiary relationship, C will hold some 5% of A also. Are you getting it? That will be triangle holding and chain holding. So you can follow the same approach what we followed now there also. There again people do step 1, step 2, step 3, table antara vichitra ಮಾಡ್ತಾರೆ ಒಂಥರ chart type. But with this that will also become much simpler. You would have to just to accommodate that extra entries into this. And connection ಎಲ್ಲಿಂದ ಎಲ್ಲಿ ಮತ್ತೆ connect ಆಗುತ್ತೆ. It will become much simpler. And if you have not done consolidation at inter, people skip consolidation at final also. And what if in the future you get to do practical? You cannot say no, I skipped this chapter in foundation, I skipped this chapter in inter because change of syllabus, then I had to skip the chapter in final, sorry I can't do it. Then it's matter of money. Got it? Okay, so let's take lunch break. It is 2:15. Shall we meet at 3 p.m? So 3 p.m. onwards we will do banking NBFC. Then I think internal reconstruction we can take little light. Then we'll do buyback ESOP super quick. Okay, we'll do banking NBFC, then liquidation, buyback ESOP. ಮುಗ್ಸೋಣ 5:05 ಅಷ್ಟರಲ್ಲಿ. Got it? Yeah, let's take a break. See you all at 3 o'clock. Good afternoon, everyone. Welcome back to CA Intermediate Advanced Accounting Marathon Revision. Pre-break, we are so far done with the topics of amalgamation of companies, partnership, and consolidation of companies. Agenda is pretty simple. It's 3:15. We'll try to finish banking NBFC. Then we'll do liquidation, ESOP, and buyback. Very aggressive targets. Let's chase them. Let's start with financial statements of company. This was one among 3 chapters what was there, which was accounting for or preparation of financial statements of special purpose companies, banking, insurance, and electricity companies. Back in the time when we used to study CA IPCs. Then electricity companies got removed. Then banking and insurance was there. Then insurance got removed. This was the last one left from their family, and this is the last time this chapter will be taught. And after this, this chapter is removed from the intermediate. So come on, let's try and do the chapter of financial statements of banking company for last time. I have great experience of teaching this chapter because this is the most boring chapter and people used to not like teaching this chapter. There are several batches where I have taught only this chapter. All the other nice interesting chapters others used to teach. I used to go teach banking, not to forget, NBFC. Previously there used to be one more called mutual fund. Banking, NBFC, mutual fund. Banking, NBFC, mutual fund. Rajavardhan teaches advanced accounting. Nice. What chapters? Banking, NBFC, mutual fund. So I've got to see this chapter end to end in detail, how to make it interesting, how to cover to the core RBI guidelines and everything, and then teach it. So you will have fun doing this chapter. Now, what to expect from this chapter? There are several type of questions that you can come across from this chapter. I will do this chapter in a very weird way than how it is there in the ICS study material. My order is different, and this order I've got after a lot of experience in teaching this. So the order is first one will start with classification of banking advances into performing, non-performing, standard, substandard, doubtful, within the doubtful subcategories and loss asset. And after that, we need to try and understand how to recognize income against these bank advances. Then we'll try to learn what is ECGC cover, DICGC cover, and all of this with provisionings. And then we'll understand how to record for bills of exchange based services, which is given by a banker to an account holder. You would have seen this bills of exchange chapter in CA Foundation from the perspective of drawer and drawee. We don't see there from the perspective of the banker. Here we'll learn the same chapter from the perspective of the banker. And after this, we'll learn how to prepare financial statements for a banking company. Finally, at the end, we need to learn ratios. How to identify, how to compute cash reserve ratio and statutory liquidity ratio, capital adequacy ratio, and why is it done, and the legal parts behind that provision. Let's get started with the first one. You say banking. What exactly do we mean by banking? Banking is an entity which is created under the law which borrows money from the public to lend it or invest. And this money has to be paid back to the deposit holders either at the end of a specific time or on demand by them. So this is the definition of banking. I am not making up this definition. This is the definition as per section 3B of banking, sorry, 5B of Banking Regulation Act 1949. What does it say? Accepting deposits of company from public for the purpose of lending or investing, which is to be repayable to them on demand or at the end of specific. Demand means the savings bank deposit, current account deposit. Whenever they ask, you need to give. Time-based deposits is at the end of a specific period. RD, once it matures, will give. FD, once it matures, will give. So either at the end of a specific time period or whenever they demand. Depends upon the type of deposit accepted by the definition. Won't come in the examination. Don't worry, you don't. Banking sector in the country is divided into classifications like this. So what is scheduled by RBI, what is not scheduled by RBI. So there is second schedule to RBI Act. The second schedule to RBI Act, if the name of the bank is written, it is called a scheduled bank. If the name of the bank is not there in the second schedule to RBI Act, it is not a scheduled bank. Scheduled bank will have different sets of rules and regulations what they need to follow. Unscheduled bank will have different sets of. Scheduled banks have to go through a lot of rules and regulations. So it is more trustworthy. You find it safe to keep money there. Non-scheduled banks, the regulations by RBI is little less, so the trust among the people on such banks is also little. Talking about scheduled banks, they can be further classified into commercial banks and cooperative banks. Commercial banks, nationalized, development, regional rural bank, foreign bank, and private sector bank. Cooperative banks, state cooperative and urban cooperative. Example for nationalized banks can be our SBI, Punjab National Bank, Canara Bank. Previously, I used to tell 16 examples. Now, after mega bank merger, I can tell 3, 4 only. You remember, no? Mega bank merger, they merged all the banks together to 3. You know what was the basis based on which the government decided which banks to merge with them? Now, Union Bank took over Andhra Bank, Corporation Bank, correct or no? So, did you know what is the basis based on which they decided which banks to merge with which bank? Government enforced. Okay, banks didn't decide to do it. Now, what is the basis? Accounting software used by the banks were similar, so they decided these 3 banks will merge. I am not kidding, but that's the basis. And you know what is the reason for mega bank merger? Too many banks, too many things to handle. So it is easy to regulate for the government if the number of banks involved are less. I am not kidding. Go search what was the reason behind mega bank merger, or how did they decide which bank to get merged with the other. I'm not kidding. People are not taking me serious. Are you taking me like a joke? It's serious, guys. Serious. Satya. Development banks will be IIBI, Industrial, what to say, Investment Bank of India, or our IDBI Bank or Unit Trust of India. These are examples of development bank. Examples of regional rural banks are our Karnataka Vikas Gramina Bank, Kaveri Gramina Bank. Seen, heard? No? Which one have you heard? Karnataka Vikas Gramina Bank. Here only it's there, one branch. That no, that A in the one Bharat. Chat shop. This road end, that side corner. Antique shop. Next to that antique shop, corner. Chat shop. Don't know chat shop on that side corner. A big Mr. Peda. I think diagonally opposite this Karnataka Vikas Gramina Bank, Jayanagar branch. Huh? No. I'm not asking you to open account there. Just telling you. And then foreign bank. Foreign bank, our DBS, CTA Bank, HSBC. All of these are examples. ANZ is Australia New Zealand Bank and Dosh Bank. All these are examples of foreign bank. And comes the interesting part, private sector. Why private sector banks are the interesting part? This entire chapter where you're learning no banking sector. You are learning how to do accounting for scheduled commercial private sector bank only. You are not learning how to do accounting for nationalized bank, development bank, regional rural bank, foreign bank. No. You're learning how to do accounting for scheduled commercial private sector bank only. So scheduled commercial private sector banks are Kotak Mahindra Bank, ICICI Bank, Yes Bank, Axis Bank, all of this. If in case you talk about state cooperative and then multi-state cooperative or urban cooperative bank, state cooperative bank is our Telangana State Cooperative Bank, Andhra State Cooperative Bank, or Tamil Nadu State Cooperative Bank, Karnataka State Cooperative Apex Bank. This is a very famous one. Too many branches. Not seen that also. Pretty. Okay, then multi-state cooperative banks is Bharat Cooperative Bank and our PMC Bank. These are the examples of multi-state cooperative banks or urban cooperative bank. But in this entire chapter, what are we discussing? We're discussing scheduled commercial private sector bank accounting. We're learning how to do accounting for scheduled commercial private sector bank, not anything. Got that? Now let's quickly start with classification of advances. Banking business means borrowing and lending. So bank has given money to someone as advance. What do we call it? Advance. These advances can be broadly classified into two categories. One, agricultural advance. Second one, non-agricultural advance. Advance given for agricultural purpose is called as agricultural advance. Advance given for other than agricultural purpose is called as non-agricultural. Bank has given advance to a farmer. This farmer can use this money for two purposes. Number one, to grow short duration crops. Or number two, to grow long duration crops. Now the question is, what is short duration crops? What is long duration crops? Any crop whose crop season is longer than a year is called as long duration crop. Any crop whose crop season is shorter than a year is called as short duration. Now, why do we classify and why should we know this agriculture and all in detail, sir? Are we doing BSc agriculture? No, we are not doing BSc agriculture. But to determine whether a particular advance is a performing or non-performing asset, the basis is not months for agricultural purpose loan. For advances given for agricultural purpose, the basis is decided based on the crop season. If the loan or advance is given by a bank to an agricultural person, farmer, for crop, and it is for long duration crop, if the interest is received on time, we call it performing asset. If the interest is not received, we will wait patiently for one crop season. For more than one crop season, if the interest is not received, then such an advance will be called as non-performing advance. If the interest is received, good. If the interest is outstanding for greater than one season, then what do we call it? Non-performing. Very good. However, for short duration crop, if it is outstanding for greater than 2 seasons, if it is outstanding for greater than, then we call it non-performing asset. You get it? So to be non-performing, if it is short duration, 2 seasons, if it is long duration, 1 season. Then let's talk about, this is agriculture. What about non-agricultural advance? Non-agricultural advance, if it is given to a businessman and this businessman pays the interest on time, all good. If the businessman doesn't pay interest on time, the businessman pays interest on time, performing asset. The businessman doesn't pay interest on time, then we wait for a period of 90 days for him to book ticket, find a flat, pack all his bags, leave the house and then go to London. It will take 90 days. We get visa also. So if beyond 90 days, if the interest is not paid, it will be regarded as non-performance. So how many days is given time? 90 days. 90 set agate chanagi. Tayalenu ide. No bird ide. Arrow ansate. Hey, no relevance to any person, whether alive or dead, or in India or in London, or taken loan from SBI or not, or owner of RCB or ex-owner of RCB. No relevance. So, if in case the interest is paid on time, good. If it is not paid, up to 90 days, still called performing. Beyond 90 days, we call it non-performing asset. You get this? So, you guys understood when do we call it performing and when do we call it non-performing. So what do you mean by bank advance? Here we use no the word classification of advances. What does bank advance include? Bank advances include various loans and advances given by the bank. It includes bank overdraft, bills discounted, term loans given, and everything. To name term loan, bank advances, sorry, bills discounted and purchase, cash credit, overdraft, all of these facilities given will be included in the word advance. Got this? Now, further classification of these advances. Advances can be classified into performing and non-performing. That is major classification. Performing assets are called standard assets. Non-performing assets are called as substandard, doubtful, and loss. And doubtful assets are further classified into 0 to 1, 1 to 3, and greater. Then, how do we consider? When do we get to know whether it is substandard? When do we get to know whether it is doubtful? I'll explain this to you with the help of a timeline. Let's see the journey of an advance from performing to losses. Shall we? Okay. To start with, whenever interest is received, it's called performing asset. or standard asset. Performing asset means standard asset. When you stop receiving interest, when you stop receiving interest, till for 90 days in the case of non-agricultural loan, for one crop season in the case of long duration crop, for two crop seasons in the case of short duration crops, it will be still considered as standard asset. It will be still considered as, did you understand this? If in case the interest is due or not received for more than 90 days in the case of commercial loan, or what we say non-agricultural loan, and in the case of agricultural loan, one crop season for long duration, two crop seasons for short duration, then it will become substandard asset. What will it become? It will remain as substandard asset for a period of 12 months. Remain as substandard asset for a period of, after 12 months of being substandard asset, then it will become doubtful asset. And it will become, for the first 1 year, it will be called as doubtful 0 to 1. For the first one, it's called as doubtful 0 to. For the next 2 years, it will be called as doubtful 1 to 3. After that, it will be called as doubtful greater than 3. Are you getting it? It has to go through all of this. From standard asset, straight away it will not become doubtful asset. From standard, it will straight away not become doubtful. From standard, it should become standard but outstanding. It should become substandard. It should become doubtful 0 to 1, doubtful 1 to 3, doubtful greater than 3. That is the order. And after this, there's one more thing called as loss asset. What is it called? What do you mean by loss asset? Loss asset means ashte, you won't get money. You won't get money. Loss asset. So when do we call a specific asset as loss asset? There is no time consideration. There is no time consideration. There is no condition that it has to become doubtful greater than 3 and then it should become loss asset. From being standard asset, straight away it can become loss asset. Or it can become standard, substandard, doubtful 0 to 1 and then loss asset. Possible. It can become doubtful 0 to 1, 1 to 3, doubtful greater than 3. It will not become loss asset. It can remain as doubtful greater than 3 for 10 years. It can. So when do we call it loss asset? Who decides? Who decides? RBI, bank, bank or RBI, bank or RBI, bank or RBI or auditors. Got it? So bank or RBI or auditors will regard it as bad debt. That is like our non-performing asset. Bank, auditor, concurrent auditor or statutory auditor or RBI. Either of them. If they say, then it should be regarded as a loss. Think it? Very good. Now, why did we classify these assets into performing, non-performing? Those two are performing, rest everything is non-performing. Why do we classify the advance? Asset is asset? No. If it is loss asset, then we should write off. We should not show it in the balance sheet. But otherwise, why do we classify? Provisioning is one. The one before provisioning is recognition of income. Recognition of, the way we recognize income is very different. Do you want me to do problems on this part? Idu classification mele? Classification mele? Yes or no? No, no, no. If you want to do, we have to do one set of question on this. So the next updated version of the presentation, I want to put question here only. ಇಲ್ಲ book full zoom ಮಾಡಿದ್ರೆ here only I wanted to put question and then answer, but very unfortunate. After got it. Okay, now recognition of income. So how do we recognize income? Usually income should be recognized on accrual basis when we earn it or when we receive it. However, that depends upon the nature of advance. If it is performing asset, time if we are receiving interest, then recognize it on accrual basis. When we earn it or when we receive it, whichever is earlier. However, if it is non-performing asset, if the person is not paying money, don't recognize when we earn, wait for receipt. Only and only if you receive income, we recognize it as income. If you don't receive, don't rate as income. Getting it? So performing assets, when do we recognize? When it is earned, not when it is received. Whether it is earned or whether it is, what is important is earned. Received, not received doesn't matter. We go by accrual basis. For non-performing assets, we don't go by accrual. We go by cash basis. We record it as income only and only when it is earned and received. If it is earned but not received, we don't recognize as income. Understood? Based on this also some questions do come. Based on this also some questions do come. And I made a nice present, this whatever is there, no, that I've made one nice post out of it. I can share that also to you people so that you can use it for last minute reference with all these images. That Ajay uncle image and that shirt with blue color image, everything. I don't want to be in trouble taking some small man. I can't afford a ticket to London. I can't afford a ticket to Cricket World Cup. ಈ ಸತಿ ಬರಕ್ಕೆ ಹೇಳಿ ಮ್ಯಾಚಿಗೆ ಅಂದ್ರೆ ಅಷ್ಟೇ ಕಳ್ಸಲ್ಲ. ಪ್ರಾವಿಷನ್ ಅಗೇನ್ಸ್ಟ್ ಬ್ಯಾಂಕ್ ಅಡ್ವಾನ್ಸ್. ಏನಿದು ನೀವು ಬರ್ತಾ ಇದ್ದೀರಿ? ಏನು ಮಿಕ್ಸ್ ಮಾಡಿಲ್ಲ ತಾನೆ? ಸಕ್ಕರೆ. Let's understand provisioning rates. Shall we understand the provisioning rates? Now, standard assets, the provisioning that we do is like this. You need only one, no, 0.4. La. If it is agricultural SME, then the provisioning rate will be 0.25%. If it is commercial real estate, for residential sector, it is 0.75%. For other commercial real estate, it is 1%. For housing loan at lesser rate, it is 2%. For other loans and advances, it is 0.4. Usually, majority of the times, it will be 0.4. But there are questions where you should use 1%, 2%, 0.25, and 0.75 also. So be aware. Be aware. So remember it like this. Agriculture, 0.25. After agriculture, you need residential housing, 0.75. 0.25 and 0.75 together, 1%. Other commercial real estate, 1%. If you have taken loan at a concessional rate because you are a poor person, that poor person will not pay EMI, will not prepay the loan completely. Bank has higher risk. So they maintain double, 2% provision. And usually it is 0.4%. So 0.25, 0.75, 1, 2, 0.4. 0.4 usually. 0.25 agriculture, 1% residential, and then 0.75, 1% other commercial real estate, and then 2% housing with lesser rate of interest, subsidized rate of government will tell no this Pradhana Mantri Awas Yojana and all is there, where if your annual income is less than 10 lakhs and you don't own even one house, then when you buy the house, 0.5% concession will be given in your interest rate on housing loan. Don't know. You know, only free current to free bus. There are so many other projects of government that you should be aware of. Yeah. Then other loans and advances, 0.4%. Got that? Very good. Then remember that with regard to standard assets, it doesn't matter whether it is secured or not. Standard means what? You are receiving interest on time. There is no differential rate for secured and unsecured. However, when we talk about substandard asset, we do classify it into secured and unsecured. If it is secured, 15%. If it is unsecured, usually 25%. Usually, if it is infrastructure loan with escrow account, then it is 20%. What is this infrastructure loan account with escrow account? Escrow account is a separate kind of account what is opened with a bank account where you give the instructions to banker saying that, or you give information to banker saying that this bank account is open for this specific purpose, and you give that in writing to the banker. Banker will accept money from you, and banker will give it in writing as to what is the purpose for which you taken this you can open this account, and banker will not accept your instructions to use that money for any other purpose. You can use that document as a collateral security to apply in certain cases. For example, when you go to this auction, what if you go to the auction and then auction for some $246 million and then say, no, I was just kidding? You can't do that. No? So what should you do? You should first deposit the money in the favor of that person who's auctioning, and then take that written consent from the bank saying that you have only given instructions to that, and you also cannot ask the banker to use these funds for any other purpose, and you give this escrow document to that particular person, and they'll let you auction. And same is done with regard to directors when they're applying for shares of the company. What if directors apply for the shares of the company? Because they don't have money, they neither accept the applications nor do they allot shares. They keep the money pending. Can't do that. So they would have to take the collateral in the form of escrow account to accept the applications from directors. They should keep so much money aside in bank. You're getting it? So such kind of an account where the money is freezed for a specific purpose and cannot be used for any purpose other than that. Such an account is called as our escrow account. Our dividend after declaration, you open one dividend account in the bank and then keep no. That dividend account what you open is also like an escrow account, like an escrow account. These are all special purpose accounts what you open with the bank. So if loan is given for infrastructure and it has savings against escrow account, meaning from that infrastructure construction, if they get toll, if they get some toll or if they get some rental income or any other commercial income, that money will go to that account because they would have taken huge infrastructure loan. So if such kind of loan is given, infrastructure construction, then on that provision will be 20%. You get this? Usually how much? 25 for unsecured, 15 for secured. If it is secured with escrow account, then little less. How much? This is for substandard. And how do we find out how much is secured, how much is unsecured? From the loan given, you reduce the realizable value of the asset held as security on that date. Once you deduct that, whatever comes is unsecured, that to the extent there is security and its realizable value is there, it is called as secured portion. Okay, good. So if the question is silent, assume it to be completely secure. If question is silent, assume it to be completely secure. So now with regard to doubtful assets, if it is 0 to 1, if it is 0 to 1, 25%, 1 to 3, 40%, greater than 3, 100%. It is doubtful but unsecured, then full 100%. Unsecured loan doubtful is how much? Full 100%. If it is 0 to 1, 25. If it is 1 to 3, 40. If it is greater than 3, 100. Any doubts? Okay. Then after that, loss asset. Loss asset 100% provision. Loss asset 100% provision. Please show it slow. Just fantastic. You need to do questions on this topic also. They'll give certain advances. They'll not give percentage. You should remember percentage. You should write it. This is again presentation based chapter. There is not going to be too many computations in this chapter. But you should remember the order. You should remember the numbers. You should remember the percentages and then write in the exam. For one last time. Yeah. And very scoring. Very scoring. 5 marks question you can finish in 2 minutes. 10 marks question you can finish it in 5 minutes. Balance sheet questions and all from here are very easy. Don't have to do too many computations. Got it? Then let's discuss provisions or advances which are covered by ECGC or DICGC. What is ECGC or DICGC? Anyone? Export Credit Guarantee Corporation. Then DICGC. DICGC. Deposit Insurance and Credit Guarantee Corporation. What is it? Deposit Insurance and Credit Guarantee Corporation. Let me explain. ECGC means Export Credit Guarantee Corporation. Now you want to start business, international business. You want to export goods beyond the country. But bank doesn't give you loan because bank doesn't trust you. But government wants you to export goods. So what does the government do? Government will come in between and then tell the bank, hey, I am there for it. I will support. If he doesn't pay money, I will pay. He wants to buy very expensive machinery. You give him loan. So government will give guarantee. He doesn't have any assets to give as guarantee. So who's giving guarantee? Government. So based on the government's guarantee scheme, bank will give loan to this people who are doing exports of business, export business. That is the reason the ECGC is there. No, its caption is also you take care of the business, we'll take care of the risks. What is it? See, you focus on experts, we cover the risks. So this is a government enterprise, the government body. Look at the tagline. You focus on experts, we cover the risks. Next we have DICGC, Deposit Insurance and Credit Guarantee Corporation. So Deposit Insurance and Credit Guarantee Corporation has two parts. One is deposit insurance. Second one is credit guarantee. How does that help the banking system? Two things. One, bank has to give loan. For bank to give loan, bank has to borrow money from people. So what the government does is government steps in and then says, all of you trust the bank, keep your money in the bank. Then you are like, hey, what if bank runs away? Government will say, don't worry. If the bank closes down, if the bank doesn't make the money, or someone who's borrowed money from the bank doesn't pay the money to bank, I will give you 2 lakh rupees. Used to be the previous case. After Nirmala Aunty came, the limit got changed up to 5 lakh rupees. If you have any money in the bank, if the bank defaults, Nirmala Aunty has told up to 5 lakhs, government will give. Up to 5 lakhs, government will give. So you have deposit insurance on all your savings bank account. Up to how much? 5 lakhs. This is revised. Previously, it used to be 2 lakh. In the last to last budget, Nirmala Aunty increased it from 2 lakh to 5 lakh. Are you getting it? So this way, they motivate the say public of the country to invest the money in the bank. So the bank can give it further. By ECGC, you are giving the banks permission or comfort to lend it to export business. What about people who make goods for Indians to eat, Indians to use? That's where Credit Guarantee Corporation will come. For potential business ideas, government will step in and then say, it's okay, you give loan to him, I am there. If he doesn't pay, I will pay. The government will give guarantee to bank so that the banks can lend money to these business houses. That is called DICGC. Two parts in it. First one, deposit insurance. That is to motivate public of the country to deposit the money with the bank. Second one, Credit Guarantee Corporation. That is to help the banks lend the money to outsiders without being worried about the guarantee. Now, whenever we apply provisioning on a specific loan which is covered by ECGC or DICGC cover, For the extent which government has given guarantee, we don't have to create provision. For the extent to which their lunch is over. Chirag is like was full concentration he was listening. No, he likes JCB. Full excited. Yeah. I think that's the reason if people are sitting there. No, you can see JCB Aram say for 2 hours. Whenever ECGC or DICGC cover is there against any specific loan, we usually do know on the secured portion, unsecured portion, based on whether it is standard, substandard, doubtful, we apply percentages. To the extent it is guaranteed by government, our provisioning will be zero. Are you getting it? Government doesn't usually tell amount as capping. Government tells percentage, 15% guarantee, 10% guarantee, 30% guarantee, 30% guarantee for textile sector, 20% guarantee for handloom sector, 50% secure, what say, provisioning for guarantee for mining sector. They tell that way. Now, on what do we apply that percentage? When government says 50% guarantee we'll give, on what do we apply 50%? The unsecured portion. First, we'll take the entire loan given. First, we'll take the entire loan given. From that loan, we deduct the secured portion. That is the realizable value of the asset held as security. That realizable value of the asset held as security is a secured portion. On this, we apply the secured portion percentage, whatever is there. On whatever is the balance is there, no, that is unsecured balance. Whatever remains as the balance is unsecured balance. On the unsecured balance, what do we do? We create provisioning. Yeah, after deducting ECGC or DICGC cover. ECGC, DICGC cover, whatever percentage it's given, it's applied on this unsecured balance. After we deduct it, what we get is net unsecured balance. On the net unsecured balance, we apply the percentage of provisioning for unsecured balance, and this realizable value of security, we apply percentage that we usually apply for secured portion. Fantastic. So we need to do problems on this also. Questions can come on this topic. Want me to do a question or two? We'll finish the entire chapter and then see. Or now only? ಹೇಳಿಪ್ಪ ನಂಗೇನು ಕೇಳಿಸ್ತಿಲ್ಲ. ಹೋಗಿ ಸರ್ ಅಂತ ಹೇಳಿದ್ರು ಮಾಡಿ. ನೋ ಕರೆಕ್ಟಾಗಿ ಕೇಳಿಸ್ತಿಲ್ಲ ನನಗೆ. ಐ ಡಿಂಟ್ ಹಿಯರ್ ಕರೆಕ್ಟ್ಲಿ. Yes, okay, I heard yes. Here, this is question number 11 where they've given the, what have they given? Yeah, they have given, I would say, earned, not received, earned, unreceived, all of that. Based on whether it is performing or non-performing, we should decide what should be treated as income. Question number 11. Should I show question number 11? Page number, 192. See, term loan, what do we consider as income? Interest earned or interest received? Performing, earned. Cash credit, earned. Performing, because these three items, because it is performing, we've taken interest earned. Because it is non-performing, we take it only interest received. 5, 12 and 20. This is one question. Easy. This is recognition of income. Then we have another question that we can do on percentage. T13. 13. ಹಾಗೆ ಇನ್ನೊಂದೆರಡು ಪೇಜ್ ಕೆಳಗಡೆ 13. Have a look at this. Assets, they are asking us how much provision to be created. On standard assets 5,000, how much? 0.4%. On substandard assets 4,000, 15%. And then doubtful 0 to 1, 25, 1 to 3, 40, greater than 3, 100, loss asset 100. Similar to that, we have several other questions what you can practice. And here there is some secured by mortgage plant 600 lakhs. So in this 2000, secured 600, unsecured how much? 1,400. For secured of 600, 100%. By D greater than 3. D greater than 3. Secured 100%. Unsecured yavaglu 100% when it is doubtful. Sir, why do we do that classification? To tell whether it is 100% or 100%. Understood? Remember that sheep story? One farmer to whom the reporter goes and then asks, does this sheep belong to you? Then the farmer will tell, black sheep or white sheep? Black, black one, white, white also belong. What do you feed these sheep? Black sheep or white sheep? Black one grass, white one also grass. Why do you always ask black sheep or white sheep? Black sheep belong to white, they also belong to red. Then we'll do next set of question. Next, what did we just discuss? Provisioning over, no? ECGC cover. Question number 16. Question number 16. Nodi. How much is outstanding loan? 4 lakh. How much is secured portion? Value of security held is 1.5 lakh. In that only 80% is realizable. So 1.5 lakh into 80% is 80 plus 40, 1 lakh 20. 1 lakh 20 is secured. 4 lakh only 1 lakh 20. 1 lakh 20 is secured. On 1 lakh 20, how much provision should we do? Secured. It is for more than 3 years doubtful. 100% provision on 1 lakh 20. Balance is 2 lakh 80. In that 2 lakh 80, 50% ECGC cover. 1 lakh 40 damar. Balance 1 lakh 40 is unsecured. T greater than 3. Unsecured. 100% provision. So provision is 1 lakh 20 plus 1 lakh 40. Totally 2 lakh 60. See the answer. Very difficult? No, actually very easy chapter. Banking and NBFC are lottery. Banking, NBFC, ESOP, buyback, liquidation, all are lottery chapters. You get questions from this chapter in the exam. No, you should not answer first. Like yes, and then answer. You should celebrate first, and then answer. Yeah. Next, you understood this ECGC cover. Next, let's discuss the services given by the banker against bills of exchange. Services given by banker against bills of exchange. So for the bills of exchange, what the account holder holds, he can take certain services from banker. The services that he can take is number one, discounting services. We call it financial service. I've given 3 categories: financial service, operating service, guarantee service. All these 3 names I have given. It's not there anywhere. I have named it like this so that it's easier to understand. Financial services is discounting of bill. You are a businessman, you sold goods, your customer accepted a bill, you have the bill, you want money, you don't want to wait till maturity date, you don't have so much patience. So what do? You are in urgent need of money, you come to the banker and then give the bill. Banker will accept the bill from you, discount it, deduct a portion of it towards discounting charges and give the balance money to you immediately. Banker will hold the bill with himself and then wait till the maturity date. On the maturity date, banker will collect money on your behalf. Do you get it? Now, whatever the discounting charges, what is cut, for you it is expense. For banker it is income. How should the banker recognize that income? That's what we're going to learn in financial science. Quickly see discounting of bill. Andare, bank will accept a bill from the customer. Means say bank account holder. Account holder has sold goods to customer. Customers have given a bill to account holder. Account holder will discount this bill with banker. Banker will cut a portion of this towards discounting charges. After cutting a portion of it towards discounting charges, balance money will be immediately dispatched by the banker to account holder. That portion what is cut by the banker is discounting charges. This discounting charges is expense to account holder, income to banker. What is it? Expense to account holder, income to. How should we recognize that income? When should we recognize that income? Should we recognize that income the moment we receive it? No, accounting standard 9. It should be recognized based on time. It is like interest. Interest income should be recognized based on time. Am I right? So you should recognize it based on time. How? What time? Assume that the discounting period is there. No, fully exhaust in the current year. It is discounted and the bill's maturity date is in 3 months. That 3 months ke baad maturity date is there. No, that is in this year only. So then what do we do? Full 3 years income, recognize it as income. Well, full 3 months interest, recognize it as income. Not on the date on discounting, on the date of maturity or at the year. What if bill is discounted for a period of 3 months? In that 3 months, 2 months is in current year, 1 month is in next year. At the end of the year, we should recognize only 2 months interest. 1 month interest should be pre-received income. It should be postponed to next year for recognition. That 1 month income what is postponed until next year is called as rebate on bills discounted postponed. Rebate on bills discounted postponed from current year to next year. In current year it is liability closing balance debit side. Next year it is liability opening balance credit side. Next year that will be recognized as income. Further in the next year whatever income is earned that will be recognized, and some part of income that is received in the next year but doesn't belong to the next year, it belongs to the year after that, will again be transferred to rebate on bills discounted and carried forward to the year after that. Understood that? Have a look at this. So discount charges are also known as rebate on bills discounted. Rebate on bills discounted is income to banker and it has to be recognized in the period to which it pertains and not merely on receipt basis. You should not recognize it on, so you should not recognize it on the receipt basis. We should go for accrual concept. Here, let's see the accounting. So this is how it is. This is the date of discounting and this is the date of maturity. And between this date, if year end comes, till the year end, how much ever is earned should be recognized as income, balance to be transferred to rebate on bills discount. So the entry on discounting date, when you discount the bill, you are receiving the bill. We call it bills purchased and discounted. We call it bills purchased and discounted to account holder for the money that you pay to him. And to some small extent you don't pay to him, no, you cut and then pay. So whatever you cut is your income, interest and discount account. So entry is discount bills discounted and purchased account debit to interest or discount to account holder. This is on the date when the bill is discounted. And after this, what do we do? On the year end, from interest and discount account, we recognize income. So I'll write interest and discount account debit, but entire amount cannot be transferred to P&L. Beyond a point which is not earned in the current year, which is to be earned in the next year, will be transferred to rebate on bills discounted account. Will be transferred to rebate on, and in the next year, it will go from rebate on bills discounted to interest and discount. Are you getting it? How do we find how much is to be deferred to next year? Opening whatever is there plus what is received this year minus what is to be transferred to next year. That's how we find the amount of interest that should be transferred to P&L. How do we get to know how much should be transferred to next year? For the bills discounted during the year, we'll multiply by the bill period remaining after the year end till the date of maturity and then multiply it with discounting rate. How do we identify how much is closing rebate on bills discounted? Bills discounted which are not settled on the year end multiplied by period outstanding after year end multiplied by discounting rate. That's how we find closing. We would know opening, we would know closing, we would know current year interest. Add everything, we'll get to know how much is the income to be transferred to. Got it? And on this, we need to do a few questions. For this, we can prepare ledger account also. Interest and discount. For the bills discounted during the year, we'll write credit. Before that, we'll bring down last year's closing rebate. And we'll write current year bills discounted money. Some part will be transferred to P&L. Some part will be transferred to next year. And in our bills discounted account, from last year, whatever is brought in, no opening balance, pre-received income, liability, will be transferred to interest and discount. And from current year interest and discount account, some part will be transferred to next year as a closing balance. Got it? Come. Shall we see a question on this? Before that, presentation of these items in balance sheet. Where do we present? Rebate on bills discounted will go to balance sheet. Interest and discount will go to P&L. Interest and discount will be shown in schedule 13. And our balance sheet may, so what to say, rebate on bills discount will be shown in schedule 3. Sorry, schedule 5. That is liabilities and provisions. And profit and loss account only interest and discount will be interest on schedule 13. This you usually learn separately when we start doing financial statements. But I'll tell you, when you do this, no, along this side only, you start reading all of this, which schedule, what is it. So before we even do first problem on balance sheet, we already know 3-4 schedules. Let's see a question. There's something else. Question number. Question number 1. Shall we wind up? Thank you guys for listening. I hope you all learned Group 2 Advanced Accounting. Hoping to see you all on a different day at a different place. Tata bye bye Madbeka, banking, NBFC, liquidation, buyback, ESOP, and show some energy. ನಿದ್ದೆ ಮಾಡ್ತಾ ಇದ್ದಾರೆ Your exam is also 2 o'clock to 5 o'clock. 2 to 5, because people are staying like the most inactive part of your day. 2 to 5, 2 to 5 should be your most, say, energetic part of the day. I mean it. Do something in such a way that 2 to 5 will feel the most active. One clear don't is don't sleep at 12 o'clock. I told this last time, someone told, sir, I'll sleep at 12. I'll wake up at 1:30. I'll feel very fresh. You get used to the 12 o'clock sleeping schedule. On the day of exam, 12 o'clock, you can't sleep. Why? You need to have lunch and then go no to the exam hall. So if you don't sleep, every day you're sleeping at 12 o'clock for the last 3 months. Suddenly on the day of exam, you are not getting used to sleep at 12 o'clock. You feel very frustrated. If you can actually sleep 12 o'clock to 1 o'clock or 1:15, it will be amazing. But on the exam day, who will drop you to exam hall at 1:15 when you just you'll feel very fresh. On the exam day, just imagine 12 o'clock when you're about to feel all tension. You sleep at 12. 1:15 when you wake up and go, you'll feel very fresh. But out of tension, it might so happen that 12 o'clock you might not feel sleepy. But your body wants to sleep. Your mind is not letting you sleep. You will be very dehydrated, tired, and very lazy at 2 o'clock. Then at 2 o'clock, you're like, hey, not good, not good. Let's start. Illustration number 1. A bill of rupees 5 lakh was discounted on 1st of the February 2015 at 16%. And it will mature on 30th of April. Give journal entries. When it is discounted on 1st of February, what is the entry? Bills purchased and discounted account debit 5 lakh. How much is interest and discount on that? 5 lakh into 16% into how many months? February, March, April. 3 months. Do 5 lakh into 16% into 3 by 12. How much? 20. So I will write bills purchased and discounted account debit 5 lakh, to interest and discount account 20,000, to account holder account 4 lakh. Understood? From this interest and discount, some part is earned during the current year. That should be transferred to P&L. How much is earned? In the current year, we have February, March, 2 months. So 48,000, 20,000 into 2 by 3. How much is 20,000 into 2 by 3? 13,333 will transfer to P&L. How much is not earned? 1 month, April, 20,000 into 1 by 3. 6,667 will go to rebate on bills discount. And in the next year, we'll transfer from rebate on bills discount to interest and discount. Over. 4 marks. 4 marks. Quickly see the next one. Next one, now to we'll go to next topic. Beda. Next one, beda. We'll do question number 3. We'll see which journal it. The following is an extract from trial balance of Overseas Bank as of 31st March 2011. Bill discounted 12 lakh 64, rebate 22,160, discount received 1 lakh 5,708. See this rebate 22,160 is there. No, what is this? Pre-received income in the last year which is brought down to current year. So it will be in rebate on bills discounted account. We should transfer to interest and discount. Why? It will be earned in the current year. Entry number 1, rebate on bill discounted account debit 22,160 to interest and discount. See, rebate on bill discounted to interest and discount 22,160. Then bills are discounted. How much? 12,64,000. Discount is 1,05,708. Entry bills purchased and discounted account debit 12,64,000. Then to interest and discount 1,05,708 to account holder. Correct? Now interest and discount here is 22,160. Interest and discount here is 1,05,708. How much of this is our current year income? It is 22,160 plus 1,05,708 minus closing rebate. How much is closing? Unearned finance income. Sir, beda, sorry, yes, 19 nenpagate. No, unearned income. How much is the finance business mein income which is received but not earned? Shall we find it? Come on, let's find how much is the unearned income. So this is the bills data. One part A, 436, 282, 406. So they've given the due dates. Are these due dates after 31st of March? Are these due dates after 31st of March? What is the period remaining after 31st of March? June 5th. April lo May June ali 5 days. April 30 days, May 31 days. 30 plus 31 plus 5. 16. 6 or 6. 30 plus 31 plus 5. 66 days. So for 66 days, on this 1,40,000 at 14%, we'll compute discount. And on this June 12th, same 30 plus 31 plus 6. Then June 30 plus 31 plus 25. July 30 plus 31 plus 30 plus 6. At this rate 14, 14, 14, 16 on 140, 436, 282, 406. Identify interest. This 42,318 rupees of interest is received but not earned. So from interest and discount account, it should go to rebate on bills discounted. So I'll write interest and discount account to P&L some money income, interest on discount to rebate on bills discounted 42,380. Sir, how did you get 85,550? 85,550 is this 22,160 opening rebate bills discounted during their 1,05,708 minus 42,380. What do we get? 85,000 fan is the current year income transferred to PN. That's it. And this 42,318 in the next year it will come back to interest and discount account. Understood that? Same thing, whatever I told you how it is to be done, it's here. And for the same, you can prepare ledger account also. From last year, you bring this much money, current year, this much money, this much is carried forward to next year, this much is income. Same you can do with rebate. Opening balance is transferred to interest and discount. What comes in interest and discount will be carried forward to next year. Okay. Now you understood, and I also taught you how to present it in financial statements. In these questions, they have not asked presentation, but after each question, I have told you where will this appear in financial statements, so that you get that build up for financial statements even before we actually prepare financial statements of banking company. Okay, now see, this is the what is say financial service given by the banker for bill of exchange. Next one is operational service. What is operational service? You have a bill of exchange which you received from your customer. What should you do? You should do two things. Number one, hold that bill till maturity date. Hold that bill till. Number two, remember the maturity date and collect the money on the maturity date. There can be a certain scenario where you forget the maturity date. You forget the maturity, or safeguarding the bill is also very. You keep the bill in some place and then one rat will come and bite the paper. So two challenges are there with businessman. Number one, safekeeping. Number one, safekeeping. Number two, collection on the maturity date. Not 3 months later you realized, oh, this bill matured 3 months ago only. So to do this, what you do, you take service from the bank. What is the service that the banker gives here? Banker accepts the bill for collection. He doesn't give you money instantly. Banker will collect the bill from you. He doesn't collect the money instantly. He keeps the bill in the locker, safe. On the maturity date, banker will collect the money on your behalf and adds it to your bank balance. This is not financial services like discounting. In discounting, the moment you give the bill, banker will give the money to you. In operational services, banker will not give the money instantly. Banker will present the bill on the maturity date, collect the money on the maturity date, and then he'll increase your balance. This is called as bills sent for collection. This is called as bills for collection. Now think from banker's perspective. Bills for collection is asset to the banker or liability to the banker? It is neither. It is neither an asset nor a liability. Why? You keep money in the locker or you keep gold in the locker. Banking has asset or liability. That's bank Allah. That's not bank. That doesn't belong to bank. But you should record some books, no? So what do? You maintain one register. Maintain one. But you should know how much is there with you. So in that register, you make the entry. You write it as asset. You also write it as liability. Write it as asset also your asset. Why? You hold it. Liability, why? It's not yours. So you call it bills for collection. It's an operational services given by the banker to the account holder. Account holder sells goods to customers. Customers will give him bill. He gives the bill to bank and he will wait. He will wait. On the maturity date, banker will give the bill to customer. Customer will give money to the bank. Bank will give the money to you. Too many things are happening. Should I do it again from the beginning? Understood? Okay. And the bill is received for collection by the banker. What is the entry banker should pass? Bills for collection account debit to bills for collection account. Bills for collection account debit to bills for collection. Sorry, what did you tell me? It is bills for collection asset account debit to bills for collection liability account. ಹಿಂಗೆ ಹೇಳಿ ಸರ್. ಅದು ಅರ್ಥನೇ ಆಗಲ್ಲ. I told you, no, we should maintain register and not entries. But for the sake of accounting, we can write bills for collection asset, bills for collection liability. Okay. Then on the maturity date, it can be honored, it can be dishonored. If it is honored, what is the entry? You will collect money and you give that money to account holder. Bank account debit to bills for collection. Na Allah. Bills for collection liability account debit to bills for collection asset. Ulta. Here asset increased, here liability increased. Here liability decreased, asset decreased. If it is dishonored, very important entry. Listen, when the bill is dishonored, entry is bills for collection liability account debit to bills for collection asset. The same thing. Yeah, same to same. No difference. Bills for collection liability account debit to bills for collection. Yeah. I had put that text for myself. Later, I should download a meme and then put there. But before I put it, the chapter is only at there. Don't worry, Arya. Don't cry. Don't cry. When you become ICA president, you bring banking companies, insurance companies, electricity companies, everything you put. Call me once. You ನೋಡಿ ಓಟ್ ಹಾಕಕ್ ಕರಿತೀನಿ ಅಂತ ಹೇಳ್ತಾನೆ, ಸಿಲೆಬಸ್ ಚೇಂಜ್ ಮಾಡಕ್ ಕರಿತೀನಿ ಅಂತ ಹೇಳೋದೇ ಇಲ್ಲ. Bills for collection asset. Okay, fine. I'll do campaigning. But after you become president, you should take suggestions for changing the syllabus. We'll make only nice chapters be there. Okay? Easy chapters ಎಲ್ಲ ರಿಮೂವ್ ಮಾಡ್ಬೇಕು. ಹೆಂಗೆ ಕಣ್ಣಲ್ಲಿ ರಕ್ತ ಬರಬೇಕು, ನೀರು ಬರಬಾರ್ದು ಎಕ್ಸಾಮ್ ಅಲ್ಲಿ. Someone, if you're walking as a CA student, people should do like this. Yeah. Bills for collection asset, opening balance debit side, and further bills received during the year debit side. And the liability account opening balance credit side, further bills received credit side. Honored or dishonored, we don't care. Either ways, it will reduce. Credit in asset account, debit in liability account. Closing balance, credit in asset account, debit in liability account. Ta-da! Difficult? Say something. Time pass, no? Next comes one more ledger. This, where do we present these bills for collection? In balance sheet. Heli. Where? Notes to accounts. Where? Which schedule? Asset or liability now? Asset or liability now? Both, sir. Asset or liability? Heli pa. Asset and liability. Actually, it should not be shown, but we'll still show. Where will we show? Schedule number 3. Deposits will do, no? There we'll write. It's actually off balance sheet item. But schedule number 3, deposits we write, no? There below that note of deposit will disclose, saying that this much of bills for collection is received. Doubt ideyappa? Is your friend? What did you do? Small pieces and kept in refrigerator. Able to recall someone's missing. Not able to recall his. Dispose pieces safely. People usually get caught when they're disposing. Done. Profit and loss account. Profit and loss account, where do we write? Does it come anywhere? It is asset and liability, not expense and income. It will not be presented anywhere in P&L account. It will not affect P&L. Got it? Should we do a question on this? First. Next, last service. This is called guarantee service. Bank will give some guarantee service. Means what? You want to take loan, not in India. You want to take loan in some foreign currency in a foreign bank. Why? You want to do diamond business there. So if you want to do diamond business there in the foreign currency in the foreign bank will not give loan to you. Foreign bank will ask, what is guarantee? You will tell, I have 2 BHK flat in Marathali. 2 BHK flat in Marathali, documents can't be kept in a foreign bank in a foreign country, Amsterdam, to take loan to open some diamond shop there. No. So what do? You go to Punjab National Bank in India. So Punjab National Bank in India, you keep your assets, 2 BHK flat in Marathali, and then one car that you have, one bike that you have, all the documents, in shares that you have, you give all of this relative. So you give these documents to Punjab National Bank. Punjab National Bank will give one LOC. Letter of credit. Thank God, people know it. So this LOC will not be given in hand. It will be sent through one Maruti Swift car. Swift technology to bank in Amsterdam. So the Amsterdam bank will keep this as a security and then they'll give loan in Amsterdam. If the person, whoever takes loan there, okay, whatever Nodi, whatever body is there, if he pays the money back after using the loan, after doing the business, if he pays the money back, then that whatever LOC was there, that will be released and information will be sent to PNB. PNB will stop the mortgage on these items. So he can take the assets, use them, you can sell them, he can do whatever he wants in India. Getting it? Okay. So this is what we call as guarantee services. It is acceptances, endorsements, and other obligations. This acceptances, endorsements, and other obligations, in this chapter, we're learning it from the perspective of the Indian bank, what's giving this. Not from the perspective of the foreign bank, not from the perspective of the, getting it? So not from the perspective of the borrower. So from the banker's perspective, banker does this for the purpose of commission. Whenever they give LOC for a certain amount, they take commission. And you know what had happened then? Then what had happened is he went and asked for additional LOCs. They told the time agat. He told like old bank managers to give it instantly. Give me no. The new bank manager told it'll take little more time. Then he checked. Then he told where is mortgage properties? He told nothing. Take 2% extra commission. Give me LOC. Then he told Angela work agala. Then Neerav uncle told Ange work agodu. He told, what the hell are you talking? Give me 2 days. I'll see what has happened to other LOCs. He sees all the old LOCs. None of them are sent through Swift technology. Everything is like overrides the RBI technology and it is sent directly to the bank. Okay, fine. Is there at least mortgage? There is no mortgage also against it. Without mortgage, thousands of crores LOC has been given. Then that manager didn't get sleep for 3-4 days. He told, I need to disclose this to statutory auditors and also we should disclose this by public notice. Businessman told, please don't do it. If you do, my goodwill will get affected. Then this boy told, if I don't disclose, my job will go. I will be put behind bars. It is serious criminal offense. We can't do it. I have to disclose this. Then that guy told, if you disclose, then I will not pay the money to the foreign bank. You would have to pay all the money from your end. And they told, you do what you want to do. I'll do what I want. This guy disclosed, made public notice. No one caught it. It was self-disclosed by the bank that this much big Gotala has happened. And everyone told auditors are sleeping, auditors go on lunch break, you don't do audit properly. Hey, if it is gone through technology, we will check. If it is not gone through Swift technology, how can anyone check? We are not sniffer dog, no there. Until check, we can't check. So that was the problem. Are you getting it? And what did it tell? You take commission. Banker gives services here not for commission. Banker gives services here because banking services are required outside India, assets are held in India, and some amount of cooperation is required from Indian banks. You get it? Fine. So this acceptances, endorsements, and other obligations is not liability. It is not. Is it liability of Punjab National Bank? It will become liability of Punjab National Bank only and only when the diamond dealer stops paying money to the foreign bank. Then because Indian bank has to pay. No, foreign bank doesn't ask Indian bank to pay. Foreign bank says you have assets of that person to whom I have given loan. No, tell those assets and give me the money. You can't tell the foreign bank, hey, those assets are not there. Because you only told those many assets are there and this much is the value. You can't tell. I was just lying. It's not like sitting on the sofa and then lying. No, this is different lying. So this is a contingent liability, not a liability. Because this is a contingent liability and not a liability, we can't pass journal entries. Can't pass journal entries. But however, for the sake you want, no, I will show. Shall I? You want to read this theory or shall I straight away show? Focus on one word here. What is it? It is contingent liability. What is it? Funny. Contingent liability. This is actually not ledger. Looks like ledger. Look at the ledger. Credit side, I'll write opening balance. And further, if you've given more acceptances, more guarantee, we'll write on the credit side. And during the year, if any guarantees that you have given is been accepted, honored, very good. Liability will reduce, debit side. If it is not honored, liability will, I would say contingent liability will reduce. You would have to pay. Liability will reduce, payment will be made. Again, that also will come on debit side. If it is dishonored, either you pay or the account holder will pay. Either cases, contingent liability will reduce. Either it will become liability or it will become payment. And at the end, whatever is there, you will write as closing balance. That's it. This is acceptances, endorsements, and other obligations. What is there in black should be written. What is there in blue, you need not write in the exam. We're going too fast. Understood? At the end of this, you should disclose this in financial statement. Where do we write? Schedule 3 is deposits. There is one separate schedule for contingent liabilities in banking company. We'll disclose it in the contingent liability, or to say, schedule that is there. And it will not affect our P&L account. Will it affect our P&L account? Is it income? We need to discuss problems on this. You want me to do one or two? Time pass. There is only two questions. One question only is there in the ICA study material. Then preparation of financial statements. Format looks like this. But before talking about the format, the financial statements of a banking company should be prepared in compliance with RBI directives, Ministry of Corporate Affairs directives, and sorry, Ministry of Finance directives, and the Banking Regulation Act. Key things are applicable. All the three have to be compliant. Banking Regulation Act 1949 and guidelines issued by RBI as well as notifications issued by central government. Based on this, the schedule is already ready, which is there under Banking Regulation Act 1949. Schedule 3 talks about banking regulation, banking financial statements. In that, Form A is balance sheet, which says Schedule 1 to 12. Form B is P&L, which talks about Schedule 13 to 16. Annual report is 17. Significant accounting policies is 18. Notes to account is 19. These are schedules. You can't change these numbers. What is the format? Within the balance sheet also, each item is fixed. For example, let us say borrowings are not there. Other liabilities and provisions, I cannot write 4. It will be 5 only. You can change the number if it is note number. These are schedule numbers. Can you change them? No. For Companies Act, format is under Schedule 3. Notes our choice. Here, each item is given by way of a note. Are you getting it? This is more strict, more very particular, more guidelines, more regulations. That is the reason when we write Schedule 3, we write not applicable to banking companies, insurance companies, and electricity companies. Why? There is a specific specialized format available for them. And the way we present the items in the balance sheet, we call it marshalling. The order. There are two orders of marshalling. One is order of liquidity. Second one is order of permanence. I teach this to you in CA Foundation, Chapter 7, Final Accounts. There we told that always we follow order of permanence. Permanent items first, fixed assets, land, building, furniture, plant and machinery, motor vehicle. And then we'll write debtor, stock, inventory, cash, bank. Whereas in banking company, ulta. We follow order of liquidity. We write what to say liquid items on the top. This is more correct. Alva. Solids will go to the bottom. Liquids will float at the top. So cash, bank balance, investment, advances, then fixed assets and other. And we have a separate schedule for contingent liabilities. 12. We write it in 12. That contingent liabilities, acceptances, endorsements, and other obligations. Got this? So straightforward, very simple questions will be there. We'll give all the items. We just have to put them together into this balance sheet. Getting it? Then P&L account. Interest earned, other income. Interest expended, operating expenses, provisions and contingencies. Provisions we know how to compute. We apply standard asset, substandard asset, doubtful. That provision total we'll write here. Interest earned and other income they'll give. Interest expended and other expense also they'll give. You add them, you add expense, you add income, you find the difference. Remember this. 25% of the current year profit should always be transferred to statutory reserve. Whether they tell in the question or they don't tell in the question. Remember to always transfer how much of statutory reserve, sorry, of current year profit to statutory reserve. Did you get this? This is the format of P&L, and that's at 25%. Then we'll discuss the last part of this chapter. That is ratios. Is it? There are 3 ratios that you should be knowing. One, statutory, CRR, cash reserve ratio, then SLR, statutory liquidity ratio, and capital adequacy ratio. This CRR and SLR both are liquidity based ratios, and capital adequacy ratio is capital adequacy now. And cash reserve ratio should be maintained in the form of as a particular percentage of NDTL. What is NDTL? Net demand and time liabilities. What is it? Net demand and time. Net demand and time liabilities means that savings deposit, what is received is demand liability. Fixed deposit and recurring deposit, what is received by the company is called as time deposit. So demand liabilities and time liabilities of the company, of the banking company is there, no? What it has borrowed from the deposit holders. Of that, a certain percentage of money should be kept in the form of cash or unencumbered securities. Or current account with, or in current account with RBI. This is what we mean by CRR. This percentage will change time to time basis. You check it before your examination, and what's applicable for your examination as far as I think is 4.5 4%. I think 4.5. 4.5. I think it is 4.5 from a pretty long time. RBI is not reachable. Direct ಯಾವಾಗಲೂ ಓಪನ್ ಆಗಲ್ಲ. They're here. Reserve ratios. 4.5. Since last more than a year, it is 4.5. For your exam, what's applicable is also 4.5. What is the rate at which CRR should be created? 4.5. However, if you want check once in the RTP, it is 4.5. I am pretty confident. This was long ago, 18th May 2022. It was 4%. And I told you know already what is the NDTL: savings deposit, recurring deposit, fixed deposit, and current account credit balance. Don't take current account debit balance. Why? Current account debit balance is advance given by bank to account holder, and it will become part of our advances for provisioning, for recognition of income, and all of that. Then we'll quickly see SLR. Shall we see SLR? Statutory liquidity ratio. A certain percentage of NDTL, right now it is 18%, should be maintained in the form of cash, gold, or unencumbered securities. Cash, gold, or unencumbered securities. Right now, what is the percentage? 18%. There is one question on preparation of financial statements where we need to check whether CRR and SLR requirements are met with. If they are not met with, we need to decrease it from one place. We need to decrease it from our cash balance and then deposit in current account with RBI, because CRR should be maintained in cash with RBI or current account with RBI. Okay, there is one question wherein we were supposed to prepare financial statements. In that particular question, there is no sufficient balance in balance with the current account with RBI. So you had to reduce your cash balance, deposit so much in CRR, and then continue the problem. I can tell you the question number also. I want you to solve that question before you go ahead. Don't do all nonsense, small questions. There's only one question of that type. It's there in your ICS study material also. Tell, where is it? Aware of it? Have you guys done it in your practice usually? NP class I specifically make them do telling it again and again. Madro agate anta. I'm not able to recall the number, but there is one question. I'll tell you. Question number 31. 31 only, no? Question number 31. In Yashas material 31. Same question is there in ICS study material. Actually, it's there in ICS study material, then we put it into Yashas material. Adunu joke ಮಾಡ್ತೀರಾ ನೀವು? Will you try that question? Answer, I put it in this Excel sheet in the format in which you will love. Detailed explanation. Guys, please try that one question. We're done with SLR. Then we have capital adequacy norms. Capital adequacy norm says that how much of capital is in tier 1, how much of capital is in tier 2, and what percentage has to be maintained in this particular thing in ratio to assets. So this capital adequacy ratio is also called as risk weighted to assets ratio. Sorry, capital to risk weighted assets ratio. So as project back out. For those of them who are watching it online and wondering what happened, there was power disruption. Sorted now, we're getting that. Capital adequacy ratio. As the name itself says, it is called as capital to risk-weighted assets ratio. If you write that in the format of a formula, capital to risk-weighted, capital divided by risk-weighted assets. Capital divided by risk-weighted assets. Along with assets, we also write off-balance sheet items and multiply it by 100. Now the question is, how do we find capital fund? Capital fund in the banking company will be categorized into two. One, tier 1 capital, two, tier 2 capital. Tier 1 capital is paid up capital, statutory reserve, all the disclosed reserves. I've given a big list of items. Remember it this way: paid up capital, and if there is any preference shares issued which are mandatorily convertible and non-cumulative, meaning in the event of lack of profit in a specific year, we don't give dividend. In the next year, we need not give previous year dividend. Means it is as good as an equity share, and it is going to be converted into equity share in the future. Such shares, if they are there, they'll be considered to be part of equity. Statutory reserve, security premium, and all other disclosed reserves will be considered to be tier 1 capital. Except if there is revaluation reserve in tier 1 capital reserve, that will be eliminated. Accumulated losses will be deducted. This is tier 1. Then tier 2. Tier 2 is something that you will read very in simple terms in your problem solving, but literally it has these many items. But you won't get these many in the exam. You will usually have this revaluation reserve. Nothing else will come in your questions. You see all the questions from all the past examinations, Ever since the time CA IPCC was there, CA PCC was there. That is at a time where even I was not in school. Even I was in CRAD. PCC P1 P2. From there, if you see also tier 2 capital question, only one item will come in the exam. That is revaluation reserve. Revaluation reserve is not part of tier 1 capital. And in tier 2 also we can't take it completely. We should deduct 55% and take only 45% of it in our tier 2 capital. And at no given point of time, tier 2 capital cannot exceed tier 1 capital. At any given point of time, tier 2 capital cannot exceed tier 1 capital. We take these two at the top, and in the denominator we'll take risk weighted assets. For assets, what is there in the balance sheet, risk is given by RBI. You multiply that risk with this asset to get the risk weighted assets. What is the risk? If you have cash balance or bank balance, risk weight is 0. If you have balance with other banks or claims on other banks, 20%. If it is been secured by some savings bank deposit or government, I would say 0% risk. Or what to say, yeah, balance with other banks, current accounts or claims on other banks, 20%. If you've given any loan, if you've invested somewhere or all of this, educational loans, all of this will be 100%. And if it is given as housing loan or personal loan, then it is huge risk, because housing loan will be really huge. Personal loan is without any guarantee. So there 125% is the risk. Okay. These are the percentages. You take these assets, multiply this percentage, you get risk weighted assets. Take it in the denominator, take capital in the numerator, multiply it by 100. Then we get our tier 1, tier 2 capital, risk weighted assets, off balance sheet items, multiply by 100. We get whatever is our capital adequacy ratio. Minimum capital adequacy ratio should be maintained at 9%. If it is not maintained, you don't try to do any adjustment, just write a comment saying that it is not complied. Prudential norms for maintenance of capital is not complied, and the banking company should take necessary action to increase their tier 1 capital to make good the capital adequacy. If you are still reading from material which says 7%, 7.5%, that is outdated. Please change the material that you are reading from. Done. By this, we are done with banking company for the exam type. There's one last theory part in this chapter, that is treatment of investments. Investments made by banking. This is all lending. No, I told you in the beginning definition. Banking company will accept deposits to either lend or invest. People usually teach you deposit, advance. They forget investment. Banking company can invest in securities. That investments which is made by a banking company can be classified into three categories. One, held till maturity. Two, held for trade. Three, available for sale. Held till maturity and held for trading. Held till maturity is like non-current investments. Held for trading and available for sale is like current investment. And at any given point of time, maximum money that can be there in HTM held till maturity is 25% and not beyond. And there are certain conditions how to value HTM, how to value HTF and HFT, and how to value AFS. This held till maturity is like current non-current investments. It will be valued at cost. However, this held for trading and available for sale is like current. It will be valued at cost or market price, whichever is less time. And can you change the category of the items from HFT to AFS and all of this? So there's little bit of theory on this. Actually too much, but I've simplified it and then put it in the form of a chart for this much. So if you can read this, it will be more than sufficient. There has not been a question on this topic in the recent past, but I would not want to leave any part of the syllabus untouched. So I am touching this. Heard of this? In this somewhere? Read this somewhere? Classification change, how to classify from here to here, what is mark to market? When you're reclassifying from here to here, at what price should you take? Should you take at cost or should you take at market price? All of that not read. Simple to understand. Reclassification is done by board approval. Reclassification cannot be done. It is to be done within 90 days from board approval. And at what price should you do? You should do it at the beginning. If you do it this price, you should do it at market price. If you do it like this, you should take it at the cost, original cost price. All of that theory is there. This is one thing. If you do, we can easily say that we are done with the chapter of financial statements of banking company. Shall I finish NBFC? Okay. Good. Come on, let's do banking or non-banking. Very similar. Here also you have ratios. Here also you have provisioning. But here you don't have financial statements. For an NBFC, you won't learn how to prepare financial statements. Here, non-banking financial corporations. So what do you mean by non-banking financial corporations? It is something which does financial business, but it is not regarded as a bank. It is not regarded as a bank. You can get questions on theory, when to register it as an NBFC, what certifications are required, which is the regulating authority, what is the category and type of NBFC, when do we call it performing asset, when do we call it non-performing asset, how do we recognize income, how do we make provision, what do you mean by net owned funds, how to compute net owned funds, and finally how to compute capital adequacy ratio or an NBFC. So let's quickly get started. NBFC examples are here. All of these are most famous NBFCs that you can come across in the modern time. They do banking business, but they're not banks. Right? How is NBFC different from bank? Banks are very closely monitored by RBI. NBFCs are not that closely regulated by RBI. And banks can accept demand deposits, meaning you can keep money in the bank. Whenever you demand, bank will give it back to you. NBFC cannot accept demand deposits. NBFC can only accept time deposits. All this Shriram Transport, all of these are very famous NBFCs. They give 8.5 9% interest on fixed deposit. Are you aware? We call them corporate fixed deposit types. So they accept only time deposits. They cannot give demand deposit. They cannot say you give 1 lakh rupees whenever you want you can withdraw. I'll give you ATM card and checkbook also. Not possible. They accept only through time deposits. Are you getting it? And they will have a banking partner. They will have a banking partner. Demand deposits cannot be accepted by an NBFC. Can be accepted by a bank. Check can be issued by a bank. Cannot be issued by an NBFC. And this NHAC is there, no? Sorry, NACH is there, no? National Automatic Clearing House. Previously, whenever you used to give check, no, if you deposit in a specific bank, the photo of that was sorry, literally the check was posted to that specific place. Only then the check used to get cleared. Now that doesn't happen. They click a picture, it will be sent electronically and it will get cleared electronically. Check doesn't move physically anywhere now. That is possible because of the clearing house. Such clearing house facility is given only for bank, not for NBFC. Bank has to help an NBFC. NBFC has to take a service from an existing bank. Then next one is DICGC cover for the deposits that's kept in a bank. No, there is insurance coverage given by RBI. Sorry, insurance coverage given by Ministry of Finance. I told you, no, that insurance, deposit insurance is given up to 5 lakhs now. That is given in the case of bank. With regard to NBFC, no security from the government. And so many disadvantages. There is only one advantage. What is it? FDI. FDI restrictions are there when it comes to bank. NBFC, no such restriction. 100% money foreign people can bring to India and give loans to Indians. And Indians will say, I will not give. Possible. But for banking sector, 74% is the maximum FDI that can be there in private sector. And if it is public sector, max 20. You can't take more than 20% of the entire capital from FDI. Foreign direct. Okay. Very good. So then for you to operate as an NBFC in India, you need to have 2 crore rupees of net owned funds to take registration under Companies Act 2013 and also take certification from RBI. Certain cases में certification from RBI is not required. You need to take registration under Companies Act and certificate from RBI. RBI certificate is not required in certain cases. When is RBI certificate not required? Whenever you are closely regulated by an other entity, other government body, RBI will say you take their permission. Let us say yours is a company which is closely regulating with NHB, National Housing Board, and you're giving loans to people. NHB is there, no? NHB will regulate. RBI will say, don't ask me to give certificate, you take permission from NHB. I'm very happy. If yours is a stock exchange is an NBFC or stock broker, all of these people are closely regulated by SEBI, venture capitalists. All these are very closely monitored by SEBI. RBI will say, I don't have to give you any certification. There is a specialized body SEBI. You take their permission, more than sufficient. Insurance companies are also NBFCs. If there is an insurance company, you don't have to take permission from RBI. Say IRDA is there. You take permission from there, I am done. Here, RBI certification is not required. If the business is housing finance, chit fund business, merchant banking, stock exchange, stock broking, and venture capitalists, insurance companies, all these companies need not take RBI certification. Why? They take, they're very closely regulated by NHB, SEBI, IRDA, or MCA. They take certification from the respective authority, and RBI says, I don't have to give you any certificate for you to do business. Got this? Then, when is RBI certificate required? In all other cases. If it is dealing with asset finance company, investment company, loan company, infrastructure loan, infrastructure debt fund company, mortgage company, then it is mandatorily required. There are certain things what an NBFC can do. There are certain things what an NBFC cannot do. Cans and cannots of NBFC. What can an NBFC do? It can acquire shares. It can acquire loans and debentures. It can do leasing, hire purchase, insurance, chit fund business. What can NBFC not do? It cannot do agriculture. It cannot do industry. It cannot do sale of goods and services. And it cannot deal with immovable property. Fantastic. Must for new NBFCs is certificate of registration. Are you getting it? To get certificate of registrations, net owned fund should be 2 crores. Sir, some books they've given 200 lakhs. Yeah, either 200 lakhs or 2 crores. Both are right. Sir, which one should we follow? It is same. 200 lakhs is 2 crores. So we should have net owned funds of how much? 2 crores. How do we find net owned funds? In banking companies, we identified the tier 1 capital. No, the tier 1 capital itself is net owned funds here. Oh, but there is one small catch. There was an initial hiccup what NBFC started to get that NBFC license. No, 2 crores capital is there. So small chit fund business and all will be there. Sri Venkateshwara chit, Sri Murugan Ayappan chits, Sri Bala Murugan chits here. There will be so many small chit fund companies that is there. So they are all illegal if they are not registered as an NBFC. But to register as NBFC, 2 crore rupees. 2 crore is too much. What I do, I collect 100 rupees from everyone at the end of every month. It I'll put and I'll give money to people. I'll auction that discount and all. No, your parents deposit in that chit fund business and all. They pay 5,000, 5,000, 5,000 every month. Every month, first week, Sunday, everyone will go and sit. They'll start auctioning 100, 300, 500, 800, 1,000. 1,000 once, twice, thrice. Everyone has paid 1,000 rupees now. 10,000 rupees is collected or 12,000 rupees is collected. In that 1,000 rupees, they cut 11,000 rupees, they give it to the one who auctioned. That 1,000, what is there? It is distributed as dividend to everyone. Meaning you're supposed to pay 1,000, no. You need not pay 1,000. You should pay 1,000 minus 1,000 by 12. That less money, whatever is received, is given to this person. That's like interest. That and all is not regulated. It's illegal. You can't file a case on the other person. If you file, it will become criminal case. It will not become civil case. It will not become financial case only. For that to happen, you need to register yourself as a company. But 2 crores net owned funds is too much. So you know what do they do? I will create one NBFC. You create one NBFC. I will raise capital. My capital, I will reinvest in your company. You get money. You invest that money in my company. So both of us will cross the limit of 200 lakhs. Both of us will be NBFC. Yay! This is what was happening. That's when they brought in this regulation saying that we take capital plus free reserves, open disclosed reserves, other than revaluation reserves. We take all of this. No, from this, if more than 10% is invested in subsidiary, group company, or another NBFC, it will be deducted. You can invest up to 10%. I understand, boss. You will also invest. You will invest in another NBFC or group NBFC. Okay, up to how much? 10%. Beyond 10% of your own capital fund, if you're investing in something, you are actually symphonying funds. You raised 100 lakhs. In that, you give 10 lakhs. Okay, you give 50 lakhs in 100 lakhs that you raised. It means you actually raised only 50 lakhs. No? Are you getting it? So that is not allowed. So what do we do? Net owned funds is computed like this. You take paid up capital, equity, preference shares, which are compulsorily to be converted into equity shares, security premium, and all other statutory and disclosed reserves, capital reserve other than revaluation reserve. When we take this, from this, we basically deduct the investment made in subsidiary, group, or other NBFC if it exceeds 10% of owned funds. This is owned funds. If you invest more than 10, if you invest up to 10%, no problem. You raised 250 lakhs. 25 lakhs you invested in one subsidiary or one more NBFC or one more group company. No problem. You invest 30 lakhs, then I'll deduct it. That is not to be part of your own capital, own funds. You getting what I'm trying to tell? Did you understand the logic, reasoning? That's how we compute our net owned funds. And this net owned fund should be how much? 200 lakhs. Questions in NBFC, if it comes, it will be on computation of this only, guys. To compute net owned fund. And next, we need to understand the types of NBFCs. NBFCs can be deposit taking or non-deposit taking. And there is one more classification. It can be systematically important and not systematically important. Sir, what is this deposit taking, not deposit taking? It will accept public deposits in the term of fixed deposit or term deposits. If it accepts, it is DTC. If it doesn't accept, it is NDTC. You're getting it? Then what is this SI, NSI? As an NBFC, you lend money, no? Or you do business, no? That business, what you're doing, it's a product which is systematically important. It is covered under the list that is given by Ministry of Finance to be considered systematically important is SI. If the nature of business that you're doing is not included in that list, it is NSI. So NBFCs can be classified on the basis of deposit to NBFC ETC, NBFC NDTC. DTC means deposit taking company. NDTC is non-deposit taking company. Based on the line of business that you do, it can be classified into SI, NSI. SI is systematically important, NSI is non-systematically important. So total variety is NBFC, SI, DTC, NBFC, SI, and DTC. NBFC, NSI, DTC, NBFC, SI, and DTC. Meaning non-banking financial corporation systematically important depositing corporation, non-banking financial corporation systematically important non-depositing corporation. Non-banking financial corporation, non-systematically important, they would say depositing corporation, and non-systematically important non-depositing corporation. So four varieties. Get this, sir? Why do we have to learn this four categories? Provisioning rates are there, no? There for systematically important 1%, for not systematically important one more percentage. Sir, why sir so much torture? Feel happy. Before 2018, people used to learn two sets of rates. Now it is only one set of rates. 2018 only it changed. So around 2018 when people were writing exam, if deposit was collected before 1st of April 2018, this percentage. If deposit is collected after 1st of April 2018, this percentage. Two sets of percentages. Now you have only one. Why? That is phased out. That is phased out. Got it? Hello. Let's see the classification of assets. Two. I would say performing and non-performing. Performing assets are standard assets. Non-performing assets, substandard, doubtful, loss. Now, when do we call it? When the interest is received on time, we call it as standard asset. When the interest is not received up to 90 days, it will be still considered. Sorry, up to 6 months. NBFC, 6 months. How many months? Up to 6 months or 12 months in the case of hire purchase. In the case of hire purchase, how many months? It will be still considered as standard. Beyond the period of 6 months for other than hire purchase, beyond the period of 12 months for hire purchase, it will be called as substandard. Once it becomes substandard, it will remain as substandard based on SI or NSI. If it is systematically important, it will remain as substandard for 12 months. If it is not systematically important, it will remain as substandard for 18 months. After that, it will become doubtful. Same 0 to 1, 1 to 3, greater than 3. And it can eventually become loss asset also. When will it be regarded as loss asset? When RBI or the auditor or NBFC thinks that it is not supposed to be received and it should be regarded as loss asset. Got this? Then why do we classify these into performing, non-performing? Hey, remember this. This is important. Huh? For standard, what is the time period? 12 months, 6 months in the case of normal and 12 months in the case of our hire purchase. Provisioning rates are also different. Provisioning rates are also different. So if it is a performing asset, interest should be recognized on accrual basis. That is as and when it is earned. We don't wait for receipt. However, if it is non-performing asset, interest will be recognized only and only when it is received. Only and only when it is, not when it is earned. Got this? Then we'll discuss the provisioning rates. For standard assets, the provisioning rate, if it is systematically important, 0.4%. If it is not systematically important, 0.25%. For standard assets, systematically important, not systematically important, 0.25. For substandard assets, what do we do? 10%. For substandard assets, 10%. For doubtful assets, there it was 25, 40, 100. Correct? Here it is not 25, 40, 100. Here it is 20, 30, 50. 20, 0 to 1, 30, 1 to 3, 50 greater than 3. Not secured, 100%. Loss asset, 100%. Did you understand this? This is for other than hire purchase. For hire purchase based loans, no, the percentaging is very, very different. Observe, for hire purchase, if the due is up to 12 months, no problem. Sorry, if the due is up to 12 months, standard. If it is 12 to 24 months, 10% of net book value. These all 12 tables, 0 to 12, 0, 12 to 24, 24 to 36, 36 to 48, 48 and above. 100, 70, 40, 10. 10, 40, 70, 100. 10%, 40%, 70% and 100%. 10%, 40%, 70%, 100%. Up to 12 months, no provision. 12 to 24, 10%. 24 to 36, 40%. 36 to 48, 70%. Greater than 48 months, 100%. Got it? This is the provisioning for hire purchase. Capital adequacy ratio, like how we do for banking companies. Capital fund, divided by risk weighted assets multiplied by 100. How do we find capital fund? Same. Tier 1 capital plus Tier 2 capital. Tier 1 capital is same to same what we found there. What did we find? Net owned funds. Paid up capital plus compulsorily convertible preference shares plus free reserves plus security premium plus capital reserve other than revaluation reserve minus accumulated losses. From this we deduct investment in subsidiary in the form of equity or debenture if it is more than 10% of what? Of own funds. This is gross own funds what we get here. When we deduct more than, if it is more than 10, we deduct it. Then we get what? Net own fund. Understood that? This net own funds is found. Now, what is it? Tier 2 capital. Tier 2 capital will be that revaluation reserve. There are several other items which I've put, but don't worry, you won't get those. Yeah. Preference shares other than what's there in Tier 1. Revaluation reserve after deducting 55%. And then several other items are there. But don't worry about this. This will not be questioned to you. That's it. Tier 2 capital in no case can exceed Tier 1. Always Tier 1 only should be more than Tier. Then we apply this risk weighted assets. Risk weighted assets, don't worry, they'll tell risk in the question. They will not ask you to compute. We have to say this capital adequacy ratio questions are only not there. Previously, when this material was first published, there were two questions. Now in the recent edition, there is no questions on capital adequacy ratio. Is there any questions? I don't think there is any questions, but theory is there in ICA study material, so I have covered. I don't want to leave it untouched. If the question comes, they will only tell risk. This much is the risk against this. So you multiply the risk and then find it, because it is the last attempt. They don't want to let people go. If they give, in case you cut close and then go. Don't leave it untouched. Very similar to banking. And it should be minimum how much? 15%. By this, we finish with our banking companies and non-banking financial companies. Similar, not similar? Similar. ಏನಾಯ್ತು ಬ್ಯಾಂಕಿಂಗು ಎನ್ ಬಿ ಎಫ್ ಸಿ ಆಯ್ತಾ ಈಗ ಏನ್ ಮಾಡೋದು ಲಿಕ್ವಿಡೇಷನ್ ಇಸಾಪ್ ಬೈಬ್ಯಾಕ್ ಬೇಗ ಬೇಗ ಮಾಡೋದಾ ಬೈಬ್ಯಾಕಾ ಲಿಕ್ವಿಡೇಷನ್ ಬೇಡವಾ shall I finish liquidation or you don't want? Actually, liquidation in detail, there is video on the same YouTube channel. It's about 20 minutes ka 3 videos are there. Detailed mein liquidation is there. On each variety, one question is also there. If you say that you will watch that and you want me to go to ESOP, I'll go to ESOP. Illa liquidation ಮಾಡಿ ಅಂದ್ರೆ ಮಾಡ್ತೀನಿ. ESOP liquidation, I'll share the link. If you want, you better you watch it. Okay. Actually, you should see, because now do you agree with me that banking NBFC, you might have read, I'm not denying your preparation, but do you agree with me that the class made it little better with certain organizing things? Same with regard to liquidation also. Liquidation, majority of you usually start with a chapter or start with what topic do you start? Usually start with B list contributories, or you start with liquidator's final statement of account. You get it? But the correct order is not that. Correct order is first you should do statement of affairs. After you finish statement of affairs, you should do liquidator's final statement of account, and finally you should do B list contributories. I've told the reason and everything in comprehension. It is actually very nice material for you to revise the topic. See this liquidation of companies mein, the ordering is actually very nice. The topic mein, why, what is statement of affairs, why do we prepare, how do we prepare, and then the order of things. You have that list A, list B, list C, list D. I have made a very nice format how to remember that. A is preference, so to say, A is assets realized, ASP and ANSP. C is government, this is Nirmala aunty, this is employees, this is laborers, need to pay them. Then D is debenture holder, E is unsecured creditors, F is preference shareholder, excited guy, G is equity shareholder waiting for him to get the money, and H is deficiency or surplus. Then we discuss things in detail, how to compute that liquidator's remuneration, when they use the language all assets, when they use the language net assets, when they use the language say some assets, how do you compute remuneration out of that? Gross assets, net assets, ETA, gross assets, total assets, all assets. When the liquidator is entitled to percentage of commission, how much? 2% on gross assets. And what do we compute? ANSP only, or ANSP plus surplus of ASP, or ANSP plus ASP? And they say total assets, what do you do? And they say all assets, what do you do? And they just say 1% of assets, then what do you do? Are you getting it? So such kind of cases, everything in theoretical format and complete may we've discussed efficiency, and then this how to identify and everything. You guys, I would recommend you to do it. It will be little helpful to you. And this is liquidator's final statement of account. And finally, we have the topic of B list contributories also. So this is the one. C. GTA, gross assets, total assets, all assets. Ella. This topic is also not there for next attempt. Shall I go to ESOP or buyback? Buyback. We'll do both. First ESOP, then buyback. We'll finish it 5:30 only. Don't worry. By 5. Employee stock option plan. Section 53 of Companies Act 2013 restricts us to issue of shares at discount. Am I right? However, Section 54 of Companies Act 2013 allows us to issue shares at discount if it is in the form of sweat equity share. If it is in the form of sweat equity share. So people in the last decade have become super rich and billionaires because of ESOPs. So ESOP is an amazing thing that has happened to Indian economy, because when the IT sector was in boom and every IT employee wanted to quit a company, change the company for getting higher salary, and people who were loyal were getting lesser increment than the people who kept on hopping the company for 30% hike. This is a sword that was used to retain the employee in the company. They never felt that it is their company, and that's the reason they were hopping. The company told, if you stay in the company for 3 years, I will give you 100 shares at 20 rupees. But each share of the company is now traded in the market at 1500 rupees. But the company told, I'll give it to you at 20 rupees. How many shares? 100 shares. But you should work with me for 3 years. The employee was excited. If I work with the company for 3 years, I'll get 1150 rupees share at 20 rupees only. If I pay 20, I'll get 1150 rupees worth of share. 1150 minus 20, 1130 into 100. Oh my God, so much of money. And then the employee started retaining back into the company. And whenever the company started doing it, the point is the nominal value of the share is only 10. When they issue it at 20, still they're collecting premium of 10. But shareholders will be little at disadvantage. They'll be like, hey, we paid so much money, we earned so much money, which is accumulated into reserves. Now these employees from their workroom, they're straight away coming into the general meeting and they'll vote and all. This is not fair. Then the company convinced them, shareholders, saying that, see, if in case they keep switching the company, that reserves what you see now no will not be there tomorrow. You somewhere one day will come, you do eating, general meeting, voting, and then you go. But who will work daily? They. So you should make them feel responsible. That is the reason I'm giving. So you convince your equity shareholders that there will be no dilution in their voting rights, and then tell them that it's for the good of the company, and then you go ahead with this ESOP. To do this, you need to keep the power in articles of association. Government of India was so happy because the middle class people, lower middle class people, and all these people who would basically not invest in capital markets, keep the money in Chiti Vyavara, keep the money in gold, keep the money in the puja room, living room of the house, their money is now coming into market. So government was very happy. Government told 1150 rupees share. You are issuing it at 20 rupees to the employee. 1130 rupees difference is there. No, I will let you treat it as expense. Government is also giving you this privilege. You will say, what is big deal about it? When you treat 1130 rupees, you will still treat issue price as 1200 or 1150. What you collected is 20. 1130, what is not collected, you will treat it as expense. When you charge so much expense, your profit will decrease, you will save tax. So much of money, you will treat it as employee benefit expense. Expense incurred to retain the employee within the organization. Now, you incur this expense to retain the employee within the organization for a period of 3 years. So this expense has to be booked over 3 years. This expense has to be booked over 3 years. So each year you will go on making the provision. It is not actual expense. You don't pay cash. So first year, let us say for our is 1220 is the issue price. What is issue price? 1220. You will collect 20 rupees from employee. So how much is your employee benefit cost? 1200 per share. First year 400 rupees expense. Second year 400 expense. Third year 400 expense. 400, 400, 400. You charge to P&L. You're not paying cash. It will stay as provision in balance sheet liability side in reserves. It's called as employee stock option outstanding. So at the end of third year, if the employee is still there, he will give 20 rupees. You will write bank account debit 20. And that provision, whatever you had made by way of reserves, you will debit that employee stock option debit 1200. To equity share capital 10 rupees, balance money security premium. This is what you will do. Did you get this? You will book expense, you will use it as premium. So it will basically go from your P&L account balance to security premium in reserves. There's not much of a change there. But you take advantage and tax advantage and expense against it. And employee also will be happy because he feels like he's the owner. Government is also happy because money is coming into the capital market. Everyone's happy. So I say, well, I am also happy. Come on, do one chapter on this source. Students are also happy because easy chapter will get 10 marks in the examination. So that's how this chapter happens. And here, whenever you give shares to employee, there are certain conditions, performance based conditions. Performance can be two: market performance, employee performance. Market performance, company will tell, if my company's rate of return becomes 10% at the end of 1 year, first year only I'll give you shares. If it doesn't become 10%, we'll wait for 2 years. 2 years it should become minimum 8%. If 2 years my average rate of return is 8%, then I'll give you shares at the end of 2 years. No, then I will wait for third year. At the end of third year, if it becomes 7%, then I'll give. This is market condition. This market condition. It can be rate of return earned by the company, target share price of the company, completion of specific project by the company, or any other target. If this is the case, then it is based on the company, no, not driven by single employee. What do? We create provision for the first year based on the number of employees who are there, multiplied by number of options that is there for the employee, multiplied by intrinsic value. What is intrinsic value? The value at which the share is to be issued minus the value that will be collected from the employee. Difference is our expense. Am I right? Value at which the share is issued deducted by value at which the share money that is collected from the employee, difference multiplied by number of employees into options per employee, multiplied by the year in which we are doing provision, divided by total years. Too much provision we make. In the next year, some employees might leave, some employees options will lapse. So we'll take the number of employees still eligible, multiply by number of options still eligible, multiplied by cost per option, multiplied by the year in which we're doing it, divided by the total. Whatever provision we compute, no, it is not the total provision, but what we compute is a provision to be maintained at the end of that year. We compute the provision to be maintained at the end of second year. Then we deduct the provision that was already created at the end of first year. Difference provision will be created in second year. If in case, if it turns out that so many employees have left, that we have higher provision in first year than what is required at the end of second year, then what do we do? Such excess provision will be reversed by transfer to general reserve. Third year you need how much ever required, you create provision. Are you getting what I'm trying to tell? This is how we do. This is if it is market based performance. If it is employee based performance, you give an employee based target. You need to save cost of 10%. You need to bring the cost of production below this. You had kept such target. If in case first year you are expecting the employee to complete the target in 2 years, you create half provision. Second year the employee failed. What do? Provision whatever you have collected, no, fully reversed by transfer to P&L. Third year he fulfilled the target and you are giving him ESOP. Third year create full provision. So if it is market based, we will adjust the provision created for one option to another option. First year provision is created for 100 employees. In the 20 employees leave. Second year 80 employees are there. For that 80 we should create provision, no? Here 20 who left, for them we've already created first year provision, which is no longer required. That will be adjusted against this 80 employees provision. Only balance will be created. This is for market condition based. If it is individual employee condition based, if people don't perform, reverse the entire amount by transfer to P&L. And later when they perform, you need to create the provision. So this is how you do it. Number of options outstanding multiplied by current market price minus excise price multiplied by current year divided by total vesting period minus the expense already. This is how we do. There are some questions on this. Very easy to do chapter this is. And I hope you people have done this before. Have you? Did I cover the topic whatever was required to be done in this chapter, both the varieties with the entries? And just to tell you, the entries will be, when you create the expense entry, will be employee stock options outstanding will be credited and employee benefit expense account will be debited. Entry will be employee compensation expense to employee stock option outstanding. Done. And this employee compensation expense will be transferred to P&L. Entry is P&L to employee compensation expense. On the excise date, bank account debit to employee stock option outstanding account debit to equity share capital to security premium, whatever is there. And if it lapses, you transfer it back to general. Only these three entries, different dates may you should do. Sometimes you might have to prepare a bigger table to identify how much money is to be created, targets has it been met or not. There is one question where there's a target given 12% and vesting period is not mentioned. 12% will not be met in first year. So you end up thinking vesting period is second year. And then you think at the end of second year, you understand vesting period is not second year also. Then you rechange the vesting period to third year and then do, and at the end of third year, actually it vests. So such kind of problem, there are two questions in ICA study material. One is in study material, one is in RTP. So you do one of them at least for you to be more comfortable with that. Got it? Yeah. Anything more in ESOP that you want me to touch upon? Can I go to buyback? So we finish buyback, we would be not doing two topics. One is internal reconstruction, liquidation. Other than that, rest everything is touched upon. Come on, let's quickly do buyback. And not even a single bit of theory is missed. Okay, there is something called as reload feature, reload option, and why does company issue ESOP. All these three have been questioned. One in RTP and two questions have come in ICA exam only in the past. People ignore these theory questions and then go. Such an easy thing to read. If in case you read this, no, you'll get 4 marks when the question comes little offbeat from the exam. So please do read little bit of theory also. Accounts and the only problems ಮಾಡಿ ಹೋಗ್ತೀರಾ. Sometimes theory will be the easy, very, very easy ones in the examination. Yeah, let's start with buyback and shares with differential rights. Equity shares can be bought back, preference shares can be redeemed. Equity shares cannot be redeemed, preference shares cannot be bought back. Why does the company go for buyback? Very simple. In the market, if the price of the company is very low and the company thinks that price is not correct, then the company to give support, what do they say? They'll say market 1,700. Yeah, I will only give 1,900. Whoever wants to sell it to me. That's the offer that the company is giving. That's what we call as whenever company buys back, company will take the share back from the employee or say that people and then give them money. Correct. But whenever company takes the share back, share capital is reducing. I told you yesterday, I'm telling you today also, capital of the company cannot reduce other than by way of capital reduction approved by court of law under internal reconstruction. How can you reduce the capital? So whenever you buy back the share, you should create CR. You create. However, for the purpose of buyback, funds can be raised by way of fresh issue. If you raise the funds by way of fresh issue, should you create CRR? No. Only to the extent nominal value of the fresh issue is lesser than the nominal value of shares bought back. You can go for. Got it? Same class of shares cannot be issued. It's a different class of shares. You are buying back equity shares, you will issue preference shares and then collect the money. You can sell investments. You can sell assets. You can use the cash that you have. But if you do it other than by way of fresh issue, you would have to create CRR, capital reserve ratio. Got this? Sorry. Capital redemption reserve, CRR banking companies model. There's a lot of theory. Why do we do this buyback? What will happen? What will be the impact on the market? Hostile takeover, L1. Say the movie story here. So buyback is like BB. BB means like wedding. So you need to remember, whenever there is wedding, from 30-40 days before only, you will full apply SPF sun cream and then sit at home. First tanning will happen. So sources of funds for the purpose of buyback can come from three places. SPF. What is S? Share proceeds. P. Premium. F. Fresh issue. One second. SPF. It can come from security premium. It can come from proceeds of fresh issue or free reserves. These are the three resources from which you can take money. And how much of buyback is possible? Buyback is possible to the extent of 25%, up to 10% or 10% buyback. Then you don't have to take a say general meeting resolution. Just do board resolution and then go for buyback. If it is more than 10 and up to 25, then you should go for special resolution. You should take everyone's consent and only then you can do it. Pass a special resolution and then do it. So buyback is like wedding. No, you take the permission of the people in the close family. If the age gap is 10, the age gap is more than 10, then you should take everyone's approval. All the relatives should say yes. If not, they'll mock at you. And child marriage is not allowed. Meaning, if the share is not fully paid up, you can't do buyback. For you to do buyback, the share should be fully paid up. Got it? Then observe this. So to be authorized by AOA, there should be power in AOA and the share should be fully paid up. If it is not fully paid up, you can't do it. Then resolution, board resolution, if it is up to 10%, 10 more than 10 up to 25, special resolution. And in order to do buyback, whenever you want to do buyback, just do DRS, decision review test. What is it? To do the debt equity ratio test, resource test, and share outstanding test. When you do buyback, your equity is reducing. So ultimately, your debt will be more than equity in that case. But the ratio of 2:1 should not be bigadified. It should be minimum 2:1, meaning debt cannot exceed more than 2 times of capital after you buy back. Debt cannot exceed more than 2 times of capital. Minimum equity should be half of debt, or maximum debt should be 2 times capital. Debt cannot be more than 2 times, or equity cannot be less than half of debt after buyback. And the second one, resource test, we call it R, resource test. Resource test says that whatever funds that you use for the purpose of buyback, it should be less than 25% of paid up capital plus free reserves. PUC plus free reserves into 25% what you do. That is the maximum money that you can use for buyback, whether to pay nominal value or to pay premium. And at any point of time, the buyback of that you're doing cannot exceed more than 10% of the shares outstanding. TRS test. Did you get this? These three tests have to be complied with. Whenever they only tell this much amount of shares we are trying to buy back, is it okay? Is this possible? You will check under each of the test and then tell this is okay or this is not okay. The questions become very, very interesting when they ask you to find out how much shares are supposed to be bought back. That's where what will happen at that case is you would have to create CRR. When you create CRR, some part of reserves are decreasing. Understood? And then debt equity ratio should be 2:1. So there you end up writing this X number of shares are bought, Y, X, Y will come, and one very, very weird, irritating equation will come. Are you getting it? The only way to skip that is very, very simple thing. This is the formula. Paid up capital plus free reserves plus security premium. This is there, no? Minus 50% of debt. It should be equal to 50%, no? If you deduct 50% from it, paid up capital plus free reserves plus security premium, SPF. SPF. This is a resource available for buyback. From this, you deduct 50% of debt. That should be the minimum equity. Divide by buyback price plus nominal value. Buyback price because so much of funds is going out. Nominal value because CRR will be created to this extent. You add these two. Whatever the answer you get, that is the maximum number of shares that can be bought back in debt equity ratio. Looks very simple, no? Remember, what is it? SPF. What is it? Security premium, free reserves, paid up capital. Minus 50% of debt divided by buyback price per share plus nominal value per share. I'll solve a question on this and then show it. Very quick. Very quick, very quick. I'll not take too much time. Don't worry. Please, please. Debt equity ratio based. Question number 5 in your ratio study. The same question is there in ICA study material. Yeah. Pratham Limited. Page number 8. I'll show the question on board for those who don't have the. Don't worry. Same question is there in ICS study material. Don't worry. Pratham Limited. Have a look. So Pratham Limited, a non-listed company, has the following capital structure as on 31st of March 2018. They are requesting us to compute the maximum number of shares that can be bought back in the light of above information. Equity share capital 30 lakh. Debt equity ratio test we're doing. Equity share capital how much? 30 lakh. Reserves and surplus. General reserve 32 lakh 50. Security premium 6 lakh and P&L account 4 lakh 30. We'll take all these three. We'll not take revaluation reserve. Add all these three. Sorry, add all 4. 30 plus 32 50 plus 6 lakh plus 4 lakh 30. See? What do we get? Do we get 42 lakh? Do we get 42 lakh? So this is your XO, X by 1, all that. Now I'm doing straight. You get that? Minus 50% of debt. How much is debt? 42 lakh into 50%. How much? 21 lakh. Deduct. You get 72.8 alva. And you got 72.8 paid up capital plus free reserves plus security premium minus 21 lakh. What do we get? 51 point whatever divided by 40 rupees. How did we get 40? Nominal value per share is 10 and buyback price per share is 30. 30 plus 10. What do we get? 40 Madi. 1,29,500 shares. If you do that X method, right, debt equity ratio and then take X and then do the entire thing, you'll get 1,29,500. Wherever you have read from, whichever material you read from, whichever kind of question you have done, for that question, please apply this concept. And I'm not just dumping one formula on you. I'm also teaching you the logic. The sources of fund, resources of fund for the purpose of buyback is SPF. add SPF. It should be maintained 50% of debt, deduct 50% of debt, divided by buyback price plus nominal value by CRR should be created. To deduct these two, you will get the maximum number of shares under the debt equity ratio test. Resource test is simple, no? PUC plus what to say free reserves. Security premium is also taken in that, and on that we divide it by number of 25% is the maximum funds. Multiply by 25%. Whatever you get, divided by buyback price 30. That is the maximum number. And share outstanding test is even more simple. Number of shares outstanding multiplied by 10%. Are you getting it? And the journal entries for buyback is first shares bought back account debit to bank account. Premium, if any, adjust it. And then you will write what to say CRR creation, free reserves, general reserve or P&L account debit to free. You understand this? This is the quickest time in which anyone could finish buyback. Thank you people for letting me do that buyback in such. If you want me to teach any part of buyback which you are worried, which is bothering you, please do tell. Internal reconstruction is based on journal entries that you can handle. I'm giving it to you because you people told me. And liquidation of companies. Whenever you see this video, I'll give you another set of videos. It is 3-4 videos, not 1 hour, 1.5 hour, 2 hour videos. Short videos. Entire liquidation you can finish it in 1 hour. All the concepts end to end is covered without leaving a single line that is there in the IC study. But it is nice, and I've taught you a technique to remember the order also. How to do statement of affairs, how to do liquidator's final statement of account, as well as how to do P-list contract. And I think if you do that, can I say that is it safe for me to say that we are done with group 2 advanced accounting? Yes or no? Yes, Venkat. Creative listing ಯಾವ್ದು ಹೇಳು ನಂಬರ್ ಹೇಳ್ತೀಯಾ ಯಶಸ್ ಮೆಟೀರಿಯಲ್ ನೋಡಿ ನಂಬರ್ ಹೇಳಕ್ಕಾಗತ್ತಾ you think number illustration 6 ಎಲ್ಲ ಕ್ವಶನ್ ಸಾಲ್ವ್ ಮಾಡಿದೀನಿ I can share the answer to you if you want 16 detail ಆಗಿ ಸಾಲ್ವ್ ಮಾಡಿದೀನಿ if you want I can share the answer to you detailed like smallest of the things 1,45,000 into 7 into 1 by 1 1 by 2 smallest of the things not even a single addition or subtraction is done without telling and I've solved the same question in 2 methods. I don't mind doing, but without the context and without teaching the problems before this, if I straight away do this, it might tamper the confidence of some people. But I can share the entire solution to you in detail. This is not how the presentation is done in the study material. I have changed the presentation a little to make it more simpler to understand. I'll share. If in case you do have doubt, I'll answer. We'll be there tomorrow also. I'm there tomorrow. Got it? Yes. For people who are watching this session on YouTube, I hope you people liked it. In the description to this very video, I will add liquidation of companies video also. Please do not like, share, subscribe and all. Do study well for your examination and then clear very soon. You can definitely share it with the people whom you think it's very beneficial for. That's it, guys. For people who are watching it recorded. Shall we wind it up for the day? Very good, guys. You guys learn anything new today? Did you guys have little fun today? Remember, life is not a battle to be struggling. It's a game to be enjoyed. Till the time you're learning something, you're having fun. It's all good. The day you guys see that you stop learning something or stop having fun, trust me, you might start struggling because you might be in a battle. So thumb rule to stay happy is pretty simple. It is to stay in the game. So one last time on this day, I have just one simple question for all of you. Are we in the game? Are we in the game? Are we in the game? That's it, guys. Ta-ta, bye-bye. Take care. See you all tomorrow if you're coming for group 1 leftover portion. Otherwise, do really within your examinations. You're at a different stage altogether. One fine day. Best of luck. Take care. Ta-ta, bye-bye.